This video course is everything that I wish I had when I first started in crypto back in 2017, so about like 7 years ago. Now, if you stumbled across this video, you're extremely lucky because I'm going to be explaining in this 4 or 5 hour video what I believe to be the #1 strategy to make millions of dollars from the crypto market. And trust me, I've tried everything. I've done day trading, swing trading, flipping NFTs, pre-sales, airdrop farming, automated and manual. I've done everything. And after all these different strategies I've followed, I've looked at the one that made me the most money, the one that has the highest probability of success, that the most amount of people can do. And that's what I'm going to teach you in this video. And I think it's by far the #1 strategy. And yes, this strategy works because this strategy in particular that I'm teaching you made me millions of dollars from crypto in the past 7 years that I've been in the space. And so a couple reasons why I think this strategy is really, really good to follow is #1, it's beginner friendly. With trading, you need years and years of experience to make money as a trader. With this strategy, it's more a long-term approach. You don't need to be a complete advanced crypto participant. It has a low skill barrier. So you don't need years of experience. It's low time commitment as well. You don't need to be staring at the charts 50 hours a day. You can do this part-time, running a business or working a full-time career. It's not a huge time commitment strategy. And also it can be scaled infinitely to work at any capital size. So some strategies people will teach you, it'll work on $100,000 market cap meme coins where you can put 10 bucks in, but you can't put $100,000 into this. Whereas the strategy I'm going to teach you, you can do it with millions of dollars, you can do it with $1,000, it doesn't matter. And so around this strategy, what I'm going to teach you is market psychology. So you need to understand how the market works, why it works the way it does, how humans influence the movement of the market through fear and greed. I'm also going to teach you fundamental analysis. So how do you analyze a project? How do you know if it's good or bad? You need to understand this. Mindset training, that's #3. So how do you control your emotions? How do you know when you're making an emotional decision? How do you avoid being impatient? All these different things. #4, how to avoid scams and hacks. If you're going to make all these millions of dollars, but you lose it in a hack, well, that was pointless. #5, technical analysis. You need to understand how to read a chart. #6, how to minimize your tax liabilities. So if you make all this money, but you're not set up properly for taxes, you're going to get completely wrecked by the government. Last but not least, understanding crypto price action and cycles. So the way that crypto moves is different to the way the stock market moves. You need to understand what the difference is so that you can be ready for it. And this YouTube video that you're watching right now is a 4-hour excerpt of the full course is about 30 hours. So if you want it, it's in the description below. But the strategy that I'm teaching you today is simple, but it's not easy. And to summarize the strategy into one sentence, what I'm going to teach you is long-term investing into new altcoins which have 10 to 100x upside potential, researching these projects using my 14-step fundamental analysis checklist, buying these coins during market capitulations, and then exiting these coins once your thesis for the investment has played out. And I'm going to teach you how to build a thesis, how to identify market capitulations, how to hold through the volatility and everything in between. And again, it's a simple strategy, but there is a lot to it. You can't just come into crypto with a strategy. You have to understand everything around it. So as a disclaimer, before we finally get started on this video, I want you to understand a couple more things. #1, this is a long course. 30 hours is a long time. It's probably going to take you a while just to even watch the 4 hours of this YouTube video. If you're going to dedicate to crypto, make sure you actually watch this video. Some of you are going to watch it and you're going to go on your phone on TikTok or play Fortnite and have it in the background. I don't recommend this. If you're going to watch this course and try to make millions of dollars from the market, you got to take it seriously. So I recommend getting out a pen and paper, taking notes, watching some sections twice, not having any distractions around you. If you watch this video, make sure you do it fully focused. Because if you can't spend a few hours focused on learning 10,000 hours of crypto knowledge condensed into 30 hours, how are you going to make millions of dollars? #2, nothing said in this video is financial advice. I'm an educator. I like teaching people what I'm doing. Doesn't mean you have to do it, but I'm just showing you what I've done and what has worked for me. And #3, this course might seem a bit jumbled. I'm talking about a strategy, but sometimes I'm going to talk about mindset. Sometimes I'm going to talk about how to minimize tax liability. Sometimes I'm going to talk about market psychology. And you're going to say to yourself, Daniel, you talked about a strategy. Where's the strategy? In order for you to make money in crypto, all these different moving parts connect together into one piece, which is the full strategy. I can tell you what coin to buy, when to sell it. But if you don't know how to control your emotions to handle the volatility along the way, you're not going to be able to do it. So that's why the course might seem jumbled, but trust me, it's not. Each moving piece is important because they all fit together like a jigsaw puzzle. So that's all. Let's get started on the video. Today's lesson is the house always wins. I've spoken about this one a number of times as well, but I'm going to cover quite a few new concepts in this video that you probably haven't seen many people talk about. So you should find this one really interesting. But this is another section of the mindset course. And essentially your mindset to crypto is that you need to understand that the people who always win, regardless of whatever the market does, is the house. And the ultimate goal of any participant in crypto who wants to basically inevitably make huge money, to make millions of dollars, is to find a way to become the house in some way, shape, or form. So what do I mean by the house always wins? What is the house? In a casino, the owner of the casino makes money regardless of what happens in the casino. The people who go sit at the tables, they only have a chance of making money. But the person who owns the casino makes money regardless. So in crypto, it's the same thing. Who is the house? Well, the house is the exchanges, the projects, gurus who teach you how to make money in crypto, the paid groups, the influencers, the marketing agencies who basically help you grow your projects, all these businesses. This is the house. They facilitate the gambling. And these people win regardless of what the market does. It can be a bull market, it can be a bear market, they're still making tons of money. And so there's a number of lessons around this mindset topic of the house always wins. And I want to get into this lesson number one, which is it is almost always better to sell shovels than to dig for gold. So most people watching this video, if not all, are looking at crypto through the lens of how do I dig for gold? But digging for gold isn't necessarily the best path for everybody. Often it is better for you to try to figure out how to sell shovels than it is to try to figure out how to dig for gold. If you think about this expression relates back to the gold rush, where all these people found gold and they're all digging it up. When you're digging for gold, there's only so much that you can dig. And most people who dug gold didn't really make much money. And the people who sold the shovels, they made all the money and they had no risk, because if they could sell a shovel, it doesn't matter how much gold that shovel digs up, they sold the shovel. Same thing in crypto. It's like 90% of people who try to make money in crypto lose, but 100% of people who build a successful business win. Now, obviously, there's a lot of failed projects, there's a lot of failed businesses. So the risk you take in building a project is on the front end. You generally just fail on the front end. The issue with the investing is you have all the risk on the back end. So when you close your position, are you in a profit or are you in a loss? And most people in crypto, they don't struggle with making money, they struggle with keeping it. Most people in crypto make profit. Most of them just don't keep it. That's the biggest problem. They get to the end of the bull run, they don't take profit, they don't understand that it's a highly volatile asset class, all their profit turns into a loss. Or they end up trying leverage trading with all the profits to get even more wealthy because they weren't happy with the amount of wealth they made, and then they lose all their money leverage trading. So all the risk with business is on the front end, all the risk with investing is on the back end. It's can you keep the money? Whereas with business, it's can you get it off the ground? And in my opinion, I think business for a lot of people is a better path. So if you're watching this and you're trying to figure out how to get rich from crypto, becoming the house is a really good option. And if you look at the distribution of how many crypto participants who made at least $1 million, how they made their money, it probably looks like this. So most people who became a millionaire from crypto became a millionaire from selling shovels. And it was only a smaller amount of the pie that people digging for gold actually made the million. Most people who get rich, they built a project, they're on the team of a project. Like there's a lot of invisible millionaires in crypto that you guys don't realize. Imagine, for example, there's how many coins over a $50 million market cap? Well, we can actually go have a look. So there is almost 500 individual projects in crypto that have over a $50 million market cap. Now, of this market cap, how much of the supply of this token is owned by the people who build the project? Well, they take usually anywhere from 40%, 50% is like a rough estimate of how much the founders take. So how many people are on the team of these projects who get equity? How many people have a percent of the tokens that are going to get unlocked in the future? So for example, this coin, maybe they give 30% of the tokens that get created to the team. Let's say you're the lead marketing guy of Fala, you might be entitled to 1%, 0.5%, 0.2%, whatever it is, of the tokens that get unlocked. So as a person who's a part of the house of Fala, you're making risk-free money off of the back of all the people who are digging for gold. And you have to think about, let's imagine each one of these projects has at least 5 people on a team. You do the math of 500 projects, each with 5 people on the team. That's 2,500 people who might be entitled to equity in the form of the tokens that are getting unlocked. And let's say we head into a bull run, the market goes up 4x, all these coins become a $200 million market cap. That's like 2,500 people who very likely receive enough tokens to become a millionaire. Now, I know you think 2,500 millionaires, it's not a lot of people. This is only for 5 people per project on the team. You have to consider that how many millionaires millionaires did Binance make from people on the team? They have hundreds of people on the team. You also have to consider a lot of these projects in crypto don't have tokens. For example, Nansen, it's a data analytics platform. How many people are on the team here who have equity? You also have to consider Dragonfly Capital. This is a crypto VC firm. They're also got a bunch of people on their team who get equity. So you have to consider there's thousands of people, tens of thousands of people who have a house who make the millions, and they represent a large amount. Now, a lot of people in bull runs make millions, but they don't keep them. So maybe there's 20,000 people, 50,000 people who become millionaires from crypto in the bull run from digging for gold. But I would say 80% of them lose the million. They don't keep it. So there's actually only a small amount of people who actually keep the 7-figure mark from their portfolio from digging for gold. So this is just stuff to keep in mind. I'm not saying don't invest. I'm just saying the mindset is the house always wins, and this is proof of it. And it's showing you how big the house is. There's an invisible 3 to 10,000 millionaires from crypto that you'll never know who got rich off of the back of you speculating. It's the invisible millionaires. And they're not on Twitter telling you how they made $1 million. They're not trying to get you to join a paid group. They're not posting content online. They're secret millionaires. They don't want you to know, because these projects don't want you to know that they're becoming millionaires off of the back of you losing money. Like Sui, classic example of a VC coin with no adoption and just tons of VCs waiting to get unlocked. You can see it in the price action. It's just a terrible performing coin. Has a lot of overhead supply. Not many people are interested in it. That's why the chart sucks. For example, there's at least 100 invisible millionaires who are currently a millionaire from Sui. And they're never going to be flexing on you on Twitter, telling you, this is how I made my $1 million, guys. They're invisible. So you don't realize how big the house is because they're never going to be in your face. Most people in crypto got rich through running a VC fund, getting allocations to new coins. So that's what I do. Building projects in the crypto space, being on the team of a project and getting equity, running paid groups. That's what I do. And data analytics businesses. That's what I do. Paid shells of coins, marketing agencies for coins, pump and dump scam coins. And that's how most people got rich. And it's a way more reliable way to get rich from crypto when you build things with real value than speculating on existing assets. But this is for most people. I would say that building things, whether it's in crypto or not, is the best approach for life. Let's say you got rich from investing. You made $1 million. You didn't really provide any value to the world. You're a millionaire, but you didn't really do anything to get there. You made magic internet beans. Like, did you really deserve to make that money? It's always a really good idea to try to approach crypto from the mindset of like, is there a way that I can build something real with real value to make money from? Or maybe even building something outside of crypto. It doesn't have to be in crypto. Building things is generally the right way. You want to try to become the house in any way you can, whether it's in crypto or out of crypto. Being the house also means that you can get rich regardless of the direction of the market. So as an investor, which is my main approach and maybe what you're going to do mostly as well watching this video, we need the market to go up to make money. We need the bull run. I mean, I might make some money, but I'm not becoming worth 8 figures in a bear market. That's just not going to happen. I'm just not that good at it. I need a bull run to get to 8 figures, just being honest. If I was just to build projects in crypto, I could get to 8 figures without the market going up. We could be in a fucking 5-year bear market. I'll still get to multi-millions because I'll be building things. So getting rich is in your control when you become the house because the outcome is down to your work ethic. In business, if you just work harder and smarter and longer than anyone else, you'll make money. In crypto, I know people who've been doing it for 7 years full time, they still haven't made money. And more time in crypto doesn't necessarily mean more money, but in business, more time put in does mean more money. It's just a work ethic thing. It's just like you work harder and smarter than the competition, you beat them. Doesn't really work like that in investing. You can try so hard to make money and you'll probably make less. If you work less hard, if you get lazy, you sort of almost make more money in the end. Let's say you're lazy, you don't look at the charts as much, you buy and you hold. There you go. That's 2 of the most important things. Don't stare at charts all day. Let your positions run. Don't micromanage them. It's sort of like reverse to investing. And also investing, you need the market to go up. Do you control the market going up? No. Can you force a coin to go 10x? No. Can you force yourself to make money? No. You cannot force profits. So that's a little bit of another difference between being the house and being the investor. If you get an opportunity to become the house, take it. It's my advice. That's lesson number 1 of the house. Then number 2. Lesson number 3 is you need to understand that the house in crypto is actually a net outflow of money out of crypto. So this is a big problem because if you want to buy things in the real world, like most things, especially expensive things, they don't take crypto. If you want to buy a $40 million mansion like Mr. Curve CEO over here, you're not paying with Curve tokens. You're selling the Curve tokens to stable coins, putting the stable coins into your bank account, and then you're buying the mansion. So this is a problem with crypto. We don't use it enough as money where it's not flowing out of the ecosystem. To use your crypto, you generally still need to withdraw it to fiat currency. That's a problem. So in the bull run, all these VCs and all these exchanges and coins, they make all this money, way more than in the bear market, and that just increases their outflow. They go from withdrawing maybe maybe 50 mil a month to maybe 500 mil a month. And it's hard for the inflow to keep up with this outflow when it gets high enough. That's one factor for why we get big bear markets, because in the stock world, the money sort of stays in that system. Obviously, you sell a stock for cash, but it's still the same system. It's the traditional system. But in crypto, that money is out of crypto. It's in a totally different financial system. If we could find a way to allow people to buy things with stable coins, then project founders would be keeping their money in the crypto ecosystem, which would be a lot more beneficial for the long term. Because when you take money out of crypto, let's say the Curve founder takes 40 million of Curve, turns it into a house. He gave the $40 million to someone for this house. So someone has $40 million in cash right now. What are they going to do with that money? Well, they're probably going to put it into stocks or something. If this person has a house worth $40 million and they sell it to the Curve founder, I doubt they're a crypto person. Highly doubt it. They're probably a real estate person. So that money doesn't come back into crypto. It's fucking gone forever, right? That's a problem with our current system. If we fix this, then that's good. This is what I said, the invisible millionaires. You don't see the Curve founder flexing on you on the timeline. Here's my 10-step guide to making $40 million so you can buy 2 mansions that you definitely do not need for your family, and you pay for it off of the back of the investors in your protocol for one of the worst performing tokens during the last bull market. You're not going to see the Curve founder post that. Look how fucking trash this coin is. It's like one of the worst performing coins ever. Why? Well, number one, it's too boring for people to care about. Number two, the marketing team sucks. Number three, this dude dumping all his money. That's a problem. And the last lesson here is there's a hierarchy in crypto, and the house wins first, then the rest of the market. The house always wins, they win first, and the rest of the market wins. This is what the hierarchy looks like. So this example is for a new coin. When a new coin is launched, the founder makes money first because the founder does a token sale or he raises money from VCs. They get money from a VC, the VC gets tokens. The tokens aren't necessarily worth anything. But if the tokens do become worth something, the next person to profit is the VC and the insiders. After the VCs profit, smart retail profit, they get in early. The dumb retail don't profit because the dumb retail don't have anyone to shit on. They're at the bottom of the hierarchy. They've ran out of people to profit off of. The founders never get shat on. They launch a coin, they don't necessarily lose anything. What is the cost of launching a coin? Very minimal. Make a website, $10, $100. Make a coin, what's that, $100? What else do you need? Free Twitter account, free Telegram. Maybe once you start scaling the coin, you need money, but it's so cheap to launch a coin. They never lose. VCs get shat on, but they can shit on other people. Smart retail gets shat on, but they can shit on other people. Dumb retail, they're at the bottom. And if you're watching this course, you probably find yourself in this category. Some of you are probably here or here, but most of you are probably in dumb retail. So I'm in this level. This is me. I'm not a founder of any coin, but I do VC and I am smart retail. Sometimes dumb, but mostly smart. Yeah, most of you guys are just at this level. So you got to try to climb this hierarchy. The top of the hierarchy is the house. If you can become the house, then you're the winner. You're the best position possible. But if you can get here, then you're fine as well. And look, for an example of me trying to get myself into being the house, we just put $600,000 into at pre-seed. I don't know if you guys know, it's one of the most promising pre-sales in my opinion at the moment. And yeah, we managed to get over $500,000 US in allocation. There was only 6 investors who managed to get this round on. And the fact that we got this is insane. I don't think any of you guys can register how insane this is, but this is an example of climbing the shitting hierarchy to place yourself as close as to being the house as possible, to maximize your probability of making money and to maximize the size of your returns. Like when the token launches, I highly doubt it's at our price, entry price. So no one will be able to buy as cheap as us. That gives us the highest size of return and highest probability of making money. The key with VC related bets is you want to make a number of bets and you only need a few to win to cover the cost of any losses. So you might look at this list and go, oh, this one died, but then you'll look at or I don't know, any of these, and you might go, oh, this one went 20x. Okay, well, that makes up for the losses and there's a lot of extra profit there too. The moral of the story here is you want to climb the shitting hierarchy to get to the house or as high as possible. And this is an example of how I've done it. One way I've done it is I've become the VC. This is as high as I'm going to go. I'm not going to launch a coin. I'm as close to being the house as I can possibly want to get to. And this is putting me in the best possible position for this bull run. And as I said, this is my mastermind group. This is a course, but if you want to join my private community where we get access to all these deals and stuff, you can find information somewhere in here. But I recommend if you want these sort of deals that you should be looking into the group. Moral of the story, you want to become the house if you can. The house always wins, and climb the shitting hierarchy. Thank you guys for watching. I'll see you in the next lesson. So we've gone over a lot of topics, lessons, principles in this course so far. And I want this section to be another lesson, but I want it to be also like a bit of a summary of prior lessons learned, because I'm going to be going over a couple things that we've sort of already gone over in the course. Now, this is a really, really important concept to basically tie everything together, I would say, for the mindset section. And it comes back to this idea of, are you an amateur or are you a professional? And this extends to all areas of life. It is really important to understand this in relation to investing. So most people, they approach life very much like amateurs. They don't take any endeavor that they go into very seriously. They don't get results. They don't care that they don't get results. And they're just generally lazy and they don't really give a fuck. And if you're watching this video and you've been quote unquote an amateur in other areas of life, that is probably somewhat of a reflection of how you're going to approach crypto. And if you are an amateur in crypto, you will not make money. You can be an amateur with many other areas of life and it's not going to significantly affect you. You can be an amateur chef, but it's fine. If you are an amateur in crypto, you will lose all of your money. And there's only one outcome if you want to make money in crypto, and it's through becoming a professional and approaching crypto professionally. Because if you do not approach crypto as a professional, any of this money that you make, which the amateurs make, you'll end up losing, because it's not about making money. It's all about how you keep it after you've made it. Because every single person I've talked to, I've spoken to thousands of crypto investors, I know the patterns of what these people are doing. Everyone talks about how they made money, they got all this money and then they just never sold, or they just didn't have a strategy, they gambled it away, house money effect, all the different things that we talk about in this course they did wrong. And that's how I know that this is what these people are doing, because I've seen it firsthand hundreds of times. And these people all failed at the same core concept, which is they just didn't approach crypto as a professional. Everyone who I know in the crypto market who has approached it as an absolute professional always ends up getting results. They always end up making money. I know at least 100+ millionaires, as in people who've made $1 million from crypto, and all of them pretty much are much the same. They take this shit very seriously, and I actually know more than 100 who've made $1 million and lost it. And if I compare the ones who made $1 million and lost it and the ones who made $1 million and kept it, it's a very, very stark and clear difference. The ones who made it and lost it, they made it through luck. They sort of were amateurs. They got lucky, stumbled across something that made them money. They weren't really doing things properly. The ones who made $1 million and kept it, they had a proper process. They had strategies. They had algorithms that they've developed. They had a team. They did all these different things that a professional would do. And so I want to go over in this video how an amateur approaches crypto and how a professional approaches crypto. And I want you to think about yourself and how you've approached crypto prior, and whether you are doing crypto in an amateur way or in a professional way. So let's go over our list of things that amateurs do and professionals don't. So as we've already gone over, amateurs make money and they just never keep it. Professionals, they make money and they keep it because they know what they're doing. Amateurs don't have a system. Professionals have a fully fleshed out system. No process, proper process, no defined edge. The professional has a defined edge. So what I mean by that is a professional has a segment of crypto which they focus all their attention on, that they've become really good at. So good to the extent where they just print money in that sector consistently. And professionals will double down on what they're really good at, and they will take as much money from the market as they can. And amateurs will try to do many different things, and they will never truly become very good at one thing. And thus they never get an edge, and they just don't make money. You only make money if you have an edge. Think about poker players, think about video games. If you're playing Call of Duty and you're just running around the battlefield shooting people, you're going to get killed. But if you are very strategic with how you play the game, so only moving in certain directions on the map, camping when you get to certain locations, changing to your close range gun when you're in close range areas, having a good set of headphones so that you can hear when your enemies are walking around. All of these different things that you do, which would be quote unquote done by a professional, that's what ends up making you kill the opponent and win the game. Same as crypto. No back testing or forward testing of strategy. So if you're watching this video, just think for a second to yourself. Have you ever back tested or forward tested the strategy that you're going to be implementing? Most of you are probably going, oh, I don't actually have a strategy that I'm going to be implementing. Oh, okay. Well, that's not good, is it? You're trying to make millions from crypto and you don't even have a strategy and you haven't even tested it, even if you did. Probably not a good start, is it? Probably not doing very well, are you? So you have to back test everything. I made an algo that I use for investing. I've gone over it already. I back tested it and I forward tested it for 2 years. Now, using emotions to make decisions. So this is a big one. Amateurs still make decisions based on their emotions. So they buy when they feel greed or they sell when they feel fear. The professionals do not listen to their emotions. They make logical decisions. Next one, amateurs don't don't have tuition for understanding what to do. They don't have this 30-second brain, which is a topic from the pattern recognition video if you want to watch that. Amateurs don't have this, whereas professionals do. Amateurs don't really take the market seriously. They view it as a casino where they can go and they can gamble and they can have fun and they can just lose a bunch of money. A lot of people, they come to crypto and they really just don't take it seriously. Because crypto is the riskiest market, they come here with the mindset that because there's a lot of risk, they don't need a strategy behind what they do, which is really weird to me. It's like, for some reason in everyone's brain, they think because something is really volatile that they don't need a strategy. Oh, it's shit coins. They're not worth anything. I just chuck money in. What has the volatility got to do with the fact that you don't need a strategy? It doesn't make any sense. You need a strategy more when you do shit coins because of how risky it is. The strategy is even more important in the assets which carry more risk and more return, because generally volatility is a reflection of opportunity. And if there is an asset with more opportunity reflected through volatility, the better of a strategy you have to capitalize on the opportunity, the more money that you're going to make. If you just buy stocks, you don't really need a strategy because there's not much money to be made. There's not much money to be lost. You can just basically do whatever you want. You're going to end up performing well over a long enough time horizon. Crypto, shit coins, you need a strategy. 90% of the coins are going to go to zero within a year. It's a much different game. No mentor to guide you. So all the rich people I know have mentors. People who are above them, who are giving them advice, they all have them. Every rich dude has a fucking mentor in something. Whether it's a gym coach or a business coach or someone that mentored them when they first began their business journey. Every millionaire had a mentor. If you don't have a mentor, I don't know what the fuck you're doing. No high-level community to share alpha in. So amateurs tend to try to do things alone. They go on Twitter, they go on YouTube, they try to use free information, they try not to pay for access to any groups. So they just remain in this perpetual position of just being shit at crypto and never having a network. And because they approach it like an amateur, they also are too lazy to get really good at crypto. So they end up just staying in this really bad zone where no one wants to help them for free because they suck at making money. They don't put enough effort to become good, and their ego's too big to spend money to join a group. The professional is in multiple high-level groups. The amateur buys when it feels right. The professional only buys when upside is asymmetric. Cut winners and they add to losers. So when a position's losing, they double down on it. When a coin goes up, they take their profit quickly. It's the wrong mentality. You got to do it opposite. As well as this, people who are more amateur, they always like to look at what's the highest return they can get on a coin, and they only end up allocating a very small amount of their portfolio to capture that return. So it's like, yeah, I'm hunting for the 100x's, but I'm going to put $500 into 50 coins and hopefully one of them goes up. It's like, whoa, even if a coin goes 100x, it only went up 100x with a tiny portion of your portfolio. So you could have just put everything into ETH, doubled your money, and you would have done better. So the professional optimizes for total portfolio returns. They don't care about what multiple they can get on one coin. They care about which position sizing and portfolio structure based on my risk and reward ratio and my ability to spot asymmetric opportunities is going to offer me the most optimal return for my total portfolio, not just the portion of my portfolio which is within one position. That's what it's about. Now, this is the comparison between amateurs and professionals, and I need you to understand that in crypto, you only really make money from two ways. You either become the pro or you follow the pro. So being the amateur is not an outcome that leads to money. Implementing what the amateur does is neither. So you either have to be the professional here or work with someone who is this professional who can basically tell you what to do. So here is what a standard portfolio return looks like. So in markets, if we were to look at it on a 20-year time frame, people lose and gain the same amount of money. They make money and then they lose it. And actually, to be honest, most people lose more money than they gain, because as well, you have to consider that there's fees, there's spreads. Every dollar in is actually not a dollar out because the platforms that you use accumulate your money through fees and stuff. And when you look at this standard portfolio return profile, you can see how there's no stop loss. It's just you lose money, you make money, you lose money, you make money, you lose money, you make money. It's just like fluctuating wherever. This is what an amateur's portfolio looks like. They make some money, they lose it. They make some money, they lose it over a 20-year time frame. They get a big bull run. This is the crypto bull run of 2020. They make all this money, but then because the bull run ends and we go into a massive bear market, they never take profit. They're an amateur, they lose it all. And they have a big loss now instead of a big win. And the only way that you can break this cycle of returns to the up and downside being mostly the same, except for obviously the downside being a little bit more because of the fees and stuff. The way that you make this return profile in your favor is by doing two things. You have to firstly minimize the downside, so cut your positions earlier when they lose, and you have to maximize the upside. So you have to only chase opportunities like this one, which are giving you asymmetric upside, and maybe ignoring these ones that aren't really making you money. That's the two things. It's find asymmetric opportunities and minimize your downside exposure. So the difference between an amateur and a professional essentially is their ability to manage their bottom line. To a large degree, it's just how well can you mitigate against bigger higher than wanted losses. Because you can see, you make some, you lose some, you make some, you lose some. Unless you can lose less or make more, right, make this go higher, then you're just going to end up not making money. And this tweet is a little bit of a summary if I just sort of rambled there. Any money that's made without risk consideration will be given back in time. So you can see, because this guy has no risk management, no process, no defined edge, is just making you losing money, no back testing, no mentor, no nothing. Yeah, he might make money in the bull run, but the ultimate end location for his net worth is down. Without a portfolio, process, thesis, and consideration of downside up front, you're essentially borrowing money from the smart and giving it back to them when they need it. And this is what I refer to with, he makes money in the bull run and he loses it. He didn't make money, he just borrowed it from other people and then gave it back to them. And this is another really important quote to be able to distinguish between if you're an amateur and a professional. You need to ask yourself, if I was to do what I just did 100 times, where would I be? Would I be making money? Would I be losing money? So let's apply this in real time. So if you don't take the market seriously, what's the outcome of doing that 100 times, not caring about the market the next 100 times you buy and sell? Is that going to be a huge return outcome, or are you probably going to lose money? What's the net outcome of using emotions to make decisions? Well, you're going to buy too high and sell too low, and you're going to end up losing tons of money. So the net outcome is over 100 times is losing money. This is how you would apply it. I just want to do a high level overview here again. If you're going to do crypto, you have to either follow the pro or become the pro. You have no other choices. So if you want to become the pro, you can't do anything that the amateur version of yourself is going to do. You can't do any of this. You have to ignore it. You have to approach this shit like a professional. Now, if you want to instead follow a pro, again, I'm going to mention my mastermind. I give you everything that you need, the strategies, the one-on-one guidance, making a plan with me, ongoing education, ongoing oversights into the market, access to a network of high-level crypto guys, access to one of my favorite traders who also teaches in the mastermind. You're going to be able to follow the pro very, very closely, and it will mitigate the entire process of trying to become the professional yourself, which most people don't want to do. Today, we're covering, in this video, it's not about the coin, it's about the process. This is one of the biggest things that every newbie in crypto gets wrong. The most common question I see when a newbie talks to me, or just newbies in general, is they all say like, hey Daniel, what coin should I buy? What's the next 100x coin? Like, you go on YouTube, and what's like the most common video that people are looking for? They're like, top 100x coins, top 25 altcoins with 10 to 100x potential by 2026, big cap millionaire tier list. Oh my god, they name these videos like a fucking porn video. Big booty Latina with white nerd. They fucking make it all porn hubby. It's so cringe. They're appealing to the retards who don't know any better. Now, I'm not gonna act like I'm on a moral high ground and I've never made a video to appeal to retards, because I have made videos saying top 100x coins, but it's purely just for engagement. I don't actually believe in it, but these people do. These people really think that, wow, it's all about the coin, and they'll do all this fancy editing like you see right now, but it's not about the coin. It's about the process, because every single person has been burnt on a coin before. Think of every single coin in the market, the best possible coins from the last bull run, the coins from this bull run. Think about BNB. Think about all these coins. Every single coin, even the best ones like BNB, the most amazing companies, have burnt people and lost them money. Why is this? Well, markets are zero sum, so for every person who makes money, someone lost money. You only make money by being better than people. We've already covered this. So by you thinking that the coin is what matters, you're not thinking about the entry, the exit, justification for the entry and the exit, the emotional management, the risk management, the position sizing, and everything that is around the position or the coin. If you just go on Twitter and you look for a coin to buy and you just buy a coin, you're not going to make money, because by the time you're seeing a coin and everyone's talking about it on Twitter, it's a consensus bet, and consensus bets do not perform well. And as well as this, if you buy a coin, maybe it does make you money. Maybe it was a consensus bet on Twitter. Maybe it makes you money. But if you do not have a process, you do not know when to sell, you're probably going to make emotional decisions because you don't have a process to hold you accountable. You're going to sell it at the wrong time, probably at the bottom, or you're just going to never sell it and you're going to hodl it back down 95%. And that's what everyone does. They buy these best coins that were really hot in the moment. The bear market comes, these coins are not so good anymore because it's a fucking bear market, and they've lost money. If they would have just had a process to know where to sell, they could have bought any fucking coin. They could have bought Ripple, the most stupid coin in the market, and they would have made money. So it's not about the coin. It's about the process. Now, here's a little summary of what I just said. Even the best performing coins go down 90% eventually. If you don't have a process, you will buy the top and experience this drawdown. And I'm pretty sure all of you who've done crypto watching this have experienced this. The outcome for those without a process is always the same. It's losing all their money, because it doesn't matter what coin they buy. They all have the same outcome. Every coin has the same outcome, because at the end of the day, the coin they buy is irrelevant to making money. Every beginner investor asks the same question. It's the equivalent of a nerd asking,
what line do I say to get the girl?
It's like, bro, you're a nerd. No girl's getting with you. I could give you the best line in the world, and maybe she likes you for a second, but she's not going to fuck you. Why is this? Because it's not about the line. It's about the tonality, the timing. It's about the six-pack. It's about the eye contact. It's about, are you a dude that can fuck? It's about, who are you as a person? It's about confidence, charisma, personality. It's everything around the lines that is important. And when you have everything around the lines, it doesn't matter what line you say, it all works. I could say any line to a girl that likes me and she will just love it, because it doesn't matter. The line is irrelevant. And it's the same thing with investing. It's not about the coin. It's about everything around the coin. So what is it that is around the coin? It's the strategy, the emotional control, the forward testing of a system, and the edge that you've crafted in the market. It's about your entry. It's about your exit. It's about the sizing of your positions. It's about the time horizon for your investment. It's everything around the coin that is important. All these videos telling you the top coins, all the Twitter posts telling you the top coins, they never tell you the top strategy, the top emotional control. They never tell you the top entry, the top forward tested system. No, they're all about the fucking coin, because they don't know what they're doing. So what is my system? Well, my system is this right here. I use the Hunter algorithm investment system that I've designed to buy low and sell high 95% of cryptos in the market, because I understand that it's not about the coin, it's about the process. Now, obviously the coin is an important variable. I made like a 10x return on Toshi right now, and the reason I'm up 10x and other people have bought other coins and they're up 2x is because of the coin. But I guarantee you, someone without a process is buying Toshi now instead of a month ago, and maybe I take profits now, and because I'm taking profits now and they're buying now, they're buying it up here, whereas I bought it down here. The reason Toshi went up 10x is because I have a process to identify when to buy coins. It's not the coin itself, it was the process to find this coin at the right time and then know when to buy it and sell it based off of my system. And this is my system to help me determine when to buy and sell. Now, I didn't use this for Toshi, but I use this for pretty much every other coin. A great investor can make money on any coin because of a good process. I guarantee you, give me any coin, I spend enough time looking into this thing, I can buy it at a good time and sell it at a good time. Purely based off of the sentiment of the holder base in the Discord and Telegram communities of the project, based off of the sentiment on social media, based off of the developments of the project, based off of the overall macro market, what Bitcoin's doing. I can get you a good entry, I can get you a good exit. Doesn't matter what the coin is, I'll make it work. A bad investor will lose money on every single coin because it is no process behind what they're doing. This is why when you ask someone how they lost all their money, they tell you about how any different coin in the market lost some 90%. It doesn't matter what the coin is, the story is the same. Oh, I bought it and I just thought the market was going higher and it didn't go higher, and then it went down and I didn't want to sell a loss, so I waited for it to go to break even, but it never went to break even, and so I'm just holding this coin down 90% now, and I'm sort of hoping that in the next bull run this thing goes up and it makes me back the money that I lost, and then I can take it out and sell that position and forget it ever existed. That is the answer of someone who has no idea what they're doing, and that is what every single coin creates for people who believe that it is about the coin that makes them money. So why can't you profit without a process? Because without a process, as I mentioned with the things above, you are susceptible to making emotional decisions, buying when a coin has become a consensus bet, so when everyone's talking about it at the top, selling the bottom when it dies, and never taking profit because everyone said we're going to the moon. That is what a lack of process does for you. Without a process, you've got no defined edge, no advantage in the market, which means you will not keep any of the profit. Because think about it, crypto without an edge is like a slot machine. Every dollar that you put into the slot machine is 90 cents out. So you put in $1, pull out 90 cents, put in 90 cents, pull out 82 cents. You slowly get to zero because it's statistically rigged against you. And it's the same thing with crypto. You pay fees in crypto every time you buy and sell. Every dollar you put in is a little bit less out. Also, without an edge, you are statistically rigged to lose money because your competitors are better than you. So it's physically impossible to beat the slot machine, and it's physically impossible to beat crypto without a process. Maybe there's the odd guy who goes in the casino, in the slot machine, puts in 10 grand, pulls out the jackpot and leaves and never comes back, and he gets super lucky and he made money. But do you want your financial future to be completely bettered on a very lucky scenario occurring which had nothing to do with any skill, any process, any dedication, education, any intelligence? Or do you just want your whole life to be a fucking gamble? Obviously you don't, because you're watching this course. So the only way that you can make money in crypto is to statistically rig the odds into your favor so that every dollar that you put in is $1.50 out. So that it doesn't matter what coin you buy, because your process is going to get you a good entry, it's going to get you a good exit, it's going to not have you experience an entire bear market, it's not going to have you making emotional decisions, it's not going to have you buying coins that are consensus bets, okay? That is the answer to what coin should I buy? Stop being an idiot. Ask about what process you should follow. That's a much better question. Now, this is Kun. He is very good. I always talk about this guy in his course. He's a fucking genius. He said again, every time an account shills something, there's two outcomes. You either made money or you lost money, and you said, don't listen to influencers. On a long enough time horizon, the ultimate conclusion is number two, don't listen to influencers. That's the ultimate conclusion. There's no outcome where you just keep copying influencers and just keep making money. Eventually, you're just going to lose it all, and then you're going to go, this guy sucks. You shouldn't follow influencers. Blah, blah, blah. On a long enough time horizon, you'll always pick that one, because that's when you realize it's not about the coin. And then you realize that you need a strategy, you need a process, you need to have risk management, you need to have emotional management, and all of these things. Now, if you're watching this video and you don't have a process and you were hoping that I told you to buy all these coins, I'm sorry, but that's not going to happen. If you want a process, then I give the process inside of my mastermind. I've mentioned the mastermind a bunch of times. I'm sure you can probably find the website link somewhere in this course. That is where you go if you are looking to be handed the exact strategy, the exact process for how to actually implement the lessons from this course. Because this course gives you the education. If you want the implementation of the lessons, you got to be in the mastermind. So yeah, thank you guys for watching. That's everything for this video. Next section of the course, everyone pays their tuition. This is going to be a bit of a brutal, harsh truth for you guys. You're not going to like this video, but pretty much unavoidable, this lesson. And it's definitely a crucial mindset component to keep in mind. I guess the ultimate conclusion of this video is just patience and perseverance, and it's setting realistic goals for yourself and what you can make from the coming bull runs. Just for context, everyone pays their tuition. I'm referring to the amount of money that you have to lose in crypto before you can actually long-term make money. So the thing is, in bull runs, everyone makes money, but very few people are able to keep it. So when I say you have to pay your tuition, that doesn't mean you won't make money this bull run. That doesn't mean you're not going to lose money forever. What it means is that there is a minimum amount of losses, a minimum amount of pain, a minimum amount of mistakes that you must make over a minimum amount of time before you can keep all of the money that you're making. Everyone will make money, but very, very few will keep it. And the tuition that you pay is not just from the money that you put in, it's also going to be from the profit that you make. You'll make profit and you will lose the profit, and that is also the tuition that you will pay to the market. And it's just how the game goes in crypto. Now, if you were to do, let's say, a traditional stock investing, do you have to pay a tuition fee? No. I think if you do 401k, stock investments, just putting $100 in a week or something, you will never have to learn investing because they do it for you. If you buy gold and you just hold gold, there's no lessons you have to learn. You just bought gold. But if you are coming into crypto as an investor, there is absolutely a huge tuition that you have to pay. And that simply comes down to the volatility, the risk, and the amount of gains that people are trying to make. When you buy gold, you're not trying to get rich. You're okay if it doesn't go up and down. You didn't buy it to go up and down. But with crypto, the mindset of any money you put in crypto is this is to make me rich. And making wealth and getting rich and wealthy is an emotional topic, because maybe you've got a bad financial situation and you really want crypto to make you wealthy. And so crypto is a very difficult game because of how high of an expectation you have on how much this is going to improve your life. And so you really want to do it right. You don't want to make mistakes. So trying to make money in crypto is the equivalent of signing up for a 3 to 4 year university degree. Now, the difference with a crypto degree and a usual degree is this degree is permanently ongoing and there's no actual starting point. And you can actually start the course whenever you would like to. But in order for you to complete the course and to make money after the course, you have to do courses, I guess, that occur at each stage of this repeating 3 to 4 year university degree. So for example, if you come into crypto during euphoria at the top where most people come in, most people start the degree, you cannot say that you completed the degree and be a fully sufficient, independent, profitable investor until you have experienced optimism, belief, and thrill and completed the full cycle from the very top to the very bottom and then back up again. So you might get in at the euphoria top and then experience this bear market and then experience this part. But until you've had one entire experience here, you haven't finished the degree. And so you're going to probably end up fucking up selling the top. You're probably going to end up selling too early, right? Because you're going to see this is euphoria, but you're going to think that this is euphoria. You're going to sell way too early and then you might buy back in. So that is sort of just how markets work. You can start at any time the degree, and the degree has a sometimes cheap, a lot of the time very expensive tuition fee that you must pay. And the tuition fee is paid basically in the form of losses that you make trying to make money. So the tuition fee that most people pay is they buy here or here, or they buy here or here. Right, that's where most people pay their tuition. It's from buying it too high and then never taking profit. They end up losing a bunch of money. And if you want to view it from a market cycle perspective, top to top is a complete market cycle, right? So this top to this top, that's a full market cycle. So we had the top, the bottom, the accumulation, the uptrend, the end of the bull run, and we start a new cycle. So until you have experienced this to this, you're not a fully competent crypto investor because there's things that you haven't seen yet. There's a tuition that you haven't paid. When you do a degree, you can't say that you have the degree done until you've completed every part of the course. You can't just skip semester 2, assignment 5 because you didn't like it or because you forgot. No, you have to do every single course, get a mark, and then assuming you got good marks and you passed the test right, then finish your degree and then you can be making serious money. So that's just how it goes with crypto. Let's read over this. 80% of the mistakes investors make in markets can only be learned to avoid through first-hand experience. So a lot of people will be watching this and go, okay, well, I'm going through this course. This course will allow me to go from taking 3 years to taking 6 months to make money and keep it because I'm learning everything. Well, the problem is 80% of the lessons you have to learn to make money can't be learned from a course. They can't be learned from anyone. They have to be learned from first-hand experience. You can obviously reinforce the lesson running it by a mentor, which is really good, but you can't learn how to talk to a girl by reading a book on talking to girls. You can only learn through doing the thing, which is talking to the girl. You cannot avoid making mistakes in crypto by just reading, don't do this, don't do that, don't do that, do this. You have to make the mistake firsthand and then learn it. So the only way that you can not lose money is basically to first lose lots of money many times. And massive losses, which is your tuition fee, must be paid to the market. Now, you either pay them up front when it's cheap or you pay them later when they've accrued interest. So a lot of people, they will make a bunch of money in the bull run. They won't have paid their tuition fee and they will think to themselves, oh, wow, investing's easy. I made all this money. And then they get to the end of the bull run and because they haven't paid their tuition, they lose it all because they don't know how to sell at the end of the bull run. They haven't seen that part of the market cycle yet. They haven't seen how this part operates, so they would never know how to act in it. You either pay your tuition early in your investing career when you don't have much money usually. When you're younger, you tend to make less money. You make more as you get older. You're better off learning when you're younger. Also, when you're younger, you can take more risk because you're younger, right? You've got more life to make up for any mistakes that you make. When you're 55, you're too old to start from zero because you've just got not much time. You can't afford to make mistakes and you got more responsibilities. You got kids, wife, etc. When you're young, you do it when it's cheap. You learn everything up front, or you can decide to go, you know what, I'll make money this bull run and I'll just face the consequences later and of not paying my tuition now and I'll just fucking pay it later. But when you pay it later, you've accrued interest in the form of making money when you shouldn't have, and you end up paying that all back to the market. You don't keep any of it. So because losing money for a long time is inevitable in crypto, your best option is to minimize the amount of money you lose, and you want to maximize the speed at which you do lose. So the quicker you can make every mistake and the more you can learn from each mistake, the less money you can lose from every mistake, the better. But also, you have to keep in mind, if you're going to get your hands dirty, don't just get your hands dirty. You want to get your whole body dirty, right? You want to go all in. Speedrun all the mistakes you can make through experimentation, reflection, and research, learning, reading things online. You are good enough as an investor to go to the market and take the equivalent of 20 tuition fees in profit. So in markets, you can only lose, your tuition fee once, hopefully, but you can gain back your tuition fee unlimited times. Warren Buffett made billions and billions of dollars as an investor. He probably paid his tuition fee when he was very, very early in his investing career. He probably paid $50K. So what, he paid $50K and then he took $1 million tuition fees? So that's, it's a good return on investment. You fuck it up for one cycle, you learn what not to do, and then you've got unlimited amounts of tuitions you can take after that. Now, the typical tuition period for crypto is 2 to 4 years. Sometimes you can learn it earlier. Sometimes you can speed run the process. Yeah, usually it's a full market cycle, and the full market cycle takes about 3 to 4 years. So from here to here is about 3 to 4 years. Sometimes it can be longer, maybe 5, but it's generally 4 years for crypto. Some people, they make money in their first bull run, but if they didn't make and learn from enough mistakes, they end up making them later with a much bigger portfolio. We sort of covered that before. So you want to invest with enough money that it hurts to lose, good for remembering the lesson, but not so much that it would have a massive financial impact. As they say, don't invest more than you're willing to lose. This quote is like the most famous quote in crypto, and it became the most famous quote for a reason. It's just so true. So many people have lost all their money. You need to never put in more than you're willing to lose because it's so risky. But yeah, pretty much how I would explain it. Bob Lucas here giving us some supporting evidence. Noobs always get wrecked. That's the cost of tuition. When you're new to something, you just get wrecked, right? You're new to surfing, you get dumped. You're new to snowboarding, you just get face planted. You're new to skating, you just fall off and bang your knee. You're new to basketball, you get thrown to the ground, you slip over. You always get wrecked, and that is the cost of your tuition. So how do you not pay a tuition? If you want to avoid it, how do you do it? Well, you can avoid paying a tuition by focusing on index funds, gold, bonds, anything where, like I said at the start of this video, it's sort of like low risk and you don't have high expectations for, and it's sort of like hands off, right? You don't do anything. Index funds, you don't have any involvement, so obviously like in a 401k, you can't unlock it either. So you just end up eventually making money. And that relates to this point here. If you can't sell, eventually you'll make a profit, right? Over a long enough time horizon, the price will go up, you'll be in profit. So that's the lesson. Everyone pays their tuition. See you in the next video.
The next lesson is about capturing 6/8 of a trend. So this lesson is a overarching macro bull run lesson, and it's a really important one to conceptualize. To help you understand this concept, I need you to look at this imaginary coin. Now, this imaginary coin, I beautifully drew it, and it's a representation of a coin from the bear market to the bull market and to the new bear market. And what I want you to understand here is that capturing the green box return is 10 times more likely than capturing the red and green return, okay? But how much more money do you make from all that extra risk of doing something that's 10 times less likely? Not much, is it? You only get a little bit more at the red, and you only get a little bit more at the red, but it's 10 times harder to do. So what would you rather? Would you rather, over a 20-year time span of investing, capture all the high probability moves, which get you 80% of the profits? Or would you rather go for gold and have a 10 times less chance that you make money to try to capture a little bit more profit? See, it doesn't really make sense now, does it? So under this logic, you now understand that the goal is not to buy the bottom or sell the top, because it's a very low chance you can pull it off. The goal is to capture 6/8 of the trend. That's the goal. Okay, so how do we do that? Well, just so you understand, you're never going to reliably sell a top or buy the bottom. Sometimes you might get lucky. I got lucky. I talk about Toshi a lot. I bought the exact bottom, but also I forced the bottom, because when I say buy Toshi, you know how much fucking money people want to put into that shit? There's like 200k instantly into Toshi. So I sort of created the bottom. But anyway, a lot of times you do get lucky as well. There's been many other times where I've bought the bottom, not always happening, but sometimes it just happens. Sometimes you get lucky. But to try to consistently repeat it, which is what we're always trying to do, we're always trying to do things that we can repeat 100 times in a row and we end up in a profit. Buying the bottom and selling the top is just not one of those things. So the key to making gains, the big gains, consistently over a long time horizon, multiple bull and bear markets, is to capture 6/8 of the trend. Now, why is this? Because the key to success in investing over a long time horizon is to have a strategy which consistently puts the odds in your favor, right? Investing is very similar to a game of poker. You win in poker by having an edge which you play and statistically makes you money, because it's just statistically the odds are in your favor. You play enough of the game with this edge in your favor, you don't succumb to emotions, etc. Boom, you just have profit. You just mathematically will have profit. Same thing with investing. You design a strategy which over a long enough time horizon puts the odds in your favor that you will inevitably end up in a profit, okay? So trying to time the bottom instead of buying when upside is simply asymmetric is perfectionism, which massively decreases probability of success in markets. Really, I'm putting it in bold because that's an important sentence. Perfectionism will cost you a good entry trying to find a perfect one, and thus removing any profit that you were going to make anyway. Because when you try to perfectly buy a bottom, you miss it. And then you're chasing price, and then you probably don't even end up getting an entry. When you try to sell the top, you end up missing it. Price is now down 60%. You don't want to sell because you lost a lot of money. You're going to wait for it to go up a little bit. You never get it. Now it's down 90%. Congrats, you fucked yourself. Okay? Perfectionism will cost you a good entry or a good exit trying to find a perfect one. It is not worth trying to maximize the gains in a 5% probability scenario, especially when the upside is limited. It's better to maximize for pursuing high probability opportunities which still possess 80% of the upside. Another Kun tweet. I know you guys love this guy. You know, he was just referencing a quote here. One needs needs to be an optimist in times of maximum pessimism. But basically what he said is slightly different to what the tweet was originally about, but it was a useful tweet. Sounds easy in theory, but in reality, things can always go lower. So the way that Kun gets around it, and the way that every good investor should get around the problem of price going lower, is you need to think about downside volatility. How much downside volatility will entering now incur? If the downside volatility is less than 30%, but there's asymmetric upside, then it's in a buy zone. Because the goal is not to buy the bottom or sell the top. It's to buy when there is a lot of upside and there's not much downside. Because remember, we talk about statistically, mathematically putting the odds in your favor. Let's make up a fake statistical mathematical strategy here. 80% win rate, 5-to-1 risk to reward. So you risk 20% downside for 2x upside. 100 investments in a row. Well, it's sort of more a trading perspective, but it applies to investing in a row. What is the outcome? You win 80% of the time, and each time you win 5 times more than you lose. So let's say if you did it 100 times in a row, 80% of the time you win, each time you win, you 5x your money. 100 times 80% is 80 times 5. So in this example, you win 400, and how much do you lose? Well, 20% times 100 is 20, times 1 is 20. So for every $20 you lose, you make $400. Pretty good. I mean, this is not necessarily realistic, but in this exemplar, your win rate and your risk to reward ratio is designed in a way based on the strategy that it's profitable. Now, does this, just because you made this, does this mean it's real? Well, no, you have to test in back testing and forward testing the win rate. And you have to constantly optimize the strategy. But that's a general idea of the way that you can do math to understand what he's trying to say here, right? You win in investing by only making bets and buying when there's asymmetric upside, because you inevitably are going to lose money. So the only way to win is to win way more than you lose. And that's how you make money. So how do you buy bottoms then? What's the mindset for buying bottoms? Well, every time it was the bottom, personally speaking, I said to myself the same thing. And I realized this the other day. I say this, I go, yeah, like we're getting close to a bottom, but I wouldn't buy here. I think it's going lower. I think we got time to accumulate. Like we got time, it's early. I'm going to wait a bit. That's what I always say at the bottom. And it's annoying. This is like my weakness. And it's always the bottom when I said this. Now, why is that? Well, you have to think about it, right? My feeling about the market is the same feeling as everyone else. Now, my gut instinct is different, but my sort of feeling, my emotion is the same as everyone else. Now, if I think going lower, bottom isn't in, wait a bit to buy, patience, everyone else is thinking that, meaning everyone's sidelined, meaning that if price goes up and it's actually the bottom, they're going to have to chase it higher, which is how bull runs start. So because that's what happens, and you're always going to think price is going lower at the bottom, bottoms never feel like bottoms. It's impossible to. It's always going to feel like you're buying before a fucking cliff. You're about to fall off a cliff, but you walk off the cliff and then you end up hovering. That's sort of what happens. So the secret to avoid this problem is, as Kun says, it's to buy not the bottom, but when you think the downside is limited and the upside is asymmetric. The key is to invest when the upside is asymmetric, not when it's the bottom, as this mitigates the problem of not buying because it might go lower. So very good solution here. Now, how do you sell a top? Selling tops is similar but different. So my logic for selling a top is this. Selling tops is way harder than buying bottoms because when the market is at the end of its bull run, it's way more volatile than when it's at the bottom. And there's just a much larger range that price is trading in when you are in that process of selling. So especially for altcoins, right? If you look at any altcoin chart at the top, they're all parabolic. They're all going absolutely ballistic. The most volatile period in the market is just before the market tops. It's sort of what happens. Look, this is BNB. You want to sell the top on BNB? Well, look, in the span of a week, May 12th to May 19, price went from peak of $596 down to $339. So in the course of a week, the price range was about 50% to the downside. So if you sell even a week late, you lost half your money. So the volatility of tops is really, really volatile. So selling the top is harder because of this. And another reason why it's hard to sell tops is because in price discovery, it's very hard to determine like resistance levels. Like for example, on BNB, if you're trying to sell it right now, okay, well, here's resistance, like here. Price discovery, there's no fucking resistance. Like how do you know when to sell? It's just going up. So it makes things a lot harder. This whole concept of selling is especially harder for altcoins. BNB was a pretty big coin, but you can imagine something that's a lot smaller, even more volatile. Let's see if SHIB's a good example. Yeah, so look, imagine trying to time an exit on SHIB. It's like genuinely impossible. That's October 27 and November 5. What's the price difference? 50%. Like how are you supposed to sell a top here? It's very, very hard. So the logic is not to try to sell a top, but it's to sell in the final 1/8 of the bull market. So this is how I view it. Every single day when we get towards the later end of the bull market, I'm going to ask myself, do I think this is the final 1/8 of the bull run? And I feel like asking yourself when to sell a top is a really tough question, but asking yourself when the final 1/8 is very simple. I think we can all know when the final 1/8 of the bull run is, because I think think we all know, okay, it's getting late, but I think there's still, room to run. So the idea is that I ask myself this question, and when eventually the answer is going to be yes, I think we're in the final eighth because my Uber driver talked about Bitcoin, all the people in my gym are talking about Bitcoin. And the idea is that when this trigger goes off, I then began implementing my sell strategy, which I cover in the mastermind. And this allows me to get an exit, a decent exit near the top, and it allows me to not bag hold my position down when the bear market inevitably comes, especially for altcoins. And look, you need to be comfortable with the reality that you're just not going to sell a top. You're going to sell significantly below the top. It's just how markets work. And if you try to time the top, you're just going to lose even more money because selling a top has a 98% plus failure rate. So you have a 98% chance of not selling the top, and then you just open yourself up to massive downside because if you try to sell the top and you miss it, price goes down 50% in a week after the top, you're hoping that the market goes back up again. It never does. Look like SHIB, right? You try to get a perfect exit. Oh no, it's down here now. Well, where are you going to sell? I'm going to wait for it to go back up. Nope, it's all going down. But if you just knew this is the final eighth, this region, I'm just going to sell an exit. You would sell an exit, you wouldn't experience all this downside, okay? And you have to ask yourself this: is it worth trying to capture a last 50% extra profit, but risking a 90% downside, give or take? Here's some other tips as well. You should always assume your portfolio is 30% less than it is, because it's never about what your portfolio is worth right now. It's about what it's worth when you sell. And the truth is you're never going to sell the top, so your money is immediately 30% worth less than the peak value of what it is, right? So if you just start viewing your portfolio today as 30% less than what it is, you will be comfortable with the fact that you sold 30% below its peak because you knew that it was 30% less anyway. And it just helps you manage the emotions. Now, tip number 2, if you're in altcoin positions, especially the more volatile, smaller ones, you're never going to sell a top like with SHIB. So you should immediately assume that it's an even smaller position size. It's 50% smaller. If price can go minus 50% in a week or two, and your exit could be very easily a week or two off, it's a safe assumption that your portfolio in the altcoins at least is worth 50% less than what it is. Okay? Just like a safe assumption. So just to summarize everything I said, don't try to be a hero timing the bottoms and selling the tops. You have to be comfortable with the level of profit that you have when it is finally time to sell. And if you get too greedy trying to maximize your money when you know it's time to exit, you're going to lose all your money. So that's the end of the video. I'll see you in the next one. Cheers. Yeah, I want to talk about flows today. In the way that I use it to do my crypto analysis is probably the single most, if not like top 3 most important of the fundamental analysis tools that I use, right? The understanding of flows and applying it to a coin I find is really, really important. And the way I like to do crypto is I like to start first with analyzing where is the money going to flow. And once I know where the money is going to flow, I like to look at what assets are the best positioned to capture this flow of money. Now, there's obviously other ways you can approach fundamental analysis. You could just do purely finding projects that have a world-class team and a world-class founder. And then once you found those, you find the ones, that fit all the other criteria. Or you can start with the flows, like I said before, and then you just identify the best coins that pick up that flow. So for example, if you know all the money's going to flow to Coinbase and then it's going to go to Base, then you find the best coin positioned on Base for that flow because you're expecting a massive inflow of capital. What's the best project to capture that inflow? So there's a number of different ways that you can approach fundamental analysis from. I tend to like doing it from a flows first perspective. And the concept of flows is basically about where is the money moving into and where is the money moving out of. But particularly so to make money, it's about where is the money flowing into. Okay. So what is inflows? Well, inflows is like people moving money to one particular chain, one particular sector, or even a particular coin, or even just crypto as a whole, right? It's the movement of money into something. And then what would an outflow be? Well, an outflow would be something like the team selling tokens, emissions, maybe stablecoins leaving, like the stablecoin market cap's falling, or, maybe any of these things that are where money is actually flowing out of something. So let's say a certain sector is underperforming, inflation, so the VCs unlock their tokens and then they sell them into fiat currency. These are all examples of more like an outflow of capital. And so you have to basically find which coins will have the most inflows and the least amount of outflows in order for you to make lots of money, right? Because you buy low, sell high. You buy when there's not much inflows, you sell when there's tons of inflows. And look, sentiment, narratives, on-chain data, the team, the community, all this shit is just telling you where the money's going to flow. Okay, at the end of the day, you can look at all these things like the sentiment, but all of that is just telling you where the money is going to flow. And if you want to know what to buy, the ultimate question that you need to ask yourself is, where's the money going? If you know where the money is going to flow, you will make money. So look, all these tools, right? This is all the different shit you can use technically or fundamentally to pick an asset. All of it is just dictating the flows. And I think Alex Kruger has a good post here on more so related to the stock market to explain this concept. So you can see here that the blue is the stock market price and the orange or yellow, whatever color you would call that, is the liquidity. And you can see that the liquidity has been going down and price has been going up. And you can see that liquidity and price are not one-to-one correlated. A lot of people tell you that you need liquidity. Price is dictated by liquidity. To an extent, liquidity is important because liquidity will tell you how much money there is sloshing around. If they're pulling back the liquidity of, like how much money there is, then that's tightening. They're trying to slow the economy. You could argue that that is, it's bad for price. But you need to understand that the market is about flows. Where is the money flowing, or where is the money going to flow? And what you're going to find is that even though the liquidity is falling, price can be going up because markets are forward looking, right? So let's say right now the liquidity is dropping and the price is going up. That might be because people are expecting the liquidity drain to stop soon, right? Because people front run bad news events ending. If the bad news ends next week, people will buy today in anticipation of the bad news ending. You determine what the market is doing based off of the flows. Where is the money going? That is ultimately going to tell you what price is doing, or where is the money going to go, okay? So it all comes back to flows. Flows is like the fundamental core underpinning of how you sort of dictate how to make money from things, okay? You buy something, you make money because more money came in than came out. More demand than supply, okay? And I guess another way to look at flows is like inflow and outflow. It's demand and supply, right? What is demand? It's people wanting to buy something. What are inflows? It's people wanting to put money into something. It's the same way to explain the same word, okay? Now, markets at their core, as I just said, it's a meeting point, right? It's just people meeting who have something, on one side and something on the other side, and they want to swap it to each other, okay? And depending on the demand and the supply will dictate the price, okay? Inflows is buyers, outflows is sellers. So let's talk about the importance of flows, especially so in crypto. If you know where the money will flow, you will inevitably profit. The reason I like using flows in analysis is because, even if, let's say you pick a bad coin in a sector that gets a lot of inflow of capital, you will still make a lot of money. If you focus solely on knowing where the money is going to flow and you buy assets that will pick up this flow of capital, it doesn't matter if the coin has, holes in it, if the ship has holes in it, if the coin has a bad founder or it has a shit community. It doesn't matter. These things will always go up. And just because the team is good doesn't mean you make money. There's a ton of good team projects like ICP, Internet Protocol. You buy something like Matic. If you bought Matic because the team was great a year ago, has lost you money because what you didn't understand was the importance of flows. What was the flows telling you 1 year ago? Or maybe not a year ago, like 2 years ago, right? You could have argued that the flows were showing that Matic was not a coin you'd want to own. And so just because you understand a coin as a good team doesn't mean you can make money from it. Let me show you a real life example of what I mean. Okay, so Matic has been performing pretty terribly. It's up 2x from the bottom, which has massively underperformed the entire market. But not only that, Matic's down quite a bit from its all-time high of about $3. If you bought Matic up here because the tech's great, the team's great, that's what your argument was, you've now lost a bunch of money. If you would have first looked at it from the perspective of flows, where is the money flowing, you could have understood that back in 2022, you could see the Federal Reserve and governments around the world are doing quantitative tightening, all these other related fundamental catalysts in relation to understanding flows. You could have argued that it probably isn't the time to buy Matic. If you buy an asset in the right sector, you will make money. And this is also related to business. If you build a business in a booming sector, your business can have a lot of things wrong with it. For example, you might not have the best landing page, you might not have the best content strategy, but if it's a booming sector, every business makes money. Now, you don't want to just be the guy that wins because you're in a great sector. You want to be the guy that wins regardless of what happens. But still, if you pick the sector where the most money is going to flow, you can sort of fuck up the coin selection and do really well still. This is why flows are so important for me. So whenever I want to consider which coin I want to buy, these are questions that I ask myself, okay? I always like to know who my exit liquidity is. With Toshi, for example, I always reference this example in this course, I know, but it's just the most recent example. Toshi, what is my exit liquidity? Well, I know that at the end of the bull run, people like meme coins the best. New investors love meme coins. So why don't I buy today what coin people are going to love in a year from now, 2 years from now, whenever it is? Also, my exit liquidity is going to enter at the end of the bull run through Coinbase and they're probably going to get sent from Coinbase to Base because Coinbase is going to set up some sort of incentive programs likely in order to encourage them to go to Base. Okay, and what does everyone want to buy on Base if that's where the money is? Okay, well, they're probably going to want to buy the meme coin. Like I just said, that's what they buy at the end of the bull run. So just purely based off an understanding of who my exit liquidity is, I'm able to buy the asset which is going to best appeal to the people I'm going to sell to before it's even happened, right? Who am I selling to? This is a really, really important question, because when you're deciding to buy something, you're buying it because you think someone's going to buy it from you at a higher price later on. So you have to ask yourself, what type of person is going to be buying from you at a price higher than the price that you bought at? Why would someone buy something from you that's more expensive than what you bought it for? Right? That's a weird concept. You think it's easier to make money, but you have to understand that you make money from someone buying something higher than you bought it at. You want to make it 20x on your money? Well, you need someone to look at a coin that's gone up 20x and go, this is a great coin to buy. There's not many people in the market who are going to look at something up 20x in fucking 6 months and go, yep, that's a great idea. I need to buy this, right? A lot of dumb people at the end of the bull run are going to do that. And so that's when you identify in your brain, okay, if I expect this coin to go up 100x, I need someone who's going to want to buy this coin up 100x. And those people are the dumb people at the end of the bull run. So that's when I start seeing dumb people get in at the end of the bull run, that's when you need to sell, because your exit liquidity is currently in the market. Your exit liquidity has came. The people you want to sell to are here. And that makes it easy as well to identify exits, because the hardest part of crypto is selling. If you know your exit liquidity, if you know the flow of money you need to see in order for you to want to sell, you can more easily time an exit. Oh, when's the top? When's the top? Well, you know that you need a certain person to sell to. So it's not about when is the top. It's about when is the person that I want to sell to here. And once you've sold to them, maybe they take the price higher than your exit, but that's okay, because you just wanted to hold it until the dumb people that you wanted to sell to came. And then once they've got it, they can do whatever the fuck they want with it. But you're out. And that's totally fine. And that's how I would approach it. You also need to ask yourself, what's going to cause money to flow into my coin or sector? So whenever you analyze a coin, genuinely ask yourself, why is the money going to flow here? Why here and not somewhere else? Why this particular coin and not another coin? And so, for example, let's say you're investing in AI coins. You would say, well, AI is huge in the stock market and it's hard for people to invest into AI related companies in the startup phase. So crypto is the best way for retail to speculate on this AI trend as it becomes more and more popular, because you can't buy anything AI unless it's Nvidia at $1 trillion market cap or whatever, right? That's the argument. Flow of money will come in because it's the only way that retail can speculate on AI. For meme coins, I like Toshi because Coinbase is going to win this bull run because they've really positioned themselves well, and Binance and FTX are sort of dying off, and Coinbase is like the biggest player now. They're going to send all their users to Base. They're all going to buy Toshi, right? So that's what's causing the inflow. Let's think about Solana. What will cause money to flow to Solana? Well, Solana is the best chain in terms of fast, cheap, and easy to use. It's got the best user experience, and it's got the highest amount of developers, meaning it's got the best ecosystem related projects of any chain except for Ethereum. It's, like I said, very cheap, but it's also simple in terms of you don't need to bridge to a layer 2. So it has a lot less complexity than trying to use Ethereum's ecosystem. It also has really, really good marketing. I think it's a better marketed chain than most of these other competitors. You know, the normies are going to love Solana because it's the one that they find first, generally speaking, versus something like C or Aptos or whatever. They're going to find Solana first. And that's why, you know, that would be an argument for Solana. And you also have to ask what's going to have the least outflows. I think this is the least important question, but it's still important. So let's say you buy a coin that has like 300% a year inflation and it kicks off in a month. Well, that's a little bit concerning because you have a lot of outflows because you have a lot of money entering the system, which is, you know, potentially going to be sold. Maybe it's emissions from miners. Maybe it's VCs getting unlocked. You know, is this a big, heavy VC coin? You know, is there likely going to be a lot of outflows because the VCs just want to sell at any price when they get unlocked? That's the questions you need to ask yourself. So before picking any individual coins, I identify the sector. Remember I said sector, then coin. What are the sectors I'm most bullish on in terms of flows? Well, these are my 3 most bullish sectors. Meme coins on new and upcoming chains, new L1 protocols, so things like C, Monad, and any high beta asset capturing flows from Coinbase. Okay, these are my 3 favorite sectors going into this bull run. Now, this is filmed in January 2024. In 6 months, my answer might be different, and it probably will be. I made a video on YouTube about a year ago saying that one of the big sectors for this bull run is NFT exchange tokens. The thesis took 3 months and it fully played out, and then the thing just died off. I made 6 figures from the Blur airdrop, but then that was the only way to really capitalize on that trend. Everything else was shit or died off. And so if someone watches that video now, they're like, oh, is this still a thing? And I'm like, no, bro, that trend died ages ago. So look, this whole fucking trend here could die off, but you know, meme coins and UL1s, that's been a trend that's been making money for 7 years, 6-7 years. After ETH came out, right, all the competitors have been pumping. And I think, you know, the Coinbase thing, maybe that's a bit more short term. Now, why do I like these sectors? Well, like I said, Ethereum came out and then there's all these cheap competitors that have been coming out every single cycle. In 2017, it was Ripple, Cardano, Tron. In 2020, it was AVAX, DOT, Atom, you know, all this sort of shit. And now it's Sui, Aptos, Monad. right? There's just always new layer ones every cycle. It's a reoccurring trend. And I think Coinbase wins the bull run, so they're going to have all the users. They're going to send them to base. Okay. Now, there's a couple tweets here. One thing I like to do before I enter a trade is ask myself, who's my exit liquidity? If I can't identify a group of people to be my exit liquidity, it's probably me. Keep in mind that when you repeat, we are going to sell our on-chain gems so much higher. To whom? Who are you selling to? Oh, you don't know? Well, you're probably someone else's exit liquidity, you dummy. You got to understand who you're going to sell to. When you enter a coin, if you don't know who you're going to sell to, why did you buy it? Why do you think it can go up if you don't know who would possibly buy it? Whenever you buy something, you should know super clearly, oh, okay, this is the very clear customer avatar who I'm going to be selling this coin to. Also, Degen Spartan, one of the best investors on Twitter, he said the main utility of Lido, LDO, is selling it to other people at a higher price. That is the ultimate conclusion that you will come to as an investor in crypto. The purpose of these coins is nothing besides selling it to someone else at a higher price. That's the only goal. And so when you ask yourself, who is my exit liquidity? Who am I selling to? You are getting to the crux of how crypto works. In the same way that Degen Spartan, who's made tens of millions of dollars from crypto, approaches crypto and is one of the best investors on Twitter. The main utility of coins is to sell them to someone else at a higher price. If you know who you're trying to sell to, you will know when they are buying and you will know when to sell to them. This is an interesting way to look at narratives and flows. You can tell a strong narrative from a weak narrative by how much capital that narrative can induce. So, for example, ZK Sync or anything ZK related, it's, cool technology. There's not really much capital flows for ZK related projects. But for example, meme coins and AI and layer ones are where most of the money is. They attract a lot of money and it's what retail loves. And so they have long-term consistent inflows coming in. So, ZK Sync might have been a trend that crypto Twitter hopped on for a week or two, but the trend for AI, the trend for meme coins, the trend for layer twos, layer ones, more so layer ones, is months to months. And yeah, again, here's an exemplar of one of the theses. Coinbase wins the bull run, sends the users to base, they buy the native meme token. Okay. Now, if you're watching this and it didn't play out or my thesis changed, opinions change over time. So maybe a better competitor comes up to Toshi, maybe Coinbase doesn't win the bull run, but this is just my thesis and thinking at the time of recording this video. But this as a concept, as of now, is how you would do flows analysis. And as well, you need to understand that there's different types of flows. Okay. So in crypto, your ideal exit liquidity is new investors. The exit liquidity that you don't want to have to rely on is people who have been around since the last bear market and are still in the market. So in a bear market, there's no new people coming in. So the market becomes what you call player versus player. It's the same group of people in a little room together like this trying to take each other's money. But player versus enemy is when there's people outside of the box, right? Normies coming in during the bull run, right? They come in. And so when we're in the room and we've been in the room together for years, we all know each other. We're all trying to take each other's money. And there's a bunch of people who don't know how to take people's money, right? Like imagine in this room, you make money by taking other money from other people's pocket. You get pretty good at pocket pinching, right? And then imagine all these people have never stolen something from someone's wallet and they're all coming in to this place where we're all professionals at stealing wallets, right? These are the best group of people to steal money from because they've never, ever stolen money from someone before and they don't know how to protect themselves from having their money stolen. And so they join, you don't try to steal money from the other players. They're all very good at what they do. You got to take money from the new guys because it's super easy. And then eventually the new guys become good. And then this, box grows bigger. All of these people are now a part of the box, right? Let's extend the box. And then there's going to be a new subset of people. And then you want to take their money again. And this cycle just repeats on and on for every bull run. And this is why you say the class of 2017 are now professionals. The class of 2020 are now professionals. The class of 2023 are soon going to be professionals. Each cycle brings a new class in who are shit, who become good, and they take money from the new class, right? Because also you have to understand that the things that PvP and PvE people buy is different and the way that they buy is different. So people who've been in the bear market who are now professional pocket thieves, they buy certain types of coins in the bear market, and the bull market new guys buy certain coins. So let's say you're in the bear market and you're trying to buy a coin to sell it in the bull run. You can't buy the coin that's hot at the time of that bear market because in the bear market, the people you want to sell to aren't in the market and they are not, interested in what is popular right now, right? So in the bear market, what do people like? Well, they like things with revenue, things with users, real coins that have real usage and real adoption, all this sort of gay shit that sort of doesn't really actually mean anything. What do people in the bull run love? What do the new guys love? What do the enemies love? Well, they love new and shiny layer ones, meme coins, gaming coins. Bro, the amount of newbies that are asking me how to buy gaming coins, they fucking love gaming coins. AI coins, and they love Ponzi schemes. Okay, this is what the enemy loves. And so when you're in the bear market trying to figure out what to buy, you need to ask yourself, what do my enemies love? What does my exit liquidity love? And this is what they love. This is what they want to buy. Okay, most crypto people underperform as they think they're too good to buy the bullshit that normies buy. They don't fall for the tricks that dummies fall for, which ends up fucking them over as they miss those opportunities entirely. And this is an example, right? A lot of people won't buy Ponzi schemes, AI coins, gaming coins, meme coins, new and shiny layer ones, because I'm not going near that. It's a Ponzi and it's going to collapse soon, right? This is what people do when they mid IQ. What do the dumb people do? Well, they're not smart enough to understand that these coins are shit. They think they're good. And then what does the really smart guy do? Well, he knows that they're shit. He knows that the dumb person thinks they're great. And he knows that he needs to buy early what the dumb people are going to buy later, because he knows that it's much easier to take money from this person than it is to take money from this person, because this guy is easy to predict, is easy to understand. And he comes at a particular time in the market cycle, which is at the end of the market cycle, right? So whenever you're, analyzing what coin to buy, you need to understand, where is the flow of money going to come from? Who is the exit liquidity? Who are you selling to? And it's generally speaking, you're trying to sell to this guy at the end of the bull run, because it's his first cycle. He doesn't know what he's doing. And, it's just easy to take money from him, right? Player versus enemy. The low IQ guy is this group of people who aren't in the market yet because they don't know how the game works. And yeah, again, this is an example. People will continue to mid-curve meme coins, but in reality, they got the highest volume on most chains. They got most of the mind share. They got no utility, and they're a financial vehicle for social capital. Okay, you can't counter trade human nature. You can't just not buy things because you think you're on the moral high ground. I'm so great at investing. I'm so professional because I don't buy Ponzi schemes and meme coins. Well, crypto is all a fucking scam, and the difference between meme coin and non-meme coin is a tiny smidgen of fundamentals. If you remove that tiny smidgen of fundamentals, it was only 2% that you took away. It's still 98% a scam. Okay, and a lot of people on YouTube are like, oh, I knew crypto was a Ponzi. Can't believe you guys are participating in a Ponzi, blah, blah, blah. Yes, all of crypto is a big fat Ponzi scam. And there's very few coins which are actually legitimate, which actually make sense to buy. Like Bitcoin is a completely legitimate, fair, normal investment asset class, right? That you could argue is a good investment. It makes sense. I understand it. But most of crypto is purely just speculation on shit that probably won't have value long term, or it's just some shit scam project that has some cool devs that they're going to rug pull on, or it's just never going to work, or, like most of this shit is not going to survive. Okay. It's not going to work. And most of it is just a straight up scam. Like all these meme coins, they have value and maybe they continue to have some value long term, but it just doesn't really make sense. It's literally just a fucking photo of a dog with the ability to trade, owning that. You don't even own the meme. You just participate in a way to speculate on the meme. So I'm not saying this in a way to say avoid it, but like, that's just what crypto is. Are you here to make money or be right? Are you here to make money or buy the thing that, it's got great fundamentals, but it doesn't fucking make money? Now, let me give you a visual of what I was just explaining before. So in the red box, people tend to like more the coins that have better fundamentals, revenue, users. They tend to like the safer assets. So for example, I think you'd see Binance coin was the best performer here. And then we go into the bull run where things go ballistic. And this is where meme coins blow up. So you got things like SHIB, Doge, that's what was going ballistic here. All the new layer ones, so Solana, that's where this shit was popping off. And then you come back into here, coins like GMX, like a decentralized perpetual exchange, or Rollbit, a casino coin. Anything that had real users and revenue was what was popular. And then you have, again, we're going into a bull run, meme coins started popping off again. Pepe started the trend. And then Toshi and Bonk, we're starting to get back into that green box now where the dumb shit starts to pump again. As well, the reason why the considerations of flows and who they come from is super important, because it reframes your brain to think of what the future people will want to buy, not what people want to buy right now. And you can see here that why would you want to buy new layer ones? Well, how many of the top 10 coins are layer ones? Bitcoin's a layer one. Ethereum, Binance coin, Solana, Ripple, Staked ETH, Cardano, AVAX, DOT. There's like 7 of the top 10 coins, layer one blockchains. So you can see how big the layer one trend is. Pretty much most of the fucking market cap. And then what's USDC? Well, it's a stable coin, so it doesn't really count. What's Tether? A stable coin, so it doesn't really count. And then Dogecoin. So the top is stable coins, layer ones, and memes. So that's just to give you an idea of where the money flows and cares about putting itself. It's all about layer ones and meme coins. Now, I think going in the future, it might change as we get games or apps with millions millions of users. For example, things like Steppen, were starting to pop up. Axie was starting to pop up in the last bull run, but that's more a trend that will take time to play out. Now, we've got a case study of using flows analysis. So one of the simplest case studies for analyzing flows is the Bitcoin ETF. So I've been talking about the ETF for ages, and the reason I've always talked about the ETF is because it's the best fundamental catalyst to activate new flows of capital. People are so bullish on it because the ETF opens Bitcoin up to millions of new investors. It's like if you've got a dam wall that is blocking water from coming down. Imagine you put a rocket into that dam wall and then all the water comes into the river. That's what an ETF does, or at least opens the crypto market open to receiving. And look, all these different people giving their opinion on the ETF are giving what you could call an example of flows analysis. There is already a Bitcoin ETF. Why would this change demand? Well, the same way Buffett holding a stock creates demand and a stamp of approval, BlackRock is an asset approver. Their stamp of approval being the largest investment firm in the world, it turns on this as a sophisticated asset badge. That's what it gives crypto. Crypto is a legitimate asset now. And not to mention that BlackRock is the largest asset manager. Large firms already get expressions of interest and can see the levels of demand. BlackRock and others flip their lobbying and marketing money to making Bitcoin a safe haven and media-wide coverage, cleaning up the image. So he's analyzing how BlackRock getting a ETF approved leads to a flow of capital coming in because the BlackRock firm will change the perception of Bitcoin. Okay. Here's another example. Basically, he's arguing here that getting clients when a new ETF launches is really important because once a client picks an ETF, they tend to stay with it forever. And also, when you buy Bitcoin in an ETF, in 5 years, you're probably still holding that Bitcoin through that same ETF. It might be worth 5-10 times more than what you bought it for. So let's say at the beginning of this ETF, $1 billion goes into Bitcoin. In 5 years, that might be worth $5-10 billion. And so the money that they get from fees and holding the assets, as the asset is going up in price, increases. And so getting the money in early is super important for those number of reasons. The fact that as the money goes up in value early, they actually make way more from holding the money in from fees. And when a user picks an ETF, they tend to stay with it. So you got to get the client, be the first one. And so that's an analysis of flows. Why is that important? Well, all these firms are going to be marketing heavy at the start because they need the users ASAP because they know how important it is. And so that means there's hundreds of millions maybe going into marketing, which is basically a big marketing campaign to buy Bitcoin. That's going to bring a new flow of capital in, which is going to make the price go higher. That's flows analysis. Every asset manager in the world is basically long Bitcoin. They don't have directional exposure, but a 10x in the price of Bitcoin is a 10x in yearly management fees. So the higher the price of Bitcoin, the more money that they make because the value of the asset is higher, the fees are higher. So, this guy is referring to what this guy's saying here. I think he said Kang. Yep, Kang. This basically involves massive ad spend, shilling Bitcoin at every public appearance, and advertising all their clients to get exposure to Bitcoin, right? This is flows analysis. Again, another post by Fred Krueger. So he had lunch with an old ex-Salomon, ex-UBS friend, and basically he hasn't got Bitcoin because he has to use a hardware wallet. And he doesn't want to own MSTR because he views it as a second-tier software company. And he almost will certainly buy the BlackRock ETF when it comes out. There's no sense in waiting 2 years if this is the beginning you wanted to buy Tesla in 2020, not today. There are a lot of people like him, and their advice is taken by a lot of other people who trust Gian Francois. TradFi is all word of mouth and relationships. So in the old school TradFi world, it's very much about word of mouth marketing, very much about communications. You meet people in real life for dinner, for coffee, at networking events. All the rich people tend to hang out together in person. In crypto, we tend to all message, and it's like a little Discord, Telegram group messaging universe. But in the TradFi world, it's all about relationships and dinners and golf clubs and all these in-person meetups. And that's where conversation builds around this stuff. So once these ETFs start coming out, people start investing in them, they start making money from them. They go to the golf club with their 5 friends who all have $1 billion company each. And one of them says, yeah, I made a bunch of money on Bitcoin. It's got an ETF now. Yeah, BlackRock has this ETF. And they're like, oh, wow. And so then all these billionaire guys ring up their financial advisors and say, hi, I'd like to put in, I want to get into the Bitcoin thing. I see it's got an ETF now. Can we do it? Yeah, well, you're with BlackRock, so you can easily buy it. How much would you like to put in? Let's start small. Let's put in 0.5% of my assets. Okay, easy, done. We'll do it today. Boom. That's the phone call done. And that's the analysis that he's doing here. And that's an example of flows, right? What did that example just show? It just showed that when this ETF gets approved, because of the word of mouth method of communication, and because of the fact that rich people hang out with other rich people, and because of how they need the ETF for them to want to buy Bitcoin, this is going to, when it comes out, lead to a new inflow of capital from these new wealthy investors. Okay. So at its core, crypto and generally markets in general, is a game of understanding flows. Where's the money going to go? How much? How do I get it the best exposure to that flow? How much flow is waiting for it to get easier to buy? Markets are simply supply and demand. More demand comes from inflows. If you know where the inflows are going in future, you can profit. When you know the flows, the coin becomes easy to pick. So, for example, to mention Toshi again, Toshi was an easy pick because I just asked myself, if Coinbase wins, which I think it does, it sends the money to Base because they've already said that from the employees that I've spoken to at Coinbase, from the internal documents that they have about what their plans are. It just makes sense. And then what do they buy when they're on Base? Well, obviously the meme coin performs best. Every single cycle, every single, chain, the meme coin pretty much always performs best. Maybe not 100% of the time, but 90% of the time. So, okay, well, just makes sense. Toshi's the face of Base, right? And that makes the coin selection easy. I didn't have to research 100 different fucking coins on Base. I just knew there's 2 meme coins, Toshi and Mochi. Toshi's better. That's all I had to do. That's literally the extent of that analysis. And so instead of looking at all these ecosystem projects in Base, which performed fucking terribly, I just went straight to the best performer because of a very good filtering process. When you know what sectors to focus on, you drop the potential coin selection by 90%. When you see the incoming outflows from token unlocks, you're able to better time entries and exits and identify the coins you must avoid with terrible tokenomics. And so that's another point as well. You have to be able to identify outflows. So you have to be able to look at token unlocks. If there's a big token unlock coming, maybe you need to look into taking profits before the VCs get unlocked and dump it on you. So that's another thing to consider as well. One thing I said here is how much flow is waiting for it to get easier to buy. So in the game of flows, something else you need to consider is how easy or hard was it to buy the coin? Because when you think about it, easier something is to buy, the less people who will probably buy it going forward. Because in crypto, when the coins get listed on Binance, that tends to be near the end of their rally. So look at Bonk, for example. Bonk got listed on Binance recently, and I think the rally ended after Bonk got listed. I think it went up temporarily. Yeah, it went up temporarily, but Binance was the exit liquidity. Now, why is that? Well, Binance is the exit liquidity because before it was on there, it was hard to buy. You had to bridge to Solana, you had to go to a DEX, and you had to buy Bonk. And Solana was considered the dead chain. So why would anyone be bridging to Solana? They thought it was dead. Oh no, now it's listed on Binance. Oh, well, it's easy to buy now. Boom, that's the exit liquidity. So you should have bought Bonk, for example, when it was hard to buy, when no one was talking about Solana. And for example, there was another coin called Space Mesh. Space Mesh was on this exchange called safe.trade. Very, very sketchy exchange. And that was the only exchange that it was on, and most people had never, ever heard of it before. And the only other way to buy it was OTC, because the only coins that were coming onto the market were from people who were mining the coin, right? The people who were securing the network. That was the only way that coins were coming onto the market. So you had to buy directly from miners on the exchange. And so because it was so hard to buy, the market cap was a reflection of the fact that there's tons of people who might buy who haven't yet because it's just too hard for them. And so when this coin would get listed later on, other exchanges, it opens the coin up to more investors. When it gets easier to buy, more people probably buy it. That leads to the price going up. So yeah, another consideration is there likely to be this coin getting more easily accessible in the future, right? Is there a barrier to entry? Because the bigger the barrier to entry, generally the earlier and the lower the price that you're getting in at, assuming that later on it gets easier to buy. So if you're looking to buy, for example, something at a $10 million market cap, it's probably a really good thing that it's hard to buy. Like you find a 10 million market cap coin, fuck, I got to bridge it across to this shit chain. I got to do this and that. That's a good thing. That means you're early. Okay. And then when it gets to a later point when it's super easy to buy, that's when you want to be looking more so to sell. And this is also like the Bitcoin ETF. Right now, crypto's hard to buy because Coinbase is a pain in the ass. I'm getting like a new guy in the crypto every week because of my brand. They're all giving me the same pain points. Fuck, I have to contact the support. What's the difference between a spot wallet and a funding wallet? Why do I need to spend 3 days verifying my KYC? Why don't they let me withdraw to a random wallet? I have to prove that it's my wallet that I withdraw to. There's so much bullshit. Whereas when the ETF comes out, that opens it up to new people. So you can see that even though Bitcoin is quote unquote easy to buy on Binance Coinbase, it's still not as easy as it could be. And the ETF is a very large step towards ease of access. And that's why it's bullish. Not only is more people going to buy it because more people know about it, but it's just more people can buy it because they couldn't before. Okay, so that's another consideration of tokenomics there. The harder it is to buy, the more likely the coin is mispriced as it becomes easier to buy over time. Let me bring it back to the key points, the key considerations of flows. So I would say, how hard/easy is it to buy? Is it going to get easier, harder in future? Who is your exit liquidity? Who are you selling to? Why will this group of people want to buy? What is going to drive the capital flow? Is the sector already popular, right? So all of these, questions is what you need to ask yourself when you are doing flows related fundamental analysis. And if it's hard to buy, gonna get easier to buy in future. You know who your exit liquidity is, you know who you're selling to, you know that they're not in the market yet, you know that they're gonna want to buy because they love these coins, you know there's a particular couple catalysts or reasonings for why the capital is going to go there, and the sector's not currently popular but it will be in the future. You can basically guarantee that you're going to make money. This course is all about making crypto so easy that if you get all of these boxes ticked off, then you can basically be guaranteed to make money. That's the goal, right? You tick off all these different questions, and what I'm going to have at the end of this course is a little like cheat sheet thing to fill out. How many points out of 10 did this fundamental characteristic get? All right, let's do flows analysis on this coin. What score out of 10 did we get? Did we get all the questions answered? When you can answer all these questions and say yes, 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 and it's a big yes for all the different sectors, basically guaranteed to make money. So that's flows. Hope that made sense.
All right, so let's talk about one of the other fundamental characteristics, which is outlier price action. Now, it's not so much a fundamental characteristic in the sense that it's about the project and it's about the team and the community and stuff that's much more fundamentals based that we've covered in the other sections. But I would consider price action a fundamental in the way that I use it to determine my long-term investments, okay? You could argue that this is a technical thing, talking about the price movement of a coin. You could argue I'm looking at the technicals, but I like to view this as a fundamental characteristic because when you buy an altcoin, yes, this is a technical consideration, but it is a reflection of the underlying fundamentals of the project. If the project has outlier price action, it's a reflection of the fundamentals. And it's also a reflection of some more technical things, but from a long-term perspective, if a coin has outlier price action, it's because of its fundamentals. So in crypto, the worst coins that you'll come across copy Bitcoin's price action. They'll go up the same as Bitcoin, they'll go down the same, they'll go down more and up less, right? Those are the worst coins you want to buy. So for example, things like Ripple, Litecoin, Cardano, XMR, Decentraland, anything that just copies Bitcoin, like only goes up when Bitcoin goes up, those are the worst coins to own. And the best performing coins, the ones that make you the most money, ignore it. They don't give a fuck what Bitcoin does. They'll do its own thing. And you probably already know this if you've been in the market long enough, if you haven't seen this, but now you understand that this is a really important characteristic. So just to help you visualize in a really simple way what I'm referring to. So in crypto, right, you got all these different coins. They're all moving at different times, at different price movements. Generally speaking, the market is doing roughly the same thing. So most coins are moving roughly the same region, roughly going up at the same time, roughly going down at the same time. They're doing the same shit. But there's some coins, 1% of the market, 2% of the market, which are doing their own thing. Now, if let's say there was a coin doing this, right? That's not an outlier coin in the way that I look at it. An outlier coin in the way that I'm looking at it is an outlier price action where it goes down less and up more. Okay, so you can see here, the market is making lower lows. Whereas the market here, let's pretend this is a multi-month time frame, this coin is making higher highs. This is a incredibly bullish coin, and this is something that you actually can use entirely by itself to determine an investment. You could look at a coin that looks like this, see a chart like this, and you can buy on this breakout, knowing that it's basically guaranteed to go up. It's like one of the highest hit rate setups in crypto. That breakout of that key level when it has outlier price action for multiple months. It's such a high hit rate because the whole market is weak and this one is not weak. There's a reason for that, and we're going to cover the reason for that in this video. And Kun, as always, with some really valuable tweets here. He said that a first level test you can use on looking through alts is you don't want to be able to tell when the Bitcoin local tops and bottoms are on the chart. So for example, let's pretend that purple is Bitcoin, right? You can see that this is the bottom, this is the top, and, there's a top here. You can't tell that on the red, but you can tell that on green, on yellow, sort of on blue, and you can tell it all here. On blue, you can tell. On yellow, you can tell. But on red, you have no fucking clue. And that is a good first sign for whether you should be buying a coin or not. It should look like it flows up and down on its own terms. Obviously, greater markets impact on dips, but the chart shouldn't just copy Bitcoin and Ethereum. Because when you think about it, why do you buy altcoins? What's the point? Well, the entire point is to outperform it. It's to outperform Bitcoin, Ethereum, and Solana. The whole idea of altcoins, the whole reason they were originally invented was to stack Bitcoin. That was the whole idea. It was like the only good coin's Bitcoin. There's all these other coins like Peercoin, Dogecoin. We just buy these shit projects to get more Bitcoin because we know maybe this is the best project. And now the market's more sophisticated. Oh my God, the coins are better now. The old coins are still just as fucking terrible as they were 10 years ago. They're really not any different. So your goal of buying an altcoin is to stack Bitcoin or Ethereum or Solana. If your altcoin is just a slower Solana, if it's underperforming Solana, why do you own it? What's the point of owning a coin that goes up less than a coin which has less risk? It doesn't make any sense, right? If your coin has to have Bitcoin go up so that it goes up, why the fuck do you own it? Why not just own Bitcoin? Why take on more risk for less upside? If this is Bitcoin and your coin only starts going up, here, and it's always underperforming Bitcoin, you take on more risk because this coin's going to go down more when the bear market comes. It's going to go down way down here, and it's going to make you less money. So it has 0 point. But most of you watching this video, you have altcoins which go up less and go down more. You would be better off just holding Solana, holding Ethereum, holding Bitcoin. What's the fucking point? There is no point if it's just going to underperform. And this is why you need to buy outlier coins. So you have to benchmark your returns against what is likely to occur for these coins in a bull run. If you expect Ethereum to do a 4x, you have to own coins which you think can do more than a 4x to justify the additional risk. The question is, will you make more or less? If you're going to make less, why bother? Doesn't make any sense at all. So why is outlier price action so important? Because I've been doing crypto for 6 years. I've basically come to learn that coins which trade completely separate from the rest of the market are not to be ignored. There's been so many countless times where I've seen a coin and it's just doing its own thing while the market's crashing. And I'll be like, what the fuck is this coin doing? What's happening? Why is it doing this? And then you'll ignore it, but you'll just be like, whatever. You forget. And then that coin's pumping for months on months. And you're like, what the heck? What just happened? Why did it do that? And that's happened a lot of times. And it's happened recently with Casper. I completely missed Casper. And it's the perfect case study you need to look for in an investment. And I'm going to cover this a bit later. So outlier price action is basically a sign of underlying strength, which tends to continue beyond the day that you notice it, right? So you notice the coin's strong. The market dumps, it doesn't dump. That strength is not temporary. It tends to be at least for a few days, at least for a week, or maybe even multiple months. Okay. So when a coin moves its own direction, it has a completely separate supply and demand dynamic occurring, right? It's not dictated by the same supply and demand as the rest of the market. And if the coin is going up when the rest of the market is going down, the supply and demand dynamic is less supply and more demand. And you want to own things that have the most demand and the least supply, because if it has the most demand and the least supply right this second, it's probably going to continue to do so, right? It just makes sense because markets have momentum. Outlier price action can be determined on a low time frame for momentum trading or a high time frame for picking longer term investments. So you can use outlier price action for a short-term trading strategy, or you can use it to help pick your long-term investments. Now, this section of the course is for, fundamentals for investing, but we will go briefly into the momentum trading side of things. So let's cover that now. So for example, if you're looking to learn a trading strategy for crypto, one of my favorite ones that I used to do and that is really profitable is momentum trading. So when the market has a crash, so let's imagine Bitcoin, Ethereum, Litecoin, Solana, XRP, Ripple, and then this coin's doing this. You want to be bidding this coin because the rest of the market has got very bad supply and demand dynamics, and this one has very good supply and demand dynamics. And if it has good supply and demand dynamics right now, it probably will have good supply and demand dynamics tomorrow, because you have to ask yourself the question, if Bitcoin dropping 10% in a day can't make a coin go down, what will? If Bitcoin drops 10% and a coin doesn't drop, what happens when Bitcoin mean reverts? If Bitcoin does this and your coin does this, what happens when Bitcoin mean reverts up? Well, this coin's going to go ballistic because it has strength. If it goes down less, it's going to go up more. If it has less supply and more demand, it just happens, right? Bitcoin dumps 10% in a day, it's going to mean revert, right? If it mean reverts, that's going to give this coin the strength to push up. And people are going to recognize this strength and they're going to bid this coin. So what happens is this: one coin goes down, all the coins go down, and then there's a couple coins that do this. And the market recognizes these ones and they start bidding. So all the momentum traders start bidding. And the goal is that on the crash, find the coins which are basically holding their ground, which are outlier price action, and bid them. And I'm going to show you an example of this right now. So right here, you can see this is a low time frame chart of the coin C, and this is Bitcoin. So if I zoom in here, right, you can see that Bitcoin is going down, lower lows, and this coin is going sideways. So you could see just by common sense, okay, this coin is not making new lows while Bitcoin is. I should probably bid this coin. Right? Pretty straightforward. And all you had to do was, you can see it was going down again and it was going sideways. If Bitcoin crashing can't make this coin go down, what will? And you can see that Bitcoin did finally go up. And what happens? Well, this coin goes up significantly more. It went from 22 cents all the way up to 36 cents. So you made like a 50% gain, whereas Bitcoin went from 42,000 to 44,000. So that's how much of a gain is that? That's like a few percent versus 50%. So you can see here that because it had the underlying strength, it was able to outperform the market. And you can see another classic example here. This coin's sloping up, Bitcoin's going down. So you could maybe do some sort of retest, breakout retest strategy, because you see that Bitcoin is weak, this coin is strong. And you can see here that when Bitcoin rallied, the rally around the concept of momentum, you analyze the low time frames, you wait for Bitcoin to dump, you see which coins hold up and which ones go sideways. You bid the ones at support levels that go sideways, that have outlier price action, and you ride them as they pump. So this is a low time frame trading strategy, one of the most profitable ones that you can follow, one of the ones I highly recommend if you do want to try trading. It works really good because the way that you should view what just happened here is this tweet really well summarizes it. In my opinion, the best part about post nukes will always be when the market shows its hand and screams to you whatever coin has more buyers and less sellers, or less buyers and more sellers. What you want is more people buying, so more demand, and less sellers, so less supply. And when the market drops, it shows that to you. It shows to you which one is the leading coin, which one is the fastest horse, and that's what you want to bet on, okay? I said to you that there's two ways you can analyze price action. That was the first one for trading. Now this one's for investing, which is what this course is about. So a classic example of the outlier price action is on a coin called Casper. It launched in like November 2022, so about a year ago from when this was filmed. And Casper's gone up about 100x or more. And the reason why Casper has done this, I think, is down to four main reasons. So reason number one, why does Casper have its outlier price action? Well, it had a perfect fair launch tokenomics, which allowed for organic price discovery to occur. So, let's do some visualizations here. In the course, we talk about why VC coins are bad to invest in generally. It's because if this is pre-market, most of the value of the coin, most of the upside is priced in before the coin is launched. And then the coin launches, and then that tends to, be the final part. Casper was a fair launch, which meant it launched here. It allowed you to capture this upside, on the open market. And when you make your holders rich instead of the VCs rich, you're allowing your project to have outlier price action because you are maximizing the community building score. And you're also rewarding the people who are most likely to not sell your project. Remember, VCs want to take profits fast because they need to deliver profits to their investors. Retail investors are only accountable to themselves, and they tend to fall for the HODL, 1000x, new paradigm logic much easier and at a much larger scale than a VC who has people who don't give a fuck about crypto breathing down their neck, who just want to make a profit. How do you have outlier price action? More demand, less supply. How do you get more demand and less supply? You have an organic community where growth happens slowly and naturally over time. And you have rewarding people with profit who are least likely to sell, right? Pretty simple. And that's how you create outlier price action, in my opinion, at least one component of it. Now another reason is, and you can see here, no pre-mine, there's no allocations, no VC stuff, a community owns the coin. The second part is the high conviction holders. So because the project is obviously really good, the holders, the people who actually own Casper, have a very high conviction, and they understand that this is a layer one protocol. The competitors are multi-billion-dollar valuations. It doesn't make sense to sell this until this one is at a multi-billion valuation, right? Steady, organic growth built off the back of a team which executes and is playing the long game. So, if this was a VC coin, they probably would have had all of Twitter talking about it on launch, and most of the upside would have been priced in immediately. But with Casper, it was very much a community-run project. The growth was slow. People slowly found Casper, which allowed for an organic inflow like this instead of a VC coin where it's all at once on the token launch because the VCs want to make money fast, right? Or maybe within the first few months, then their tokens get unlocked. All that upside's been priced in. Now it's going back to being a regular coin. But if it was a slow sort of growth of the community over time like this, then the price action tends to do more its own thing, instead of copying Bitcoin. Now, number 3 is, like we just said, and number 4 is also the launch time. So Casper launched at the bottom of the bear market, right? October 2022, when things were terrible, Casper launched. Imagine if Casper launched, let's say, 5 months earlier. Casper would have had its initial investors maybe losing, 80% of its stack. And that would have created more overhead supply. It would have been more challenging for the project. It might have performed differently. So the fact that it launched at the bottom, it had a fresh chart when the prices weren't going to go any lower, set it up for massive success. So let's look at Casper and Bitcoin. So this is a 1 year time frame. Okay, I'm showing you 1 year. You can see that Casper goes up while Bitcoin went sideways. You should be looking at this coin going, wow, it's an outlier. Why is it doing this? And you should be looking to bid this one on retracements. So you can see here, Bitcoin down, Casper up, Bitcoin down, Casper up. So you can see that sometimes it does the same thing, sometimes it doesn't, but this is an example of an outlier coin. And it's funny because sometimes Casper does the opposite. So sometimes the market goes up and Casper goes down. So I think here's a classic example. Bitcoin was pumping, Casper just went sideways, right? But this is a great example of an outlier coin, okay? This is what you want to own. Now, let me show you an example of a bad coin. This is Bitcoin, Ripple, Litecoin, and Stellar. So you can see here that the higher on the chart a coin is, the more returns it made. So you can see Bitcoin, 100%, Ripple, 80%. You can see that they made less money. Now you can see that they basically follow Bitcoin, but just do less. So you can see that Bitcoin rallying here. So you can see Ripple's rallying here, the yellow one, the blue one's going up, and the orange one's going up. You can see that they all go up at the same time, right? They're all following the same general trend, right? Up, down, up, down, up, down, up, down, up. Now, this is the coins you don't want to own because their price action, their bull market is completely dependent on Bitcoin going up. Casper didn't need Bitcoin to do anything. It was doing its own thing. And that is why it has gone up 100x. These coins need Bitcoin for it to go up. And this is why they don't go up 100x. It's why they underperform. It's like imagine a high school project where you've got one kid who does all the work and then you've got the other kids which basically do nothing. They contribute like a tiny bit of the assignment. But if the assignment gets a good ranking, they get a good ranking. So they basically piggyback off of the success of someone else. You don't want to own the coin which requires someone else for them to succeed. You want to own the coin which is going to bring the success. And now if you look at this tweet, this is also another way that you can look at outlier price action. So at the bottom of the market, or whether it's the broader market or a particular coin, you're going to see bad news come out and you're going to see price not go down or price go up. If bad news comes out and price goes up, that is a sign that we have passed the point of peak fear, of peak scaredness. And is a very simple visualization for you. When the market hits the top and it begins to go down, good news comes out here, good news comes out here, and price just keeps going down. This is bearish, and this is what the top of the bull market is going to look like. Good news coming out, price not caring. And the inverse, when the market has hit its bottom and it's beginning to go up, you're going to see bad news. You're going to see China bans Bitcoin or whatever it is, right? And price is just not going to care. And that is how you know a bottom is in. Okay. And so the same thing for picking outlier coins. If you see Bitcoin being the bad news going down and your coin going sideways, it's a sign of a market bottom. It's a sign of at least that coin having a bottom, right? And he gives another example here. When Binance and Coinbase were attacked by the SEC last month, we saw a small dip, but then something strange happened. The market rallied, and in a few days, the prices were higher for the news. In normal circumstances, this kind of news would have resulted in a 30% fall in prices. It's safe to conclude that the market is tired in that circumstance. Those that wanted to leave have left, and most importantly, those that wanted to fumble their bags had done so. So if a coin can't drop when the news is bad or the rest of the market is dropping, it's a sign that there is an underlying bid, an underlying strength. There's something happening with this coin that maybe is not yet apparent to you now, that will be apparent to you in the future. And it is your job to not ignore that, but to pay attention and double down on figuring out what's happening and to get yourself exposed, because you need to be owning the fastest horse. You need to be investing into the person in the school group assignment that's doing all of the work, because it's that person who can determine its own future, who can determine its own fate, and will go far further than the people and the coins who rely on something else going up for them to go up themselves, okay? Casper is a classic example. Any coin that you find which is doing its own thing, which is going sideways when the market goes down, is worth looking into. So a little general heuristic for you, if you want to go to CoinGecko, right, or any of these platforms that list all the coins, basically just look for coins with charts that are not like any other chart. And if you find a coin which is moving unlike any other coin, add it to your research list. Figure out what the fuck is this thing doing? Why does it look different? Why does this coin have a bid and a holder base which view it differently to the rest of the market? What are they seeing that I'm not seeing? Why do they think this thing is undervalued? Why is there so many people who want this? Why is it so much stronger? Why does this have a cult community of people who will never sell? What am I missing? And that is the question you need to ask yourself. Thanks for watching. I'll see you in the next video. For this video, I want to cover one of the fundamentals of the age of a particular project. Now, avoiding old dino coins is one of the most important rules for maximizing your returns in bull runs. Mana, so Decentraland, Curve, Litecoin, Cardano, Ripple, etc., etc. These coins are a must avoid, okay? And I'm going to get into in this video why you must avoid these. And there is a particular subset of coins which you should be focusing your attention on, and we're going to be covering what these projects are as well. So to understand why new coins are better than old coins, and to understand why you need to avoid in particular these like dinosaur coins, right? The ones that just never go up much in a bull run. The reason why you need to avoid them, and to understand why you need to avoid them, I want to sort of take you through a step-by-step journey of what it looks like when a coin launches and what it looks like when a coin dies from day one to the end, just to show you the process that probably like 99% of the market goes through on that journey of a new coin, getting all the hype to becoming an old coin and no one gives a fuck about it anymore. Step number one of a new project is obviously its coin launches, right? Everyone has the token, the project's new, there's a lot of big promises about what they want to do and all the things they want to achieve, and because it's new, everyone believes them. If you say, I'm going to do this, and this, and you've just said that you're going to do it, and it looks like you have a chance of doing it, people are going to believe you, and they're going to hold you to that. But the biggest problem is all of these big goals and dreams that projects set, they never end up achieving it. The team are super excited to build stuff and get rich from building stuff. So the team generally, before they've launched the coin, as wealthy as they want to be. And the goal of launching the coin is to become super wealthy. Now, keep in mind, most people are motivated by money until they get enough money where it doesn't motivate them anymore. From that point, most people end up dropping off. When teams first build the project, they're really excited and motivated because they're not rich yet. But when they get rich, that's when they drop off. So, this is the start of the project. Next up, the community is new. They're happy. They're excited. It's a new coin. Everyone's like, wow, this thing's new. I'm here at the ground floor. This thing's going to go to the moon. So the first 3 to 12 months of the coin are generally the best period of the coin's life because it's all fresh, new, and exciting. New sector, probably new technology, potentially new team, new community, new ideas. It's a new chart. There's no price action. Everything's new. And so the first 12 months, price sees amazing upside. Generally, most coins launch in the bull run, right? So generally the coins, when they first launch, they have the most upside performance. Most people, when the project's new in the first 12 months, are in a profit. Look at these new coins, for example. You can see it's launched in August. All the holders are now in a profit. This one launched recently. You can see everyone's in a profit, literally a month or two, and it's already, gone up a lot. Another one would be Tau, Itenza, new coin. You can see it's up a lot from its bottom. It did go sideways for quite a while, but you can see it's up a lot now. One came out in April. This is where the first 12 months, as you can see with all these projects, is where they see the best performance. And after 12 months has passed, the team is basically expected to have fulfilled promises. When you said when you launched a project, we're going to have this done, and we're going to launch this crazy thing, and we're going to have all these users, and we're going to beat this project, blah, blah, blah. If you don't do it in the first 12 months, or at least show signs of doing it, the community is going to begin to become concerned and a little bit disappointed, and maybe as well angry about what's happening. And the market may shift bearish, which adds further challenges onto the continued growth of the project. Most teams, 99% of teams, say something big like here, up here they're going to do this, and they only ever deliver this. And after 12 months, that's when people begin to realize this. Oh shit, maybe this team isn't as good as we thought. It's been a year. I've been holding this for 8 months. Nothing's changed. And there's all these new projects popping up. Why do I hold this thing? And also after 12 months, give or take, the VCs, the founders, the team, they're all beginning to get their tokens unlocked. So let's say the VCs have a bunch of money and they are locked up for 6 months and they can't get any money out of the project in the form of tokens 6 months after the token comes out. They might have millions of dollars on paper, but it's locked up, so they're not actually rich yet. But once they start to get unlocked, that's when they begin to actually feel the wealth effect of the coin that they've launched. This is the Arbitrum unlock schedule. Arbitrum's worth hundreds of millions of dollars, right? When the project came out, you can see very minimal uptick in the value of, it's not the value, the amount of supply released. It pumps like this. It goes ballistic. And you can see here later in March, the supply goes up here as well. This is different groups of the supply. You can see that it's December now, and there's a big unlock coming here. That is where a lot of the insiders are going to actually realize their wealth, right? Right now, all the Arbitrum holders are probably in a big profit from the VC round that they got in, or the team's token allocation, whatever it is, but they haven't been able to realize that profit because they've been locked. So yeah, maybe you're a multimillionaire on paper, but you can't feel the effects of that until you actually get the money. And that's the problem. After 6-12 months, these founders, team, VCs get their coins unlocked. Now they're rich. They can feel it. And then they get less motivated, a lot of them, because once they get the money, what they do is sell the tokens to buy mansions, supercars, achieve their financial freedom. You can see here, Curve, terrible performer, 50% from the bottom. The Curve founder has sold tens of millions of dollars of the Curve token to be able to fund fund his mansion, 42 mansions, sorry, in Australia worth about $40 million. Okay. How did he fund this? Well, he was just selling the Curve tokens that got unlocked to him over time. Now that he's got his financial freedom, he's probably got a family, kids, everyone's happy, he's got his dream life. Why the fuck does he need to keep making his holders rich? He doesn't, because he's got away with it. He's bought himself 2 mansions worth $40 million and he hasn't gone to jail. Maybe the community sort of hates on him, but he's built what he was supposed to build. He doesn't care anymore. After this point, they see the founders super rich. They see that the founders probably getting less motivated. The things that they want built aren't getting built at the same standard they were expecting. And the community starts to get skeptical. The team's not going to fulfill its promises. And the early holders start nagging the team, asking, when's the token going to go up? When are you going to make me rich? What happened? Did the team brag? All this shit. And over time, the team builds resentment for its community. At the start of the project, the community gave them excitement and joy, but now it's moving towards resentment. And this happens more and more as the token price falls from the insiders selling, the bearish backdrop, maybe the market goes bearish as well, and the early holders taking profit. So the ones that got an early take profit, the market's bearish maybe, so that actually has a negative impact on the price. And the insiders, the VCs, are now selling the tokens as well because they're now getting unlocked. So you can see that the supply and demand dynamics are getting a lot worse. The community might have been a cult at one point, but it's losing its strength because the core marketers, its holders, aren't promoting it as strongly because nothing that they wanted to be built has been built at the same standard that they were expecting. And they end up moving from this cult to the next cult. They're a part of this cult community for as long as it makes them want to be a part of it. And when it starts to show signs that it's not the best community, they're going to go find the next one. Over time, the coin slowly fades into oblivion with a small, not super committed group of bag holders remain, and they pray basically for a bull run to exit their bags. And that's what you see with coins like Curve. No one really cares about it anymore. It goes up when the bull run happens because everything goes up. But there's just tons of bag holders, people who bought here, who were all once in profit and never sold, and now they just want to get out at break even. Okay. Here's some examples of coins that do really terribly once they've had their first cycle. So you can see here Litecoin against Ethereum, terrible. It's been underperforming Ethereum for years. Cardano, same thing, right? It has periods where it pumps, but ultimately it just ends up dying back down here. RSR, same sort of thing, just dying. Ripple, dead for 6 years against ETH. Decentraland, it had one pump against ETH, and then it's just gone down only since. Classic examples of what 99% of the market looks like against Ethereum. If you're going to hold a coin outside of Bitcoin or Ethereum, you want it to make you more money because you take more risk. Why would you take more risk holding some shitty coin like Ripple when it doesn't offer you more upside than ETH? You'd be safer owning ETH and you'd make more money. It doesn't make sense. If you're going to own a smaller coin, it's got to give you better risk-adjusted returns. It's got to give you a more asymmetric upside. It's got to have a return to justify the risk. And these coins just don't have it. You can see they don't. Unless you capture some brief period of outperformance, which is very, very hard to time. It's just not going to work. What are the characteristics of new coins and old coins? Because what we just described then was the journey from being new to being old. And you can see which point in time you would like to be a holder of the token. So let's go over the characteristics. When a coin's new, there's no expectation of major development. People understand that things take time to build. They give you a year. They're like, I'll give you a year to build shit. With old coins, there's an expectation that they should have built shit. In 3 years, where's the adoption that you promised us? New coins, fresh, new, exciting. Old, pump and dumped, less interesting. The team, the VCs, the pre-salers, they're all locked up, so they all want to work really hard to promote the coin, to make it go up in price because they want to be able to sell at the highest price possible. When the insiders have their tokens unlocked, this is what the old coins look like. New coins, they have a stronger conviction from holders, weaker conviction for the older coins. New coins likely are going to be in the sectors that are the most popular. That tends to capture the most flows, the most attention, the most money. Older projects tend to be in older sectors that people don't really give a fuck about anymore. So you can see Curve is a DeFi protocol. It's basically the backbone of majority of Ethereum DeFi, and no one really cares about the token because no one really cares about DeFi anymore. Even things like Aave, you can see no one really gives a fuck about anymore. Now, obviously the token's going up, but it's up 2x from the bottom. How much is Solana up from the bottom? $10 to 100 is up 10x. How much is TIA up in the past month? $2, 5x. So yeah, you can hold Aave and make it 2x, but you could have held something for 10 times less and made 4 times more, 3 times more. So that just shows you a bit of perspective there. No bag holders, everyone's in profit or near to it. When a token launches, maybe it does this, maybe it goes down a little bit like this. Maybe that's a 30% retracement, but people aren't in a big loss. They're like, okay, I'm okay with losing 30%. And then the token goes up, it's in new all-time highs. This is where the fun begins, in price discovery. With an older coin, right, it's been through this whole cycle of down here and, there's bag holders who want to sell at all of these levels. So when it finally goes up, it's got to get past all these sell walls of people who just want to sell and get out of break even because they don't believe in it anymore. But a new coin, C, for example, everyone's in profit. People tend to hold with a different mentality than when something is in a loss for everyone. So you can see here, the old coins, most holders are in a big fat loss, ready to exit at break even. So the ultimate conclusion is that new coins have more demand and less supply, and old old coins have less demand and more supply. So that is the basic conclusion to summarize why you want to buy newer projects and why you want to generally avoid older projects. Now, saying that, there is nuance, and this is the nuance. You want to own two types of coins in crypto, okay? You either want to own new coins like we just talked about, or multi-cycle outperformers. Let me explain what a multi-cycle outperformer is. So firstly, a new coin, how do you define new? Well, it means that it hasn't had a bull cycle. So C is a classic example. Hasn't had a bull cycle. It's, you can see that it launched here. It's just been going down, hasn't had a bull market. Also, the token is under 12 months old. So generally, if it's older than a year, that's not a good sign. So if you look at C, it came out in, what's this, August? It's December. That's like 5-6 months. That's perfect, okay? This one might be, I think it's like 6 months old as well. So that's another example. Multi-cycle outperformers is any coin which has or likely to hit a new all-time high in a separate bull market or outperform Bitcoin and Ethereum. So a multi-cycle outperformer is a coin which continues to perform well bull market after bull market. So let's look at Bitcoin. Bitcoin is the ultimate multi-cycle outperformer. It has been going to new all-time highs on this chart every single cycle. Now, Ethereum is another multi-cycle outperformer. You can see here that ever since it came out back in 2016, new all-time highs. This was the first bull run, second bull run, and the third one, we're looking good. We could go to new all-time highs here. Now, is there any other coins in crypto which are multi-cycle outperformers? I'm aware of two. So let's go over the two that I'm aware of. So Binance Coin is a classic example. This was back in 2018. This isn't necessarily a multi-cycle outperformer because this didn't exist for much of the last bull run. But look, this was the 2017 bull run, okay? It launched at the end. It still counts, okay? In the 2017 bull run, it had a high here. And then in the 2021 bull run, it hit new all-time highs, okay? So I'm going to call that a multi-cycle outperformer. So Solana is my pick for another coin which could be a multi-cycle outperformer. And I'm going to explain in this video why I think that is. But if we look at Solana versus Ethereum, you can see that it almost hit all-time highs. So one of the main ways to determine a coin as a multi-cycle outperformer is it's hitting new highs against Bitcoin, Ethereum, etc. So if we look at Sol versus Bitcoin, it's probably a bit lower. But you can see that how many coins in the market are about to hit new all-time highs against Ethereum or getting close to new all-time highs against Bitcoin. There's very, very few. I can't think of any. I literally can't think of any, just Solana. And it's funny that Solana is getting close to hitting new all-time highs against Ethereum because I have been saying for 6-12 months now that I think the only coins that you should hold from the last bull run are Bitcoin, Ethereum, and Solana. It's always been the ones that I've said that you can hold from the last bull run. And if you're not going to hold those, you should be holding something that's new. The reason that I said that you should be holding Solana, even though it hasn't proven that it's a multi-cycle outperformer, but it's showing that it might, is down to a mentality of the holder base of the project. And I actually tweeted about this a while ago, and I did it in a thread here. In crypto, there's two holder mentalities. For 99% of coins, their mentality is, I own this to get more of something else. So they buy, for example, Arbitrum so that they can get more Bitcoin. They buy KuCoin to try to get more ETH. They own a coin just so that they can stack more of something else. Those coins they buy just to get more of something else, they tend to die. They tend to become the old coins. And the only way that an older coin can remain new and fresh and exciting and performing well is if people view it as something that they want to get more of by buying other coins. And that's a different holder mentality, right? So there's two holder mentalities, right? You buy Ripple to get more Bitcoin, or you're a Bitcoin holder and you're using these other coins to get more Bitcoin. So it's the same thing, but there's two sides of the coin, right? This coin is used to get more of something else, and this coin you want to get more of by buying something else. So these are short-term holds to get more of this, which is a long-term hold. People were denominating their portfolio in how much Solana that they had, and that has not happened for basically any other coin besides BNB or Ethereum or Bitcoin, right? People in their minds were like, I want to get more Bitcoin, more Ethereum, more Solana. That's how they viewed it in their head. Solana was a top 10 coin, but it was mentally viewed at the same level as Bitcoin, Ethereum, and it was, mentally a top 3 project. And there was a disparity between how people viewed it and how the market valued it. And this is another topic that we get into in this course on the difference between perception and reality. The reality was people viewed this as a top 3 crypto, but the market perceived it as a top 10 at that point in time 6 months ago. And that is why you are seeing this right now. The market is realizing that everyone is denominating net worth, a lot of people, in Solana. They buy everything else to get more Solana because they're so bullish on it. Because the problem with old coins is there's a lot of supply pushing price down, and there's not much demand. But with Solana, there is lots of demand because there's everyone who makes money in crypto putting their money back into Solana, which doesn't happen for any other coin. Every other coin has all this supply because people are trying to sell it as it gets into a profit to buy more of something else. So you can see that if you want to buy something for a multi-cycle outperformer, or you think something that might have a multi-cycle outperformance, it's going to be because it has a different holder mentality. And you can see here the two multi-cycle outperformers, BNB. The BNB staff didn't really sell their BNB because they really believed in it. They made so much money during the bull run just from this token going up. Binance was a coin that everyone knew was the backbone of, it was a cult. Everyone just knew that this guy just built shit and stayed at the front line of innovation. They just knew they wanted to get more of this coin. It was the mentality. Same thing for Solana, and that's why you're seeing this. So what creates a multi-cycle outperformer? The broader market must want to denominate their profits in that chosen coin, or they must view the coin as something they want to get more of by doing shorter term speculations outside of it. And I've always viewed Solana as a multi-cycle outperformer, as people want to buy shitcoins to get more of it. Okay, I hope I've rammed that point home now. That's all for this document, but I wanted to show you some tweets to show you something interesting. Bit of a thread here: old coin bad, new coin good. Okay. So this guy basically in this tweet, he gets into flows. Flows is the same concept as understanding supply and demand, right? Flows is just saying, where is the money moving? Supply and demand is just showing how much people want to buy, how much people want to sell, right? How much is there to sell, how much is there to buy? That's the same as flows. And he's basically explaining in this tweet that there is a number of different flows in crypto. So there's bearish flows, so there's supply, which is the people who currently hold the token, and then there's the token emissions. And then there's the bullish flows, which is the new people holding it or the token sinks. So for example, if you have to stake a coin, right, that's a token sink because the token's locked. If there's a buyback program, buy and burns get a bad rap versus distributions, right? So there's different ways that they can create token sinks where it's basically supply taken off the market, or, supply locked away. Or I guess it's also demand through buy and burns. So the mantra, old coin bad, new coin good, is a simple reduction of bullish and bearish flows. If there are few existing disillusioned unlocked holders, they won't have coins to dump. And because it's new, everyone still has to buy. So there's lots of new holders, not rocket science. So when evaluating any play now or in the future, you should have a mental model of what are the flows here. And this is one of the topics that we talk about in the fundamentals, the flows. I think it's the first one we cover. And if you don't have strong thesis on which way flows will be, maybe don't take the trade right now. There will be a future when new inflows dominate all again. We call that PVE. So that's something separate. But you can understand here that in bull runs, or in just generally any market in crypto in general, bull or bear markets, the new coins outperform because they have more demand, less supply. Pretty simple. Here's an example of that in fact, right? Lido, great coin. It's the largest liquid staking derivatives platform in crypto for Ethereum, has billions and billions of dollars locked up, has great revenue numbers, overall great project, right? It's got a lower valuation than Jito, which is significantly less good if you were to look at it objectively through a certain lens. For example, the revenue was a very reasonable lens, and the TVL to look at something might be valued. So the Lido revenue is 80 million. The Jito revenue was 35x less. Lido TVL, 22 billion. Jito TVL, 500 million. Again, that's like 40 times less, I think, 50 times less. You get the point. But Jito valued at 4 billion. Lido valued at 2.4 billion. Why is Jito valued more? Well, it's a new coin, and revenue numbers and shit don't really drive performance. It's all about the narrative. It's about the story. It's about new, shiny, exciting. It's about what people think could happen, speculating. It's the speculative premium that exists within a project, okay? The coin you held 6 months ago are not the coins you are holding today, and they will be different in 6 months' time. If not, you're either a maximalist or a retard. What's the odds that your first draft is the best lineup forever till the end of time? 0. Okay, great comment here, and this is absolutely true. If you're not constantly reorganizing your portfolio to stay up to date with the latest trends and to take profit on coins that have now shifting into being an old coin, you're going to underperform the market. Now, you don't necessarily need to reallocate every 6 months, okay? That might be a little bit too often. At least from bull market to bull market, your entire portfolio should look entirely different. I know a lot of people who, they send me their portfolios and they're like, oh yeah, I still have these coins from the last bull run. In this example of either a maximalist or a retard, they're both. They're retarded and they're a maximalist because they own a coin which is old, and they understand that it's old, and they understand that it's not going to perform well, but but they've psyoped themselves into keep holding it because they're now a bag holder. They can't sell. You have to sell. You can't keep holding that shit. You're going to underperform the market. Give me one reason why I should buy alts that have a $500+ million market cap, had a bull cycle before, coming unlocks and bag holder VCs, waiting for years to dump on me. There are just a few that will survive and most will continue to go down. You can ignore low caps, trade them if you want when they're at the end of their bull cycle with high volume on tier 1 exchanges, but I'll be the one selling to you. So this is very, very true. When you buy a coin which already has a $500 million market cap, very likely people bought it significantly lower. They're locked up from a VC round or a pre-sale or whatever it was, and they're looking to dump on you when they get unlocked. Also, you're supposed to buy coins before they have their first bull cycle because that's where all the gains are. That's where the outperformance is. If you buy it after it's had a bull cycle, very likely you're not going to get that performance that you're looking for. So to summarize everything, you want to own 2 coins. A new coin, which hasn't got bag holders, which is new, close to breaking all-time highs, new narrative, new, exciting, fresh, or a multi-cycle outperformer. So a coin that people want to get more of, that they want to denominate their portfolio in, that has a world-class founder, that shows that it's able to stay up to date and always stay at the bleeding edge of innovation and always pivoting into the newest sectors to stay fresh. Now, I just remembered one more coin which you might consider a multi-cycle outperformer. And the reason that Matic has been able to keep performing well is it's always pivoting to new sectors, right? Once it was a layer 1, now it's a layer 2, turns into whatever is hot and trending in the market. And that's how it's been able to keep relevant. That's all the characteristics, and that's how you should be approaching crypto. Buying new coins or multi-cycle outperformers. That's how I do my fundamental analysis, okay? I'll see you in the next video. Cheers. So in this video, I want to talk about advanced narrative analysis. This topic is quite complex. There is a lot to analyzing narratives. I just want to be really clear from the start of this video that you're not going to be able to, after this video, analyze narratives like I do, because there's so many interwoven lessons and concepts and nuance and complexity to how I have gone about and learnt things. It's impossible to convey everything to you and unpack it all so that you can download it in this video. It's going to take you a long time to be able to analyze narratives and come up with really good narratives. I would like to, in this video, give you the foundations of understanding the importance of narratives in crypto and a bit of a basic understanding of how you can go ahead and use narratives to make money. And I want to give you as well a couple case studies of how I've used and other people have used narratives in order to buy things early and make money from them. So narratives is something that a lot of people talk about. It's one of the most common words people use to describe why a coin's going to go up. The core of making money in crypto is all about a compelling story. You think about why any coin went up, it's not really about the fundamentals. It's not because of anything they did. It's about the story behind the coin, the story behind the reason it's going up. Think about what people talk about online. They don't say Bitcoin had a record month of revenue. They say the government is printing excessive amounts of dollars and it's going to lead to a lot of inflation. You have to buy Bitcoin as a safety net to avoid inflation, to avoid monetary debasement. That's about story. And that compelling story created one of the biggest bull markets we've ever seen in human history during 2020. Obviously, there is behind the story. Stories can be truthful, stories can be lies, but it's not like it's a stock where it's fundamentally, objectively undervalued. It's about the story. And every single asset on the planet, to a certain degree, is driven by its story. You look at something as safe as gold or bonds. How do people determine the value of gold and bonds? Well, it's definitely not completely efficient. There is, to a certain degree, the element of the story behind the reason someone buys and sells. More than crypto, there is real reasons why something is worth what it is in the real world, why a stock is worth $1 or $2. There's a real reason behind it, but it's just we talk about narratives the most in crypto because what drives price in crypto is very much the narrative. Obviously, narrative plays a role in all markets, but in crypto specifically, because there's very little actual real adoption, we're still super early days. It's all driven by speculative premiums. The speculative premium is what is something worth above what it might objectively be worth due to what people are speculating on what can happen in the future. So in crypto, most of them have a huge speculative premium. Okay, sure, it doesn't have much adoption now, but in the future, we speculate that it's going to have value. And because people speculate it has value, there's a premium of the price for speculation. And that speculative premium is what allows us to make money through this narrative analysis. If you can buy a coin and come up with a narrative for why people are going to buy it in future and that plays out, you're able to make a lot of money. And this is what I did on, for example, Toshi. Toshi's a meme coin. Meme coins are just driven by narratives. It's not about anything real. It's all about the narrative. And so when you do fundamental analysis on any of these meme coins, the main thing you got to focus on is the narrative, because that's all that drives a meme coin. It's a story. What is a meme? It's a interpersonal relatable story that we can all laugh at. That's what a meme is. You look at a meme, everyone understands it, we laugh at it, it's a story. What is a meme coin? It's the ability to put financial gains or losses attached to the amount of people that know about a certain story. Why did Doge go up so much? Well, because Elon talked about it. He made the story of Dogecoin, the meme coin of Doge, so popular, absolutely ballistic in price. The most wealthiest man in the world tweeting about one coin. Meme coins are just social capital trading around with a speculative premium on what a certain trend, meme, movement might be worth in the future. At its core, that's what crypto is. And obviously you have coins that are like fundamental coins like Link, for example. There's all this talk about how the CEO of BlackRock, Larry Fink, is going to be pushing this sort of agenda of the tokenization of everything. And the backbone of this tokenization of everything is people believe that Chainlink will be a part of this sort of the infrastructure to enable this tokenization of everything. At least that's my understanding of it. And so people are now buying Link in anticipation of that narrative of Link playing an important role in this tokenization of assets sort of narrative. What is a story? It's a series of words, explanations, or logical conclusions. They all intertwine together to make large amounts of investors buy under the belief that price is going way higher. That's what a narrative is. When people talk about this coin is going to be massive because the first coin of a certain trend got a really great team, the community's strong, they got a new update coming out in 2 months. When they say all this stuff, this is the narrative behind the coin, the story behind the coin, which is going to make people buy. If you put the tech aside, the team, the community, all this sort of fundamental stuff, the most important part is the story. When someone is deciding to buy or sell, main thing driving that decision is what story have they been told about that coin? What is the story about what it's going to be worth in the future? And that's what drives their decision. Not many people in crypto analyze the PE ratio using all these different like fundamental analysis tools in order to determine like a fair value. They do that in the stock market. It doesn't work in crypto. It's all about the narratives, okay? The best market speculators are basically able to future predict which stories will form. That's again tying back to the mindset video, second and third order consequences. It's about understanding what will compel investors to buy your bags after a 10 to 100x. You make money in crypto from using this advanced narrative analysis by predicting correctly what narratives will take shape in the minds of people in the future. So if you guess correctly that in 3 months from now, everyone is going to believe a certain thing or understand a certain story, and you buy or sell today based on knowing that, you're able to make money as that story comes to fruition, as it becomes real. And a classic example of this story thing we're going to get into later, but it's the Toshi play. Thus, being able to analyze and future predict advanced narratives looking into the future is a huge component of making money. If you can know what people are going to think in a month, you can act today in anticipation of that. The way that I would go about thinking about coming up with a narrative, using second and third order consequences is, if X happens, what does that cause? This is a really useful exercise for you guys. Whenever you're on Twitter and you see something happen, or you're on YouTube or you just see something happen in the market, don't just go, oh shit, what's the immediate impact of that, the first order consequence? Make yourself think about 2 to 3 steps ahead. So let's say an ETF gets denied. Everyone's going to panic. The first order consequence is panic. ETF denied, that means crypto goes down. But now you need to think about what's next after that. What's the second and third order consequence of an ETF denial? That is where the smart people operate, and that is how you're able to make money. So let me give you an example with that ETF thing. Let's say the ETF gets denied. The first order consequence is crypto is going to go down. But then you need to ask yourself, okay, what happens after this? Well, what was the reason of the denial? Was it just a minor change? Was it they just didn't have quite enough time? Let's say the reason that they denied it was they just need a little bit more time and reapply and we'll accept it. If that's the vibe of what just happened, you have to say, okay, we dumped because the ETF got denied, but the ETF didn't get denied really. It almost got delayed to where they reapply. So if I was to buy the dip, it's likely that the market will go up again, understand the fact this wasn't a denial, it was more of a delay. Okay. And that would be using second and third order consequences. You got denied. Denial showed it wasn't a denial, it was a delay. And if it's a delay, then that means that they're going to reapply later, which means it'll get accepted, which means price will go up. So that would be like an example of using the second and third order consequences. This is relevant for a bull market, by the way, and the current crypto market. Maybe it's not in the future. This was posted by a guy on Twitter. I can't remember his name. I think it's Andrew. I didn't make this. I found this. If you do attention times story, if you have people looking at your coin and there's a great story behind it, you're able to make money. Okay, the coin is going to go up in price. For example, how do you get attention on your project? The community are affiliate marketers, so they basically build the community for you. Marketing stunts, you could do stuff that gets publicity. You could have a cult leader who has a following. You could hint at an airdrop, which means people are going to come across and start using your platform, maybe buying your native token. token, whatever it is. If there's a referral system, they refer their friends, sort of like the affiliate influencers. They get people to find your coin. Ecosystem funds. If there's a fund for the ecosystem that's going to like attract people to come over. And so if you have all of these different components of gaining attention and you've got a really promising story of behind the coin, the metrics are rising, there's more demand, products are getting better, there's updates coming out, good things are coming. That is set up for making money. Attention plus good offer. In a business, right? It's attention times offer. So let's say I wanted to grow my crypto business, right? What do I need? I need more people to look at my business and I need a better converting website or a better offer. So how would I get more attention? Referral system, affiliate marketers, better content, start posting on TikTok. How do I make a better offer? I have to maybe give more value away, maybe make the price cheaper, maybe add a guarantee, maybe make the offer sound better, maybe add a networking component. There's various different ways that I can go about increasing the conversion rate. This is what you would call like gaining attention, and this is what you would call converting attention. This is how people find you, and this is what makes people buy. Running a coin is like running a business, because when someone buys your coin, you just sold them a product. The product is the ability to make money. When I sell you a course on making money, it's not much different from selling you a coin. If I'm the founder of a coin, a shitcoin, I'm selling you the dream of making money. When you buy a course, I'm selling you the dream of making money. It's the same thing. It's a slightly different vehicle, slightly less scammy selling a course. Selling a coin, like running a coin, if it's a shitcoin, is a total fucking scam. This also relates back to the narrative a bit too, because here is the narrative. Why do narratives work in crypto? Well, like we just said at the start of the video, narratives are important because there's not really much real value behind crypto. It's all about what might happen. As well as this, people are stupid, lazy, and they're not investing. They're beginners. And stupid, lazy people don't like researching. They will buy something that makes sense to them. If they go on Twitter and they see a story, a narrative about why a coin is good, that is for 90% of investors, or not even investors, fucking gamblers, good enough. Okay, he said XRP is good because they got this partnership, because the founder's smart and they've got this thing coming out. The story they're told online is the fundamental research. So it's hard to buy something the market doesn't yet understand, and that's where the money's to be made. So most people, they require a story to be told to them to make them buy. They need to understand the story having been told by someone else before they get into it. I invent the story, and I understand the story before it has even been understood by anyone. I've come up with several different narratives, or I guess theses, which the entire market is completely oblivious to. And over time, the market understands what I'm saying, and I'm making excessive amounts of money. One of the first ones was the Blur airdrop. I came up in the NFT exchange token thesis. I was like the first guy to talk about that. And then everyone starts talking about it. Toshi. Obviously, the Toshi thesis was before I got in, but the level of depth that I went to was way beyond anyone else at the time. And that's what's allowed me to make those outsized returns on some of these plays. I'm understanding a narrative that's going to play out, a story that's going to play out before others do. So I want to give you some examples of like amazing stories in crypto. Obviously, we just covered Toshi. So I would say like alt-chain specific meme coins. So like a Solana meme coin, a Base meme coin. These ones have gone really well recently. They're very big stories. Another recent one was Solana versus Ethereum. So there's a whole narrative around that. Solana being faster, cheaper, easier, for arguments around which blockchain is more scalable, which one makes more sense, is it decentralized? Story of the house money effect and how Solana now has a house money effect. There's actually like new protocols airdropping and there's more money to be made on Ethereum. It's bringing this sea of money over. Once the money comes over, it usually doesn't like to come back. You can talk about how good the team is or what they do, the whole narrative behind Fire Dancer and what that means for how many transactions per second are going to be occurring when it comes out. There's this entire narrative battle between Solana and Ethereum. Another one is Bitcoins. The first cryptocurrency is Bitcoin. The narrative behind Bitcoin has led to us to get to $1 trillion market cap. How do we summarize the narrative of Bitcoin in one meme? This is the ultimate meme of crypto. This is the ultimate narrative. It's that you will buy a coin that you won't have to sell one day because it will be mass adopted by millions of people around the world. You're going to buy a Bitcoin and it's going to go up so much because so many people are using it that you never will actually have to sell your Bitcoin. You will simply just be able to use it. The whole idea is peer-to-peer electronic cash, decentralized, able to send money anywhere around the world instantly for very cheap. This is the whole narrative of crypto, of Bitcoin specifically. Now there's new narratives, but this is the main one. This is like a very, very big narrative. Another one would be Casper. So my friend, I got a video on this course with my friend. He talks about how he made a 50x on Casper, and he goes into the narrative that he saw when he first found the coin. And I want to go to Toshi first. So what was the narrative around Toshi? Well, let's look at this video. I think I've showed this video a few times, but I want to show you it again because it's really important to understand this exemplar because it's one, recent, and two, a really good example. At some point in this video, I show you different sections in this email talking about the step-by-step sort of narrative process I see. This was the narrative I had come up with. Remember, we talk about looking to the second and third order consequences. ETFs get approved, first steps played out, halving approaches. It's now January. The halving's in April. Bitcoin goes parabolic and the attention shifts to crypto. Coinbase, the biggest exchange player, people sign up. There's a positive regulatory backdrop, so Coinbase looks like it's going to win its case against the SEC. BlackRock supporting crypto publicly, the CEO on TV all the time shilling crypto. So we get good regulatory framework and backdrop. Real applications are building on Base. Coinbase wants to up its users in the value chain. They send them over to Base. Millions of users send money to Base. Creates a Base alt season. What do they buy? Well, they can't buy a Base token because there isn't one. So they have to buy a native meme coin because that's the best beta play asset. And that's the main coin on Base right now, which is Toshi or maybe Mochi. So that's me looking multiple steps ahead. ETF, halving, tons of users come in. Coinbase wants to send them across the Base. What do they buy on Base? You can see that I'm thinking multiple steps ahead here. And this is the narrative behind why people are going to buy Toshi. That's an example of a narrative that I came up with inside of my mastermind. We made tons of money. If you're watching this in a year from now and Toshi's dead or Toshi's $2 million market cap again, you need to understand that this is not a long-term hold. I will eventually sell this. So you need to keep in mind that there's not just, oh, it's down now, Daniel. Did you lost your money? No. Like, this video does not update you on what I do in the future. So just keep that in mind. Now let's talk about Casper. Casper is another example. Like, Casper is a layer 1, right? It's a new layer 1. Let me show you Casper. Okay. Casper is a new layer 1 protocol and everyone's looking at it and saying this is like the next Bitcoin. It's like a better Bitcoin. It's a founder who was cited in the Ethereum white paper because of this ghost protocol, I think is what he came up with. And everyone's really excited on this coin and it's gone up like 50x. I can see this coin has gone up a lot. What was it at down here? Very low price and now it's up at 11 cents, okay? $2 billion market cap. The whole supply is liquid. Fair launch. And my friend caught this coin very, very early. This is the narrative behind it. We talk about, quoted in the Ethereum white paper. So he, in a 2013 paper, he talked about the ghost protocol and it was cited in the Ethereum white paper when Ethereum was made. So this guy's an OG. Imagine you were looking for a coin to buy back in, let's say at the bottom of the bear market in December 2022. You were looking around, looking at all these coins, dog shit, dog shit, dog shit, dog shit. You come across this coin and you see that it's being built by a crypto OG who was cited in the Ethereum white paper, who probably knows a lot of the guys who are very deep in the crypto space. You could look at this and a number of other data points like their launch, it's a new L1, the next Bitcoin, all this sort of stuff. You can see the community strong. You could come up with a narrative, this might be the next big layer 1. And you could look at the fact that this guy is very deep in the crypto space. There's going to be more stuff coming out about how deep in crypto this guy is, about various things that high-level people have said about him. And so if everyone up here is talking about how smart he is, and this coin's at like a $50 million market cap, just by the association with these high-level people who run AVAX, Ethereum, etc., coin is going to just have its market cap gravitate up towards that region because the narrative will be strong enough to take it there. And if you look at, for example, there was a tweet here. This photo shows all the different high-level people who have an opinion on Casper. This is what the experts are saying. This is all positive stuff. For example, we've got the Ethereum founder. We've got Nervo's lead scientist, Grindev, Avalanche founder. I can't see what exactly this is showing. I can't show it to you. But it's all positive feedback on Casper and the different protocols or stuff that he's come up with over the years. So you can see that like the early days of the narrative was, okay, this guy's smart and everyone's, this is like a really strong narrative the market's going to catch on to. And you can see that now the market has caught onto it, prices up 50x. How many coins in the market can you say are created by one of the crypto OGs who's really smart, who basically contributed to the development of like the second biggest cryptocurrency? Not many guys you can say have that resume. So when you were researching back in the day, this would have bing bing, this would have like alarms would have gone off. And here you can see the AVAX founder comments on Zohar and his group, the track record. These guys are behind Casper, but he's like, didn't realize this was from Aviv Zohar's group. Excellent track record. Looking forward to their paper. This was like how many years ago? 8-9 years ago. As well as this, you can see like an example of like a narrative. Scalable, secure, decentralized, blah, blah, blah. All this bullshit, right? Here's another one. Here's another narrative. Here's another story. Remember, it's all about stories. It doesn't matter if this is true or not. It's about the story. Casper is in another league. It is the true embodiment of decentralized P2P digital stateless currency. Fully autonomous from any government or person. Fully in control by no one. By the people, for the people. Everything Bitcoin was meant to be. You could have gone and looked this coin when it came out and gone, man, like there's big narrative space here. Like big narratives could form around this coin. You could forward predict and guess that this stuff was going to start coming out. So I basically just went over this, but as covered in that interview, I was talking about the guy who did a 50x on Casper in my mastermind. The components of the story shield today after the price is up 50x plus were evident when you would have found the coin very early. Quoted in the ETH white paper. Notable figure. Specifics of the fair launch. It was clear. The seeds of the narrative were planted, but not known by the rest of the market. One thing to keep in mind is that the best performing coins generally had a Giga Chad founder. AVAX, Solana, BNB, Ethereum, Cardano. Every one of these coins had a Giga Chad founder behind them. And if you read into Casper, you would have noticed that at a $50 million market cap, this guy was a very intelligent founder, like these other top performing coins. So you could have forward predicted that as Casper developed and we came out of a bear market, but the market would eat up this narrative. So that's another case study for you. Now, let's talk about some considerations now that we've gone over this narrative stuff. Narratives are not the be-all, end-all. You can't just rely on a narrative to make money. There's more components. There's all the other stuff we talk about. Lots of narratives you're not going to be able to predict. So I'm not going to sit here and tell you that, oh yeah, I can tell every narrative that's going to happen before it happens. No, you can't. The ones that you can predict, like with Toshi, for example, you do really well on, but some narratives you're not going to understand. And really, not every investment needs a narrative. If you know that the team is really, really good and they're going to keep building and they're in a good niche and they're able to pivot and you're in at an early price and it's a new coin, you don't need to do a ton of depth into, what narratives are going to form. You don't need to. You can just purely invest based off of the other fundamental characteristics talked about in this course. Now, advanced narrative analysis works good for coins purely driven by a speculative premium. Buying meme coins and using narratives to understand why you should buy it is basically the only way that you can analyze a meme coin. It's only through narrative analysis. Obviously, it's important if it has a good team, but it all ties into the story, and the story is the main thing, okay? Now, the point at which a story is fully understood and digested by the market is the point at which you must sell. So a story and a narrative is only good if the market does not yet understand it. By the point the market understands it all, it's been priced in and there's not really much more money to be made on that narrative. If you have a narrative and it comes to fruition and everyone gets it and you're like, oh, great, you all agree with me now, you got to exit and find the next one. And I did a tweet about this. You need to sell when your once third order consequences become the market's front-facing reality. So let's say something happens which causes this, you're predicting to the third order consequence. When the third order consequence prediction happens, you have to sell because it's happened. Markets look to the future. Let me do a drawing here. This thing happens, which causes this, right? So you're predicting that this will happen. Let's say this actually played out. It's now happened. The market's now looking to the next thing. And if you're not looking ahead, you're going to be stuck here and you're going to lose money. You need to keep looking ahead. What's the next thing? What does this cause? And then what does this cause? And what does this cause? The universe is an endless cause and effect. Everything that has happened was caused by something that happened before it, and everything that will ever happen will happen because something caused it now. It's just an endless cause and effect. So you buy here, predicting this, and then when you get here, you sell, predicting the next cause and effect. And it's just an endless loop of predicting the future and selling when it becomes the present, or selling when it fails to become the present and you no longer think it's going to happen. Now, I think there was a couple other points as well. Some books about this. When the market looks weakest, when the news is at the worst, when bearish prognostications are most general is the time to buy, as every schoolboy knows. But if a man has in mind a picture of a flood of stocks pouring out from the four quarters of the globe with no buyers because of some desperately bad news which is just coming over the ticker, it is almost a mental impossibility for him to get up the courage to plunge in and buy. So the first sentence is the key here. When the market looks weakest, when the news is at the worst, that's the time to buy. It's because the narrative, the story of everything being bad and the world ending is at its point where it's most strongest. And like we said, the market is forward-looking. If the bad news has already played out and everyone understands it, what's the next thing? Is it good news? Oh, well, you probably should be buying. In the market, you are nothing but a chip on the tide of events. Optimism then must be consistent in believing not that the tide will continually flow your way, but that you will succeed in floating with the tide. So yeah, you can't, force what the market's going to do. You can't make a coin go up. So what I do is I approach the market without bias. I don't know where the market's going to go. I don't know what's going to happen. I just like to flow with where it looks like the market is going to go. Not based on what I would like to see happen, but based on what it looks like is going to happen. It's a very important distinction there. I don't look for a coin and justify some reason that it's going to go up, like, oh, I'm going to come up with some fake narrative. No, like I keep an open eye and I look for things, and if I find a coin and the narrative builds, and then I'll look into it and maybe consider buying it. But it's because I'm really convinced on the narrative, not hoping that it has a narrative, but finding it. I can't force a flower to grow, but I can plant the seed and let it blossom. I can't force finding a good 100x coin. People are always like, Daniel, when's the next coin? When are you going to find the next coin? Like in my mastermind, I'm like, I don't know. I'll know it when I see it. I'm not trying to rush it. I could easily rush and tell everyone to buy like another fucking coin and then lose everyone money, but that's not good. I would rather just go with the flow. When an opportunity presents itself, oh great, boom. I guess same sort of thing with dating, right? It's like if you try to force a girlfriend, you're never going to get one. But if you're just existing in the world doing your thing, you're just eventually going to run into one. It's going to work way better. You can't force, please be my girlfriend, please be a 100x coin, please. The market is like a girl. If she sees that you're too desperate, she will not do anything with you. Another quote is, extreme prices will come at the time when the news is most emphatic and most widely disseminated. When that point is passed, the question must always be, what next? So for example, Toshi went to like $100 million market cap, and I told everyone, I think it's going to go down, and it went down from $100 million market cap to like 35 or something. And I told everyone, guys, I think it's going to go down like quite a bit. And they were like, why is that? No, it looks so bullish. And I said, it's because Twitter has completely understood the thesis. Everything that I was waiting for, the market understands. I don't want to be holding something that the entire market completely comprehends and understands. I want to hold something that the market doesn't yet understand. And so I said to people like, look, we're still early. I think eventually Coinbase retail is going to come in and they're going to love the thesis. But at least for where we are in the market right now, we've widely and fully disseminated the thesis. And that's why it went down. Everyone in crypto understood this. Everyone out of crypto hasn't understood it yet, but they're too early. They're not in the market yet. Coinbase hasn't got all the users yet. The whole thing hasn't played out yet. And so let's talk about trends to coins analysis. So there's two types of narratives. There's like the overarching trend. So for example, like, you've got like sector specific trends. So like the layer ones or AI is a narrative. You've got the GameFi narrative, right? There's like the trends. And then you've got the coin specific narratives. So for example, we've got the Coinbase adoption. Coinbase is the macro sort of like the trend. It's the fact that Coinbase is going to win this bull run. And then you've got like the base trend. So like the base blockchain is going to get a lot of users. What do you buy? And then you've got the coin within the trend. So the coin within the trend is Toshi, right? Solana versus Ethereum. So, that's a whole narrative. One of the narratives is layer ones. Well, Solana's layer one. And then within this layer one trend is the specific coin of Bonk, the highest beta exposure to the Solana layer one getting adoption. One thing to keep in mind is that with all these sectors, without any real world adoption, how do you value these things? How do you value what a crypto is worth? Well, the value in crypto is derived from what could happen. It's all about what could this thing be worth in the future. And so that's why we talk about this speculative premium term. The speculative premium term is referring to like, how much more is this thing worth than it's probably worth? This thing's probably worth $1, but it's trading at 10. Why is that? Well, there's a speculative premium. People think it's going to be worth 20 when it gets mass adopted. Because there's no real value, it's all just a big speculative premium bubble. We have to base our valuations off of the narrative and the story of what seems possible. So when you buy a coin and everyone thinks it's dead and people are least bullish and the story behind it is really bad, but you can see that there's an underlying future where it could be better, that's the point with which you buy. And the vice versa is when you have a picture in your mind of the narrative and that narrative fully plays out, like the quote says, you need to ask yourself, what's next? Once everything's been digested, what's next? Markets are forward looking. So how do you actually do advanced narrative analysis now that we've covered the fundamentals? It's really, really hard. You can't learn this stuff overnight. I've been doing crypto for 6 years, 3 years full time. I'm still not like an expert at this stuff. It's really hard. There's no amount of video course that I could give you that turn you into a pro, okay? It's going to take years. But over time, you'll gain an understanding for what a good narrative is and what a bad one is. But here's some like general guidelines that you can follow. I guess some general questions that you can ask yourself when analyzing and looking for narratives. When you're buying a coin, let's say you buy it at the beginning of a bull run, the goal is that you sell it at the end of the bull run, right? When you sell, someone else is buying. So you have to ask yourself, who is buying from me if I'm selling? What does that person look like? How smart are they? What do they like? What coins do they usually pick, in this period of the market cycle? Like, let's say you sell it at the end of the bull run. What do people usually like at the end of the bull runs? Well, they usually like meme coins, layer ones, and Ponzi schemes. When you're coming up with a narrative, you got to think about what are they going to like the most? What really appeals to retail? They love meme coins. So maybe you should, buy some meme coins. Another question is this narrative a second or third order consequence? So let's say you come up with a narrative because you saw it on Twitter and it talks about, let's say you bought Toshi at $100 million market cap. You saw that the narrative was fully priced in. Everyone on Twitter was talking about it. That's not a narrative that you want to buy because everyone has priced in, at least at that point, the story. Now, if the story plays out, that's a different story because then it actually is playing out. Or if the narrative goes more advanced, then it's a different story. If you go on Twitter and you see someone talking about a particular narrative, but that narrative is happening right now, then it's not really useful. Like, let's say, for example, someone says this coin has a bright future because it has lots of users. Why is something having a lot of users good for its future? It's not. Having more users coming in the future is a narrative. This thing is going to go from 100 to 10,000 users. That's a narrative. But this thing has a lot of users is not a narrative. That's a played out narrative. If you buy because something has an attribute now, you're buying someone else's once, second, or third order consequence, and they're selling to you. So let's say you buy something because it has a lot of users. Someone sold it to you because they speculated. that it was going to have a lot of users. And then they're getting out when their thesis plays out, and you're getting in when their thesis is played out. You're entering for the same reason, but you're doing it one person wrong, one person right. Another thing is, did you identify this narrative online, or you came up with it yourself? Is it priced in? So if you go on Twitter to come up with your narratives, you have to understand everyone has already seen what that narrative was. It's probably mostly priced in. The best narratives are the ones that you can come up with. It took me like 4 or 5 years to get to a point where I can come up with my own narratives. So if it's your first year in crypto, well, fuck, you got a long journey ahead of you. Best investors come up with their own ideas. And let me show you one. This was from middle of last year. Kobe basically predicted the entire December/January of 2023/2024. He said that he'd be interested in longing Solana. He said that Bitcoin ETF will get approved. He talks about how GBTC has a lot of people who want to sell. The price is going to go down after the ETF gets approved because all the GBTC holders are going to sell because they finally are no longer at a discount. He was saying it's going to be sell the news. The buyers of the ETF are going to be down like 15%. Everything he said 7 months ago played out. He was able to do this because he did advanced narrative analysis. He did second and third order consequences. Because he's just been in crypto so long, he can know which scenario is the most likely to play out. He's able to do this because he's good at what he does. He's been in the market for like a decade. He's seen everything. He's developed that pattern recognition database that we talk about. I bet you this was just a message that he wrote up in like 10, 20 minutes. I bet you he didn't put hours of research into this. This was just his like intuition. This was his hunch. How likely is this narrative to play out or get close to playing out? So let's say you come up with a narrative, but it's super unlikely. It just doesn't make any sense. That's not a good narrative. How likely is Coinbase to win the bull run when Binance and FTX have basically both gone to shit and there's no other decent competitors in the market? How likely is Coinbase to send all its users to Base if they've publicly stated and privately stated in internal and external company documents that that is their plan? How likely is an ETF to get approved when the smartest ETF TradFi people say it has a 90% approval rate? How likely is Toshi to go up if it's the main beta play that has performed well already on its chain? You can see the likelihood of this scenario playing out is incredibly high. Meanwhile, when I bought it at a $2.5 million market cap, the market was pricing in that that scenario was not even a thing, or if people had thought about it, that it was very unlikely. And so when it gets closer to this narrative playing out, the probability in people's minds of this happening is increasing. And when people have more certainty on something happening, they're willing to pay a higher price for an asset. So when I bought it, no one was confident on it. But now everyone's confident on it. A lot of people on Twitter still don't get it, this Toshi play. And that's just one example of how you can do it. Another question is this a narrative that is better suited for another coin? So you might have a narrative which is a great narrative, but you have to ask yourself, like, is the coin that you currently own or want to buy the best way to speculate on this growth? So for example, Coinbase to Base to Toshi. Do I need to buy Toshi, or could I buy something else? Would I buy a DEX on Base? Could I buy a real world asset project on Base? For example, there's a coin on Base called Grand Base. It's a real world asset project. People speculate that real world assets on Base is the only chain that this is going to be good on because it's the only chain that's regulated, because they're going to do KYC on chain for everyone that interacts on the Base blockchain, or at least the ones that want to use these real world asset platforms. And that's what's required for them to be used. And so is this a better coin to own than Toshi? You know, you have to ask yourself, like, what is the best exposure to a certain narrative? Okay, let's say the narrative is AI. What's the best coin exposure to that trend? Is it BitTensor? Is it Gensin? Is it an older or a newer coin? So that's the question you got to ask yourself. And the way that I would decide with this example is when I'm wondering what is the best way to play a narrative, I ask, well, what happened historically? Okay, well, when Ethereum went ballistic, Shiba, I knew a guy that had, if he didn't sell, $400 million of Shiba in his interviews in this course. So I know that Bonk went 100x. I know that when Solana had its first bull run, this meme coin called Samo went like 100x. I know that the meme coins always perform the best, so it just makes sense. And you'd only know to pick that if you've seen that the meme coins perform best. That's pattern recognition right there. Recognizing the pattern of what I've seen before. If you haven't seen that, you're not going to recognize the pattern. You know, a real world asset project like Grand Base looks like it's doing well right now. It could be a good bet, but my main play is Toshi. Something else you're going to notice on Twitter is that as a coin goes up in price, its narrative gets stronger. It's funny, like you go on Twitter and the coin's going up and what people are saying about the coin gets more and more euphoric. All these new stories start popping up about its potential. Like for example, when Blur came out, there was so many fucking crazy stories when it airdropped about how this thing was going to be worth billions of dollars. Like for example, people were saying Blur is the only way to get an indexed exposure to the growth of the NFT industry. It's like an indexed high beta NFT growth play. And then they were saying stuff like, look at OpenSea's valuation valuation. Look at Blur's. This thing should be worth the same value as OpenSea when at its, I guess, crypto valuation. And then they were saying all this other stuff about that was a story. There was so many stories when Blur came out. I don't know if any of you watching this was around. It was like the most talked about coin for a week, and that was the top. And then the coin went down, and then everyone stopped talking about it, and it got to its bottom. And then there was no stories about it anymore. And now Blur's going up again, and there's all these stories coming back. It's funny. And all the stories are saying shit like, well, I think like the Blast airdrop is one component. And I think there's a couple other components. Maybe like the NFT vault, like the bottom is in for NFTs, volumes are going up. You know, there's like a bunch of different narratives coming out now why Blur is going to be big. But what you're going to notice is that as the coin goes up more and more, narratives come out, reasons for it to go up, stories about it. When you buy a coin, you want the least amount of narratives around the coin. And when you sell it, you want the most amount of narratives around the coin, right? You want to counter trade narratives. Now let's go over some of these tweets here. Here's a really good video by Hal. He's a great trader, but this is also relevant for investors, okay?
Crypto is a game of positioning for narratives before they exist. That's the game. In a nutshell, to your point, what is a narrative? You know, that's kind of a very open-ended thing. I mean, what I think it is reason to expect future price appreciation. That is really the actual narrative itself. So for example, the merge was a very strong narrative, and it's in the past now, so we could talk about it objectively. There was a view that once the merge occurred, its tokenomics would drastically change, and that would drive future price appreciation. So in its purest sense, that is the narrative. It's the reason to expect future price appreciation. That really is the narrative. Like, because no one will buy or sell something because they think like there's really good things happening at this very moment, right? You're buying and selling because you are speculating something's going to happen in the future. So you care about the future price appreciation. And so the narrative itself is really that. It's that reason to expect future price appreciation that you look for, or reason to expect future price decline.
So that's basically what we talked about already. Crypto is a game of positioning for narratives before they even exist. Okay, here was a tweet explaining to you how when I bought Toshi at $2.5 million market cap, no one was talking about the narrative that I had come up with, right? And I showed you the video which went over the dot points. Coinbase wins, blah, blah, blah. Now, when it's at a $50-60 million market cap, it's up 20x. All the Twitter accounts are now talking about it, right? Coinbase becoming adopted. What happens when Coinbase breaks all-time high? People will look for betas, such as they did with Sol gigasending, and therefore resorting to the bonk play. What's the original meme coin of Base? The face of Base. It's a cat coin. Now he's added in another component to the narrative. GCR, a very, very good trader, said that there's a cat coin sort of trend coming. So he mentions Coinbase, he mentions that what's the highest beta play? It's Toshi. I already talked about this when it was 20x lower, and these guys catch up late. And this guy's a smart guy, and he's still late. I actually have a friend who was messaging him when Toshi was at a $2 million market cap. My friend sent this guy Toshi, and he said, look, he explained everything that he's saying now. And he was like, look, Coinbase is going to be big. The users are going to go to Base. Cat coins are coming back, blah, blah, blah. And this guy was like, nah, cat coins are not coming back. Cat coins are not going to be a thing. It's stupid. Toshi's going to die. And now, look, he's capitulated 20x higher. And that's why it's important to really understand narratives. When I saw the Toshi narrative, instantly I was like, this is fucking genius. Because I know what a good narrative is. This guy clearly doesn't know until it's too late. So yeah, that's everything for this video. I know it's a bit long, but narratives are a complex topic. And I'll see you in the next one. Cheers. The next thing that you guys need to avoid is something that I've seen a lot of people do this week actually in crypto, and it is one of the dumbest strategies that I've ever seen people try to make money from in crypto. The strategy that I've seen lately is they sell half on a 2x. And to just sum it up in one sentence, why this is a terrible idea. The key to being a profitable investor is to let your winners run and cut your losers. So if you sell half on a double, you've just sold the winner early. And that goes completely against this thesis. Because when you think about it, in crypto, the goal is to make insane returns on a couple investments. It is only like one or two coins which are going to make you most of your wealth. It's the home runs. The goal is to hit the home runs. And I talk about this in the mindset course, the importance of the home run investments in getting rich. You don't get rich from crypto from small compounded gains. You get rich from crypto from one or two decisions, investments that you made, which outperformed everything else. And that's all you need to make a bunch of money from crypto. You only need one coin, one trade, 1 week of trading, because all the money is made from a very small amount of decisions that end up just being swing really in your favor. So if you reduce your position size by 50% on every single investment, whenever a home run does come, which is where you make most of your wealth, you are removing half of the potential gains from that home run. So let's say the home run is a 30x on your money and you sold half at a 2x. You're now never going to capture a 30x. You're only going to maximum catch the same position size equivalent of a 15x. For example, right, I bought Toshi at $2.5 million market cap. It's now at a $19 million market cap. I told everyone in my mastermind, we all bought like 10% of the supply of this. And I said to everyone, like, guys, this is a fucking no-brainer. I gave an entire full video explaining why you should buy, and it's now up almost 10x. So imagine if we had bought here and then we had sold here. We would have missed this entire gain because Toshi is a home run. It's a 100x bet, right? This is probably going to get to 100x. Like, this is at a $20 million market cap. It's probably going to be at a $300 million market cap by the time we get really deep into the bull run. It's going to be 100x. So if I was to have sold half on a 2x, by the time this gets to a $200 million market cap, I'm only making half the money. It's still sort of a home run, but it's a half home run. And the thing is, in crypto, the goal is to make asymmetric returns. You risk a little to make a lot. So if you sell half on a double, you cut in half how big this part of the pie is, and you actually don't even improve this part of the pie because you're still going to make losses. And if the position is a losing position, you're still going to lose because when you think about it, if you sell half on a double, you have to put this money somewhere else because you just took profit. You have to put the profit somewhere else. So what you're going to do is you're going to end up buying another coin. So instead of having 3 coins, you've now got maybe 6 coins. These doubled, you sold half, now you got 6 coins. Now you're going to underperform the market because you have twice the coins to keep up to date with. You're actually just going to get standardized market returns because you're not going to have the attention span to sell this coin at the perfect time because this coin is going to top before this one. And so what ends up happening is that when you have too many coins, you end up selling all of them at the same time. Now, when you do this coin here might have topped a week before at a 3x higher price. But because you got too many coins, you were never able to sell this one at the better time based on, let's say, there was a conference at the top of the bull run, like with Solana. You missed the fact that it was a conference because you were too busy. You didn't have the time to focus on all the coins. Now you end up selling this one after it's down 50% at the same time of all of these ones. So you just get standardized returns. The idea is that you cut 2x on a double, and that's also going to half your risk because now you're writing just profits. But the thing is, you actually don't half the risk. You end up probably taking more risk because you have all these extra coins. And as well as this, in crypto, you're only really going to be able to find 1 to 3 really, really good high conviction bets because you don't have time to research more than like 5-10 coins. So if you end up having a portfolio of 10 different coins, there's a much higher probability that 6 of these coins are actually a really average thesis and they're only going to give you average returns. Whereas if you would have just doubled down on these ones, the 3 that had the better conviction, you would have made more money, had less stress, sold them at a better time, and would have hit a way larger home run. So you can sort of see the reason why selling half on a 2x is stupid. So let me give you some more reasons why it's stupid. Like I said before, winners tend to keep winning. So if you sell a coin up 2x, that's stupid because if a coin went up double, it means it has a high chance of being a winner, right? It went up 2x. In crypto, things tend to go up either 20x or they don't go up at all, or they go up like 50%. Crypto, it's either the thing goes up a fuck ton or it just doesn't really go up. So the goal is that you want to buy the things that go up a ton and then sell the things that don't really go up. So if something's going up 2x, then you have to think to yourself, this thing is probably emerging as a winner if you're able to double your money. If you as an investor are able to double your money, there's something happening with this coin. So you don't want to sell it. Now, it would be like, imagine Usain Bolt is in a race. He's winning as always. You've placed a bet on him to win the race. Now, imagine halfway through the race, he's winning. It looks like he's going to win. You decide to half the bet size. So then when Usain Bolt wins, you make half the money, right? That's basically what you're doing by selling a winner. You can see that the coin's winning. It's going up in value. It's going up more than maybe the other coins around it. But no, you see it's winning. I'm going to cut the position size. No, it's not going to keep winning anymore. Stupid. Doesn't make sense. As well, you get rich from home runs, not small compounded runs. Like I said before, 1 to 2 huge investments is where you make the millions. Or the rest is just playing around until you find the next big winner. If you sell every coin that makes you money after a 2x, you're halving the profit made from the next home run. When you sell half of the home run before it becomes a home run, you're removing a lot of upside just to protect a little bit of downside. Doesn't really make sense because like I said before, the idea is the risk is 1 and the upside is 10. So when you sell half on a double, you remove half of this. So now your upside is only 5. survive, and you still got pretty much a similar downside due to the factors. So imagine you just like crossed off, now you've only got this much. Just doesn't really make sense. You're removing asymmetry from your upside. Selling half on a 2x makes you lazy. So it's funny because this is what people do, right? They go into the casino, they put in $50, they grow it to 100. So what they do is they put the 50 in their pocket, and now they've got $50 for free to have fun with. So even if they leave the casino having made no money with this $50, they didn't lose any money because they kept the original investment. That's what selling half on a 2x does. It creates gambler mentality that you're only playing with house money, because when you view your portfolio as a house money sum, you don't treat it with the same respect that you would if it was real money. And when you don't respect money and when you don't treat it properly, you end up losing it. So you're manifesting losing all your money through the fact that you are lazy, and you're tricking yourself into believing that this money is somehow any different from your other money. You want to avoid doing this because you're going to create gambler mentality. Now, as well as this, selling half on a double, like I said before, it increases the amount of positions you're probably going to end up holding, because you've now got cash, you want to put it somewhere. You're not going to put it back into the thing you just sold, so you're going to find another coin. And yeah, eventually leads to underperformance because you own too many investments. You can't keep up with them all. And there's only so many good bets, so you're probably going to buy something that's shit. And another reason why it sucks is selling half on a double is done to manage risk, right? You think to yourself, if I sell half on a double, I've just managed my risk. But this is not risk management. Risk management is having a thesis around your investment of what you think's going to happen, and then you either sell when the thesis plays out, when it's been validated, or you sell when the thesis is invalidated, so it's not valid anymore, or you sell when maybe the coin could go up, but there's a huge opportunity cost because you found a better investment. That's the 3 times that you would ever cut a position. You were wrong, you were right, you found something better. This is really the only times that you would ever sell an investment. When someone tries to sell half on a 2x, they're thinking that there's 4 times that you sell when it doubles. Smart investor, dumb investor. So what are you going to do instead? You know that it's now stupid to sell half on a double, because if I would have done that with Toshi, I would have missed out on the upside here of this thing going like 10x or maybe even 100x, right? Number 1 trending coin on base. Right? So what do you do instead? Well, you don't want to sell based off of arbitrary processes like selling half on a double, because there's no statistical edge. There's no statistical advantage. The aim is to hit home runs. 1 to 2 positions make 90% of the gains. So you want to maximize for your ability to hit the home run. Let your winners continue to win and cut the loser trades to keep searching for the next winner. Have an actual validation and invalidation for when you sell, because you're supposed to exit when you were right, when you were wrong, or when you found that something's better. Pre-plan who your exit liquidity is and sell to them when they come to buy. So the reason that you sell half on a double is because you don't know when to sell. So if I can give you the answer to know where to sell, then you don't need to use arbitrary things to know where to sell. You can just sell when it's the right time. So how do you know when to sell? Well, I guess another way to look at it is your exit liquidity. When you are looking to sell something at a huge profit, someone is going to be buying it from you and making you tons of money. So you have to figure out who that person is, because if you can't think of the type of person who's going to buy your coin when it's up 10x, then it's probably not going to go up that much. I can give you an exact personality, personal financial situation, country, goals, background of my exit liquidity, and they haven't even probably figured out what crypto is yet. I can tell you all of who my exit liquidity is for Toshi. I know exactly who I'm going to be selling to. My exit liquidity is not currently in crypto. Toshi's up almost 10x, but I'm not selling. Why? Because my exit liquidity has not come into crypto yet. My thesis for Toshi is it's the number 1 coin on the Base blockchain, which is created by Coinbase, and Coinbase is going to be the biggest exchange going into this bull run with all the normies. And when we get into the bull run, all the normies are going to sign up for Coinbase. Coinbase is going to tell them, go to Base. They're all going to go to Base. They're going to go, what do I buy? And Toshi's going to be the face of Base, a meme coin named after Brian Armstrong's cat, named after Satoshi, who is the creator of Bitcoin, the most trending crypto asset because it just got an ETF approved. And it's a meme coin, and all the meme coins are popping off. And you can see that Bonk went 40x. All the people are drawing projections like, if Bonk can go from a $10 million to a $400 million market cap, then why can't Toshi do it? And they're going to forward project all the adoption on Base and how it's the same as Solana. And they're going to have no idea about bear markets and the fact that buying something when it's up 50x is a bad idea. They're going to have no idea. So that is who my exit liquidity is. I'm very, very clear on it. And if you are very clear on your exit liquidity, then you can know exactly when it's time to sell, because exit liquidity is the people you sell to when they buy. And if you know who they're going to be, then you know when it's time to exit when they come into the market. The goal with every single lesson of crypto is you need to stop being lazy in coming up with the strategy. And you need to build strategies not based on luck, or random non-statistically backed data. You have to build systems and processes and habits and all this boring stuff based off of what's actually going to make you money. I've just proven to you that selling half on a double makes no sense because it's not a proper strategy. So what you need to do is you need to build a proper strategy. No arbitrary concepts, get something with a statistical edge, know who your exit liquidity is, have a validation, have an invalidation, have a thesis, let your winners run, cut your losers, aim for home runs. This is how you do crypto properly. That's today's lesson. I'll see you in the next video. Another thing you need to avoid is making emotional decisions. Now, obviously, you know you shouldn't be making emotional decisions, but I still think you should watch this video because even though you know that you shouldn't be making emotional decisions, most of you guys still do. So it's like, maybe you should watch this video anyway because you still haven't fixed the problem. So really important in markets, you don't make emotional decisions. Why is this? Well, emotions, if you listen to them, will have you buying when you're supposed to be selling and selling when you're supposed to be buying. The only way to buy low in the green zone and sell in the red zone is to ignore emotions and listen to logic and to have a process. Because what is an emotion when you think about it? What is fear? What is greed? Well, emotions are instincts. It's an instinctual state of mind. Now, in the course, we've already talked about the difference between intuition and instincts and how if you listen to your instincts, you're listening to your base level programming that you were basically given at birth. You're born and you've got downloaded software on your Apple computer the first day you open it, and then later on you add apps. When you get the laptop, you've got GarageBand, you've got iTunes, you've got Safari, you've got these base foundational apps. With humans, you're born with the ability to feel fear, the ability to feel greed, the ability to feel jealousy, the feeling of wanting to compete and beat others. So emotions are a part of these instincts that you're born with. So when you feel emotions, you're basically having instincts send chemicals through your body to make you feel a certain way. And we already know that in markets, you have to do the opposite of your instincts. Your instincts were useful back in the day, but the instincts are not useful now. There's no role for emotion in investing. The only way that emotions can be useful in your investing is to be able to understand when you need to do the opposite of what you're feeling. So at the bottom, it feels really bad to buy. So if you understand that it's going to feel shit when you buy, you just have to wait for when you feel shit, and that's the time to buy. So you need to do the opposite of your emotions, of your instincts to make money. So if you listen to your emotions, what you're going to end up doing is buying the top, selling the bottom, FOMOing in, panic selling. You're going to be breaking your system/process. You're going to want to just gamble to get rich quick, and you're going to lose all of your money again and again. So how do you avoid making emotional decisions? There's a number of things that you can do which will help mitigate making a decision based on emotion. So number one, if you have a proven process or strategy, let's say you have a system that says you can only buy when I tell you to buy, and you can only sell when I tell you to sell. If you had a system which was able to do that for you, then you wouldn't have to worry about when to buy and sell. You could just listen to a robot which has no emotion. And this is what I pretty much do with my investing. I don't really need to figure out where to buy and sell because I have a robot which has no emotion, which can do it for me. Let me show you this system. This is the Hunter algorithms. When everyone's shitting themselves saying the market's going to zero, my algo is emotionless, telling us to buy at 18K for Bitcoin. If we put this on the ETH chart, you can see that the bottom for ETH, we got like 10 signals at the bottom. Or the exact bottom on Ethereum. You can see it here. When everyone was panic selling the bottom, this thing was giving us 10 buy signals to buy Ethereum. We're now up 2x, and Ethereum has barely gone up. It's only gone up 2x, and we called it 2x. Sold the top, bought the exact bottom again, bought the bottom. Following a system removes you from the investment process, and it removes your emotions from the investment process, and it relies solely on the logic and the rational insights given by data. So this system is the main investing system in my mastermind. If you guys want to join my mastermind, where I give you everything that you would need to make millions of dollars from the bull run, then you should be looking into it. You want a proven process? Well, I have one. And that's how I've removed emotions from my investment process. I don't make decisions without backing it up with data. Another thing you can do, have a community and a mentor who can check your emotions. So let's say you want to make a decision of buying or selling, and you're not sure if it's an emotional or a logical decision. Well, you can just check it. Run it by your mentor, run it by by the community. Hey guys, I want to buy this. It's up a little bit, but I really feel like it's a good time to buy. What should I do? We'll just ask the guys in the community. They'll be able to give you an unbiased opinion. And another little hack is you don't invest more than you could handle emotionally. In investing, there is a sum of capital that you could invest with which you would have zero issues with emotions. Whatever that number is for you, you need to invest a little bit more than that. And then you need to continue to push forward beyond that next level. So maybe you have 5K and that makes you emotional decisions. But let's say you make money and now you've got more money and you get used to the 5K. So 5K is easy now. You got 8K now, 5K is easy. So now you got 8K, you grow that to 20K. As your capital grows, you always want to keep investing a little bit more than what feels easy. Because if you look at how you make the most amount of money, it's you don't do so much that it really hurts and it fucks with your investing, but you need to do a little bit more than what's comfortable because you need to test yourself a little bit. Often the amount of money that you invest with that has zero emotional impact is never an amount of money that would have a substantial impact on your lifestyle. And if you're doing crypto and there's no chance that you'd make money to make your lifestyle better, then what's the point? For me, I could invest with $20,000. I could lose it all and I wouldn't care. I wouldn't have emotions. If my total investment capital was 20K, I would never make enough to have any substantial impact on my lifestyle, and then it's like, what's the point? If it doesn't change anything, then why would I do it? So you always want to have a little bit more in the market, but not too much. So if you guys can't stop making emotional decisions, maybe you're just trying to put too much money into crypto and you just can't handle it. Another thing, make yourself more busy. So one of the reasons I see people making dumb decisions is they got too much time on their hands. When you spend all day looking at charts and the only thing you can do is look at your portfolio go up and down, you're obviously going to really, really care about what the portfolio is doing. Same thing with girls. When you have one girl and you're unemployed and you've got all day just sitting around, fucking around fat, and your girl's going out partying or hanging with friends or whatever, you're going to be more emotional about all of that than if you were to be busy. Let's say you were focused on your career, spending time with friends, making money, improving as a person, and your girl's going to partying or hang out with friends. Maybe the thing that you were going to get worried about doesn't affect you anymore because you're busy, you're living life. It's not going to emotionally impact you as much. So another key to removing the emotions is to just be more busy, do more things, live an exciting life where you don't need to rely on crypto gambling to basically feel something. That's why I love surfing combined with investing, because surfing is addicting and it's more addicting than crypto. If I didn't surf, I would just sit inside all day and do crypto. And if I sat inside all day and do crypto, I'd be looking at charts all day. I'd probably end up watching a crash happen live. I might be inclined to sell because I'm panicking. But if I'm out in the fucking ocean surfing and the price crashes, who gives a fuck? I'm just chilling. I'm in my position. The crash doesn't mean anything. So that's a really good reason why you need to do sports, maybe build businesses, have a full-time job. Looking at charts all day is just going to make you less money. You make the most money by doing nothing. And this is why if you look at the best stock market portfolios, it's the portfolios of dead people. Why do dead people make the most money? It's because they don't fucking do anything. They can't sell. If you delete the sell button and you force someone to handle the volatility, they just end up outperforming everyone, right? That's at least what's happened historically. So it's similar sort of thing in crypto, right? The people who end up making the most money end up doing the least with their portfolio because they're not making emotional decisions. They just bought when they saw a logical, good opportunity, held, and then sold when the opportunity went away. And then boom, done. And last but not least, listen to yourself first, others last. This one is hard for a lot of you guys to do because you're not really worth listening to. You shouldn't listen to yourself. So I guess the answer really here is to become someone worth listening to and then listen to yourself. Because right now, maybe you can't invest and so you have to listen to me. But the goal is that you become good enough at investing that you can make independent decisions. You don't have to go on Twitter and know when to buy based off of when Twitter accounts tell you to buy. You shouldn't have to rely on a Twitter account telling you what coin to buy to know what coin to buy. You should be able to listen to yourself and what you believe is a good investment first, and you can always, run it by other people later. Investing is an internal to external game. You do everything inside of you. You come up with the idea, you come up with the thesis, and then maybe you run it by other people to get feedback. But you don't go on Twitter, look at what people like, and then basically buy because they said to buy. That's external to internal. You looked at what someone else did, and then you copied them. No, you need to look at what you want to do, make your own decisions, internal to external, have your own thesis, have your own plan, and then maybe run it by other people afterwards and then implement it. So don't make emotional decisions. All right, so we're talking today about how markets price value. So this one is a little bit complicated. There's a lot to it, and I'll try to explain it all as easy as I can. To start off, let's start with a story. So in December 2017, I got into crypto, and I bought a coin called Verge. Basically, this project Verge was being talked about everywhere on Twitter. Everyone was really bullish on it, and they had this Wraith protocol coming out like end of December. And I had bought at the end of December, expecting that once this Wraith protocol comes out, it's going to change the game. It's going to make the price go up. But what I didn't realize was that Wraith protocol was a buy the rumor, sell the news play. And so I had bought it here thinking that it's going to change the world once this update came out. And I was wrong. The price ended up going down like 98%. And I learned a very valuable lesson from my first ever crypto investment. And the lesson was markets are forward looking, and you can't just think that the price is showing you is what its actual value is. And you have to be smarter than simply thinking, oh, the news is good, so it must make the price go up. Because people are what you would call forward looking. They make decisions based off of what they think's going to happen. They try to predict what the future has in store in order for them to try to make money from it by anticipating it. You make money in markets by doing today what people are going to recognize tomorrow. And I didn't realize that when I was buying Verge after it had gone up 1000x, literally from 1 Satoshi all the way to like 2000x. But I had actually learnt this lesson, and I managed to recover from the mistake that I had made slightly by selling here. There was another instance where there was a buy the rumor, sell the news event. I pretty much sold Ripple Verge here, and I never looked back. So I had sort of learnt my lesson a little bit, recovering some of my losses. So in this one, I want to talk about how markets price value. And this relates back to market psychology, because your brain is going to tell you that certain things should be worth certain prices at certain times. And that's not a direct reflection of how markets actually work. And that is very much linked to the psychology of how you make decisions and how you interpret things. And you need to rewire that by understanding how markets actually price value. So here is a exemplar number one. This is to show you that the black is the underlying fundamentals and the red is the price. So you can see here that underlying value is going up pretty steady, right? And the red is going crazy. It's going way above it and way below it, right? And this is just to show you that the markets do not fairly price assets, because markets consider a lot more things into deciding the value of something besides what it's currently worth today. So let's go over that. Markets are not a fair reflection of value. Because of our numerous cognitive biases, our tendency to make emotional decisions, and the fact that markets aren't efficient, markets are never a fair reflection of value. So for example, right, cognitive bias. A cognitive bias would be like recency bias. We believe that just because something has been happening recently, that it has to continue to happen. There's a Kun tweet here which explains this really well. The reason reality is different to financial markets is markets project out linear valuations based on recent trend. So they look at what's happened recently, recency bias, and they think that because this has happened recently, it must have to continue to happen in a linear fashion. So for example, humans have a tendency to project out linear valuations based off of recent trends. This is what Kun said. You can see here, for example, someone will look at the bonk chart and they'll go, okay, so price consolidated here and then it pumped. So what's price is going to do it again and then again and again and again. They think that because of recency bias, price was going up a lot recently, it must continue to do that. But what they don't see is all the other times that this bias was applied and it had lost that person money. So you can see here, this is SHIB in the last bull run. It went pump, sideways, and everyone here was probably thinking, oh, sideways and then up again. Nope, it just went straight down without barely any pumps. That's one example of a cognitive bias that humans do. Now, the second thing was making emotional decisions. So the end of the bull run is the most volatile, and it's a period where the price goes up the most. You can see here, the most gains are made at the end of the bull run. This is where price goes up the most. In bull runs, people make emotional decisions. So yeah, the underlying value can be here and price can be here. They don't want to miss the train. They think, okay, maybe the fundamentals will improve in the future. I need to get in today. And then they end up buying the top, right? Making an emotional decision, even though the market is clearly overvalued and you simply just need to wait for it to become undervalued. And markets aren't efficient. So again, forward-looking participants. We look to the future in order to determine what to do today. So let's give another example here. So here's a price chart. Smart investors buy here because they know that there's a big announcement coming in 2 months. They ride it up and then the big announcement comes out. They sell it a week before. 3 to 7 days before the announcement comes out, they sell. And so then the announcement comes out, that's the top and price goes down. That's what smart investors do, because price dropped after the news because it was already priced in by the market. Priced in basically just means the price had already gone up in anticipation of that news coming out. This is like what happened with Verge, right? The smart people bought before me and they sold into me. I literally bought Verge XVG from the people who were smarter than me. It is this inefficiency from the recency bias, emotions, the forward-looking nature of crypto that makes crypto so profitable and markets in general. One of the main reasons prices aren't a reflection of actual value is the market's tendency to look into the future, like we just talked about, forward-lookingness. Markets tend to top the day before the news comes out. Why is that? Because humans are smart. We try and anticipate what will happen in the future to drive today's decisions. In order to profit, must accurately predict what might happen in the future, not what is happening today. Now let's go to this Kun tweet. The best time to sell has been when everyone is doing well in real life, not because reality is bad, but because the market has applied an exponential multiple for it to go on. And best time to buy is when we are in a depression, when a linear down projection is multiplied. People have recency bias. This is what Kun is referring to. They think that because all they've seen is down like this, think it just has to continue to go down forever. But they don't understand that markets do not give a fuck about what recency bias you're applying. The market will do whatever the fundamentals are showing, whatever the market participants are going to do, right? It doesn't care about your bias about what it has to do. This is another sort of graphic to help you understand picking the right time to buy and sell. Markets are zero sum, right? Imagine a closed room with two sides. These people want to buy and these people want to sell, right? So these people have cash, these people have coins. As you can see in this graphic, there's not many people who want to sell. There's a lot of people who have cash and will want to buy. So what period of the market do you think this happens in? I want you guys to think for yourselves here. Well, this is what happens at the bottom, because at the bottom, everyone has shat themselves, they've sold, and there's a bunch of people now waiting in cash. All the red dots have moved over to the green side. Now everyone's in cash, and everyone wants to buy into the future. Because remember, every seller is usually a future buyer, right? If someone sells Bitcoin, they're not selling because they want to get out of crypto forever usually, selling because of a temporary leaving. They want to sell to buy back lower. That's what most people want to do. So when all these people are selling, they're not leaving forever. They're just swapping sides. And eventually, all of these people want to get crypto because they all want to make money. So they're all eventually going to have to come on this side. So if you see any time in the market where everyone has sold and there's no one who wants to sell, and there's a bunch of people with cash who want to buy, that is when the bottom occurs, or that is when you want to be in basically holding a coin. So when everyone is on the green side wanting to buy, you need to have already bought. And when everyone is on the red side, they own coins, then you need to sell. So if you look at this chart, where do you think everyone holds coins? Everyone holds coins here. So this part on the chart would be like a million people who have got coins. Just imagine like this side is just filled people who hold coins. That is what the top of the market looks like. And the bottom is what this looks like right now, like this. Profit in markets by being a buyer when everyone is panicked and sold, holding cash while there is no one left to sell. I also want to go through Kun's thread here. The best time to sell has been when everyone is doing well in real life. That's why being contrarian pays. Not because being contrarian is right, but because consensus at extremes in financial markets causes the market to be at the furthest place away from reality, which then starts swinging back. This swing from one extreme to the other is a smart money game. So in fact, being contrarian is also wrong, as you are sitting at a place that's also far away from reality in the other direction. Since markets move in a way in a pendulum, you benefit inversely. Learning macro is not to invest based on the findings itself. It's to understand where financial markets are relative to macro and what is the consensus pricing out linearly in which direction. That's why contrarian only works at extremes and middle of the trend is your friend. Imagine you're right here. Everyone's bullish. Do you sell? No. What about here? Everyone's bullish. Do you sell? Yes. So sometimes everyone's bullish, you don't sell. Sometimes everyone's bullish, sell. So how do you know the difference? Like Kun says here, you have to analyze things like macro, what the central banks are doing, what stocks are doing, what the whales are doing, what the different data sets in crypto are showing you, so funding data, etc. You want to look at how many coins are being created. Is there a billion different NFTs being made, taking all the money out? You want to look at all of the data, and then you want to look at what people are expecting based off of this data. You need to understand where financial markets are relative to macro, and what is the consensus pricing out linearly in which direction. So let's say you look at the market right now and the macro looks really shit in the next 6 months. Like you expect Federal Reserve to start hiking rates. They've been lowering them, but you expect them to hike them. You can see that inflation's going to pick up and become really rampant. You can see that there's all this bad macro stuff coming, but you also see that the market has no idea about it. The market is super bullish. Everyone's like, wow, price is going to keep going up. No one is really thinking about macro and how it could affect crypto. They all say, crypto is uncorrelated from stocks. We're our own ecosystem. Fuck them, right? People are saying that. And what you're doing is you're looking at the macro, applying it against what the consensus is pricing out. And then that's how you would know that you need to be doing the opposite. But if it's early in a bull trend and everyone's bullish, that's totally normal. In the middle of a bull market, your entire Twitter feed is going to be bullish. And if you try to counter trade that, you're going to be wrong. So you can't, in the middle of a bull market, do the opposite because the trend is your friend. Everyone talks about this in investing. The trend is your friend. It's absolutely absolutely true a portion of the time, but it is definitely not true in the end and the beginning. You can't say the trend is your friend at the end of a bear market. You can't say the trend is your friend at the end of a bull market. You can't say the trend is your friend. The Federal Reserve is about to hike rates 5% from 0%, and they're about to start quantitative tightening, and every single altcoin has gone up like ridiculously. Everyone's bullish. Coinbase is the #1 app on the App Store, blah, blah, all your different data, and then no one else is afraid. That's not when you follow the trend. The trend is your friend is a specific term that you can only apply during the middle of the bull market. So just to summarize, you cannot come to the market and expect the price to be a reflection of anything fair. The price is simply a representation of what humans are thinking, feeling, and seeing and anticipating to happen in the future. And you as an investor need to become smarter than everyone else in the market at predicting what's going to happen. The best investors are able to see a potential future and have that future come correct more times than it doesn't play out. I talk about this Toshi play that I do a lot. I bought Toshi, 2.5 million market cap. It went to like 40. How did I know? I saw a future. I forward looked into the future, and I thought this was a high probability scenario that none of the market was pricing in. I buy, and then the market begins to price it in as the price goes up. In this exemplar, when I looked at Toshi, it had a ton of people who had sold Toshi panicking in the Telegram, and there was not many people who wanted to sell. The remaining people were strong holders, and I saw that not necessarily using macro data, but using my ability to construct narratives, I saw right into the future, and I saw that, okay, the market has not priced in what I see correctly. The market will price this in eventually. I'm going to buy today in anticipation of them pricing it in. So I know this is a bit of a complicated video, this one. I hope I explained everything as well as possible. But yeah, the main takeaway is that markets forward looking. You want to not apply linear expectations to exponential moves, because exponential moves are short-term in nature and they cannot be looked at in a linear fashion. Humans have recency bias, and that tends to affect our judgment on the underlying fair value of things. We tend to chase momentum as well. Things can remain overvalued for longer than you expect. Another saying, the market can remain irrational longer than you can remain solvent. This is the problem with trying to counter trade people in a bull run, because the market does not give a fuck about you thinking that everyone is bullish, because the market can remain irrational longer than you can remain solvent. The market can continue to go into overvalued territory longer than you can hold your short open expecting price to go down. So that's the end of this video. I'll wrap it up here. So we're back with another lesson here. In this one, we're talking about home runs over small wins. If you've done this course correctly, you've been doing it in order, and you're going to really see in this lesson how each lesson compounds onto the next one and how you have to do it in order, because if you watch this video before the rest of the course, I'm going to be referring to past lessons that you're not going to understand the references of. So really important lesson today. This one is in relation to, again, market cycles and the crypto price action. You make most of your money from what we call home runs, or I guess another term for this would be a kingmaker trade, right? This is another expression that people use to basically describe sort of the same thing. So in crypto, you make 80-90% of your money from 1, 2, 3 different positions that occur during a bull run. It's a really weird phenomenon, but it happens for pretty much everyone. You've got 10 coins in your portfolio. It's 1 or 2 of them that go absolutely ballistic that make you most of the money, right? So if you do crypto correctly, 80% of your profit is going to come from just a few high conviction plays, investments, trades, whatever it is in your portfolio. And the reason this happens is because wealth is made through concentration and it's kept through diversification. So when you want to make a lot of money, which is what you come to crypto to do, right? You don't come here for safe returns. You come here to make tons of money. You make it through the process of concentration into some bets which you have a really high conviction on, right? Crypto is a game of looking at all these different investments, looking at what the market's doing, and basically doing nothing for a long period of time until you come across something that triggers your intuition and your interest, and then you determine if it's worth buying, and then you basically go really heavy into it, and it's a home run position, right? The goal is to maximize the amount of home run positions and minimize the positions that aren't home runs, right? And this is what I found with my investing. In the last bull run, my kingmaker trade was Solana. That's where I made most of my money. And my kingmaker trade so far this bull run, we'll see if that happens, is again Solana, but it's also Toshi, right? This was another sort of kingmaker trade, and it's obviously more an investment. It obviously hasn't finished yet. Still early days, still in the position. 2.5 million market cap. It's now at 64 million, so it's above a 20x, right? It's the beginning of a kingmaker trade or a home run. Every other position that I had entered before this was sort of mid position. So I bought Arbitrum for a brief period of time. It was sort of shit. I looked into a coin called Genie. It was a super small shit coin. It was like a Hex competitor. Sort of looked into it. It was sort of shit. And I finally came across something which I was really happy with. So shit position. It's just that gap between the last home run and the next home run. And the home runs, you really have to ride them the whole way for it to be a home run. Just to sort of explain this point better, Crypto Mikey is one of the best investors, traders, whatever you want to call him, because he does a number of different things on Twitter, and he has made a 2500x since he got into crypto. And he says here that as someone who's made this return, I can tell you having sizable fundamental analysis conviction plays in alts from 5 to 100 million market cap entry and sitting on your hands for up to 2 years will far outpace any margin trader I've met in 8 years of navigating these markets. What he's basically trying to say here is that you research the fundamentals of a coin and you build conviction and you basically hold it for 2 years, right? So when you have something that is a home run, it's a home run because it outperforms the market and you're willing to go in with size and you're willing to hold it for a long period of time to let the thesis play out. You can see he mentioned all the components. Size, conviction, length of holding is what builds you the home run position, which gets you the returns that he has already made from crypto. In the last bull run, one of his plays, which he did really well on, it was this coin. Now, RSR, he was accumulating, let's have a look how much he made. He was buying it down here at a, 0.0028 and up here. So I think it was maybe a 30x or something. But anyway, he did really fucking well in this position, really high, multiple percent of the total supply, and then wrote it up and sold it during the bull run. So what he basically did was he did lots of research, built a sizable position, held it for a course of the bull run. You can see here that it went up a lot, it went down a lot, but he still held the position, went up a lot, down a lot, up a lot, down a lot, still held the position, had conviction, let the position play out, and then sold it towards the end of the bull run. Okay. So that's how you, as an investor, which is what I'm teaching you in this course, make it big. Now, obviously you can be margin trading and you will still have the same concept apply. You will make most of your money from a couple trades that just went really well. We're talking about investing in this course. All right. So I got a little thing that I wrote here. Home runs versus small wins. If you speak to the best traders online, they'll tell you they made most of their money from a few huge trades. If you speak to the best investors, most of their money was made from a few huge long-term investments. Regardless of which strategy you follow in crypto, people in crypto made most of their wealth from a few bets. 90% of the wealth from 10% of the plays. This is why chasing asymmetric upside, another part of the course, in crypto is the key to understanding the crypto cycle. Your strategy must account for the fact that 10% of your positions are going to make up 90% of your profit, and thus you need to really nail the home runs that come to you spontaneously and, not very often. Most coins achieve baseline or underperform the benchmark sort of returns. A few coins massively outperform the benchmark. The more coins you own, the further you spread out into the underperforming benchmark, and the more standardized your returns become. Because when you think about it, you have the capacity to maybe identify 4 kingmaker home run trades or investments. So if you try to buy more coins, there's less chance that all of them are the kingmaker. Let's say you have 10 coins and you're only able to find 3 home runs, 3 out of 10, 30% hit rate. If you only focus on 3 to 5 coins, your small win to home run ratio is significantly better. And that's why it's key to really do your research, really refine, a thesis, an investment thesis behind what you own, and it maximizes the chance that you're going to find a home run. This is also why you want to add to your winners and cut your losers. And this is also why traders want to do what's called the big long. The traders talk about the big long because they make most of their money from only a really brief period of time, only a few positions. Why do some investments massively outperform and others don't? Why is crypto a place where we have home runs, where we don't really want to focus too much on the small wins? One of the first reasons is reflexivity. When a coin has reflexivity, basically is a positive feedback loop, which sends it absolutely parabolic. Price goes up, people perceive the thing as better, right? And more people buy. The fundamentals get better, price goes up higher. So some coins end up getting an insanely parabolic positive feedback loop where it's very reflexive, right? Positive feedback loop makes the price go really high. Now, some coins never kick off the positive feedback loop properly. Let's say a coin comes out in crypto which has a new Ponzi-nomic structure that has a reflexivity cycle that the market hasn't seen before. That position is likely going to be a home run because it's reflexive in ways the market has never seen before, right? It's a new trend, it's a new meta. And then this reflexivity kicks in a lot easier. Whereas if you have, let's say, an old coin that has heaps and heaps and heaps of bag holders, it's very hard for a reflexivity cycle to kick in because you've got so many people who are going to sell when the price goes up. 2 different coins. This coin launched, had a bull market, had a bear market, and now it's going sideways. If this coin tries to go up in price, there's people who bought here, who no longer believe in the project, who want to sell. So the sell pressure as it goes up is significantly higher than this coin, because this coin, people bought here, and and every single person is in a profit, except for this guy who still believes in the project because he's only down 5% for a day. So this coin has less sell pressure because everyone here is aiming for here, but people here are just trying to recoup their loss. So the target for this coin is a lot lower than the target for this coin because these people just want to get out when price goes up to 2x because they want to recoup their loss. These people are here for the moon. They're here to get 100x. So it could go up 10x, right? This could be a 10x sort of gap here. It's able to do it because that's what people are aiming for. The reflexive feedback loop, price going up, people coming in because price is going up, fundamentals getting better, price goes higher, right? Kicks in easier on this coin. So reflexivity is one reason why home run positions is what you want to account for, because when something really has its positive feedback loop kick in, it goes fucking ballistic. And also another way to understand home runs is that alt season is sort of like a home run sort of concept. Alts tend to do really, really shit for most of the time. And then for a very brief period of time, a reflexivity sort of cycle kicks in and price goes parabolic. For most of the time, altcoins are sideways or down. So the home run applies to crypto in that sense as well. From a timing perspective, you make 90% of your money in 10% of the time. So that's another way to look at home runs versus small wins. Between alt seasons, your goal is to just lose as little as possible so that you can make a ton of money when the market goes ballistic. All this time here is shit. You want to be not taking excessive risk. And during this period, it's good. The market is going up. It's parabolic. The positive feedback loop is kicked in. Alts are going like this. This is where you make all your money. And this is where the key is capital preservation. When the market is in a bear market, the key is to preserve your capital. If you're holding positions from here and you're losing 80% of your money down here, you didn't preserve your capital. So when the next home run comes, you've got 80% less money to capitalize on it. So during the bad period, you preserve your money, right? The small win period, you just want to not lose. So that when the good times come, you make as much as possible. Now, another reason is mass investment appeal. A way that you can spot a home run is if you're in the bear market and a new coin launches and a small subset of people really love the coin, you can imagine that when the market goes up, when this coin is found by more people, that group of people who love it is going to continue to expand. When a project is small, you can determine how big it's going to become based on how passionate and cult-like that tiny community is. Because if a small sample size of people really love this coin, just wait till a bigger sample size of people find this coin because they're all going to love it. This is why ground floor coin investing is like one of the best ways that you can make money. You want to find a coin between a $5 to $100 million market cap that's really small, new, has a cult-like, really tight-knit community, and ride that thing through the bull run as the bull market brings in tons of people. Because when you think about it, right, if you're trying to make money from a bull market, all these people are coming into the market, how are they going to pick which coin to buy? Well, they're going to pick the coin which already is attracting people in its small subset. If you've got a small room of people, let's say each dot is a person, right, and they all 10 out of 10 love the coin that they have, and then we take this coin into this room and there's 100 people, it's safe to assume that the love that these people have is going to be similar to the love that these people have for the coin. And that's what you want. You want something that has mass appeal. You want something that people love in a small sample size. The key is find a coin between a $5 to $10 million market cap that the people love. You do your fundamental analysis, find the cult coins, so that when the bull run comes, it's a home run play. If there's a coin in a bear market that everyone fucking doesn't want to talk about, no one cares about, you don't want to buy that thing because no one's ever going to care about it, even if there's more people in the market. And this is why coins like XLM go up in a bull market, but they don't go up very much. If we do a comparison of this coin to, let's do it to the total market cap, you can see that this coin is lagging. The market is pumping. Everything's going up. XLM isn't going up. Why? The subset of people in crypto is expanding, and they don't care about this coin. They care about other coins, right? Toshi, they care about Toshi going up 20x from my entry. Another reason why home runs make you most of your money is because there's actually a lack of asymmetric opportunities. So most coins in crypto are not going to perform well. They're just dog shit. They're going to get rug pulled. The founders are going to stop developing. The coin's old, like XLM. Most coins aren't asymmetric. And so sometimes you think you found a good coin, but you actually didn't. And so you only really learn if that coin was good or bad after you've bought it sometimes. So sometimes you buy a coin, it looks good, but then it really performs terribly. And then you find out, okay, well, the team actually was selling tokens the whole time and they were going to rug pull. So I'm going to exit that. And then, you try to minimize the loss of that position. And then you go to the next one. Maybe the next one's shit as well. But in the next one, it's that home run. You really want to go hard on it. A lack of asymmetric opportunities means that the shit ones between each home run, you need to minimize the losses. We talked about this before. And a good way to view home runs is baseball. Look at him. So in baseball, the goal is to avoid getting, knocked out. The goal is to also aim for home runs, right? And imagine in baseball, you hit a home run. Like imagine this guy, he hit a home run and he didn't run. Like imagine he hit the ball and then he didn't run. You hit a home run, you've got to let that position play out. Take it for all it's got. Why would you not run when you're hitting a home run, right? And it's the same thing in crypto. You built a thesis, you found a coin which gives you the ability to make a huge return. You see it's a winner in your portfolio. Imagine selling the winner so that you can go buy something that's a loser. You just did the equivalent of hitting a home run, but then stopping at the first base. It's like, bro, you sold the winning position at a 2x. Now the thing's up 100x. You could have made way more money just holding your winner. Understood the concept of chasing home runs. Another way to look at it is you need to let your home runs play out, because in baseball, right? Imagine 1 in 20 balls you get knocked out, but 1 in 10 you hit a home run. So you're able to give a good score for your team because for every 1 ball you get knocked out on, you hit 2 home runs. So you sort of made up for it. But let's say the 2 home runs that you hit, you didn't run across the base. So instead of for every 1 loss, you had 2 gains, which allows you to win. You had 1 loss and you didn't do anything. You're now not a good baseball player. In crypto, you lose and you gain the same amount, roughly, and then you make the big money from the home run. When you have small wins, you also have small losses. The upside and the downside is the same. But when you have that asymmetric upside, home run position, it's that huge gain that makes up for the sort of shit in between. The key with crypto and succeeding is understanding that a few of your positions, of your theses, of your coins, of your trades are going to make you most of your money. And so when you have a position which is showing that it's potentially a home run, you have to let it ride. You have to let the thesis play out. You have to let the team build. You have to let the position cook. It's like that meme, let him cook, right? Hold up, let him cook. That's literally what you have to do for these coins. You have to say, pause. I know you want to sell because you've made money, but home runs is how you make your money. So I can't sell, right? You have to let the thesis play out. Let them cook. Let the devs cook. So that's how you do crypto. I'll see you in the next video. I've got a long one and a really important one that no one will tell you about. No one will talk about what we're going to talk about today. None of the Twitter accounts, none of the YouTubers, none of the Facebook guys. No influencers will tell you this except for a few. And it's about the topic of the fact that we influencers create liquidity, not alpha. These guys are not going to tell you. I'm going to tell you the industry secrets, how this entire scam that is crypto works, and I'm going to help you avoid the mistakes that even the influencers make. Most of these influencers still don't understand most of the things that I'm telling you in this course. All of these influencers do know, but they do not tell you, is that their job is to create liquidity, not alpha, okay? Outside of a few exceptions, pretty much every crypto Twitter account, crypto YouTube account, their sole basically existence is just buying coins, pumping their bags and selling on you guys, okay? You cannot succeed long-term listening to signals or calls or telling you to buy things from Twitter accounts and YouTube videos. This alpha hierarchy applies too. So at the top of the hierarchy, the first person to make money on something is the original source, researcher, the insider. It's the first person top of the food chain. So for example, a big update is coming out for a coin or a big exchange listing. At the top of the food chain, you're the first guy, you're at the top. Next up, he tells his friends. So this guy buys and then he tells his friends and then they buy in these high-level crypto communities. Next is the paid groups. One of the guys in the high-level community probably runs a paid group, so then he shares the information that he gets to the paid group, and then the paid group end up getting in, and then the influencers all end up telling social media. And if you're following social media, you're buying after the paid groups, after the high-level chats, and then you're buying after the actual original source of information. And generally speaking, if you are buying something because you found it on social media, it got shilled to you on social media, you might make some short-term gains, but in the long term, you're not going to be a profitable investor. So your goal with the alpha hierarchy is to climb as high as possible. So for example, when I got Toshi at a $2.5 million market cap, and I bought it at that price because I had came up with my own thesis, but then I built my own thesis on it. So I was as early as you can get because I was the insider original researcher. I came up with the thesis that everyone understands today. Obviously other people had said components of my thesis. The extent to which I had analyzed this coin, I was the first guy, right? That's why I was so early. That's why the price was so low. I was the first guy to think of it. I told my high-level friends and the mastermind at the same time, and we got in. And then I tweeted it all the time on social media because I wanted to spread the word of Toshi. I wanted to make sure that Toshi was the #1 meme coin on Base. I wanted it to beat Mochi, its competitor. So I tweeted it all the time. And people on Twitter who rely on free information, if they weren't careful, I put a thread out at like this level, you're now at a loss, even though it's up 30x from my entry and the mastermind's entry. If you're not careful, you buy up here. Because if you're not going to join my mastermind, then I'm going to shill you this coin at the top because I want to generate exit liquidity for my mastermind. I want to make sure this coin pumps as hard as possible. I'm not that big of an account that the whole pump was due to me, but I would like to think that the pump went further because I was spreading the thesis, I was spreading what I believed was the truth for Toshi, which helped the price go up. And people talk, everyone was talking about me, everyone was talking about Toshi. I had all these guys messaging me like, bro, like everyone's talking about Toshi now. Yeah, no shit, I've been telling people and people are now understanding. And this relates back to influencers create liquidity, not alpha. When I tweet about it at the end of the cycle after I've bought, my mastermind's bought, my friends have bought, you're getting in maybe making some money, but you're getting in at the end when the scraps are there. You need someone to buy after you to profit. That's why this guy wins, because he's the earliest. If you bought because a tweet or a YouTube vid, you're likely too late or buying near the end. And I want to show you an example of this, and a coordinated shill by Twitter influencers on a coin to sort of showcase what I mean. He basically said, we, as in like a bunch of Twitter influencers, are bidding this coin, right? Track. And sitting at 40 million market cap, he gave me the thesis. He basically said that coordinated shill soon. So he basically said all his friends on Twitter are all going to start tweeting about this coin soon. Now, here's one of the accounts tweeting about it, right? So now the tweets start coming in. I sent this tweet to this guy, and this guy, a part of your shill network, seen a bunch of tweets about Track today. And he said, yeah, friend of mine. Told you, Zuma Oracle also posting. Yeah, coordinated shill. It's good seeing behind the veil. He told me about Track here, and he said, we're buying it. You can see it's pumping because obviously they're trying to accumulate a position. And then they all start tweeting about it. My friend didn't, and you can see it's just pumped. Now, they started tweeting about it right here. So right at this point, you can see the date, November 16. This is November 15, so it was actually here. You can see that it was at that local top. Now, obviously, price has gone up after because they've kept shilling it, and the ordinal narrative is taken off. You can see that there's a hierarchy here. The original person who built the thesis bought here. The small chat groups bought here. The paid groups bought here. And then the Twitter guys got in up here, right? So you can see the hierarchy. The amount of money you make will vary based on how early you are in finding that coin. And if you're just going to rely on free content online, you're getting the worst entry, you make the least amount of profit. You come to crypto to make tons of money. Why don't you try to level up in the hierarchy? Why do you just exist at the bottom of the totem pole getting shat on by everyone else? And of course, you can see it was at the bottom 2.5 and it went up to $6 right now. You doubled your money. But if you were higher on the hierarchy, you bought it at 50 cents and it's now $5, you're up 10x. The difference between the hierarchy here was doubling your money or 10xing your money. So you either turned 1,000 into 2,000 or 1,000 into 10,000. And that's why it's so important to climb the hierarchy, because if you don't, you're just going to be entering near the end. It's sort of like insider trading. Now, he did give a good thesis and maybe this coin does perform well, but what this guy will never tell you is, oh, I actually bought this at a way lower price and I'm going to probably dump it on you whenever I feel like it. And I'm not going to tell you when I sell, so you have to determine when to sell yourself. The lesson here is, this is an example of where listening to a Twitter influencer did make you money. If you bought after he said buy, you actually are in a profit. But in terms of the hierarchy, you are still at the bottom. You made the least amount of money. And for every time you copy a Twitter post and make profit, there's actually 10 times you copy and lose money. The most common outcome is you copy and you lose money. I was copying people on Twitter for my first 3 years in the game, and I never really made money copying people. Only the insider information, or sometimes I copied and I made money, but a lot of the time I'd copy and I lost money. For example, Alex Kruger was talking about this coin DexTF like years ago, and I researched it, I built a thesis, but I bought it because he really liked it, and then it just went down 99%. And I was like, fuck, this guy probably got the pre-sale, he's probably up 100x. I'm buying it now. I didn't realize. He was saying how good it was, but just because he thinks it's good doesn't mean that I should buy now. He's probably entered from way lower. The biggest issue as well with copying people is this. Number one, they won't tell you where they exit, which is the most important part to making money, right? They tell you where to buy, but that doesn't matter. It's about selling, right? The coins they have the most conviction on will perform the worst. So by the time you see them really confident on something on Twitter, it's likely that it's reaching the peak of its cycle. The coins that everyone is super confident on Twitter are the coins that perform the worst. And I think I talk about this earlier in the course, how you can't just copy people from Twitter. And there's always that flavor of the month coin. One month it was Unibot, it was pumping, and then people forget about it. Next month it's something else, and then it's something else. And coins have a short shelf life life of outperformance. Each coin has about 30 to 60 days where it can outperform the market, but then it ends up just going back to standard performance. And you have 30 to 60 days, it's like a ticking time bomb. And then everyone's bought and you've ran out of buyers. Casper's been pumping the whole bull run and the whole bear market. That's an exception, but most coins, you know, let's look at Unibot. This coin in June, super hot, all the way till August, so 2 months. It went from $10 to $200, 20x. And now it's dead. And everyone was shilling you this coin, telling you how great it was up here. So you lost money. Coins have a short shelf life of outperformance. Most bull posts are clout farming after a coin has gone up, where they aren't saying buy now, but they express a massively bullish tone on the coin. I know this one firsthand, and you guys won't know this. When people tweet about coins, they tweet about it because they want to collect clout. They want to get a lot of engagement. They want to show people that they make money. They want to, you know, get validation from other people. I'm no perfect person. I've done this as well. I do this all the time, actually. Every time I have a win, I flex it because I am in the business of building a personal brand and having people pay me money to join my group so I can help them make money. My incentive alignment is to flex on you when I make money so that you feel like shit because you didn't make as much money as me and my members, so that you become a member and pay me money so I can make you rich, so that you bring your friends on and it's just this big fucking we all get rich together kumbaya. It's the same for these guys. Crypto Hass, he's probably got a paid group. This guy bought this coin when it was like much lower. I'm not saying that this guy's a bad investor. He is bull tweeting about a coin when it's at its all-time high after it's gone up 20x, and people are going to listen to him and because he said it's one of the sexiest charts in the entire crypto market. Well, it's funny, one of the sexiest charts went down 30% after he tweeted about it. Isn't that funny? And this guy, you only need one play to make it in life. These guys have made lots of money because they bought it much lower, and they are flexing on you on Twitter with high conviction tweets because conviction increases as the price goes up. If you're long-term investing, you can never buy a coin when it's being bull tweeted like this because you are buying during greed, right? And remember what we talked about in one of the other videos? If you're a long-term investor, you have to buy during fear and sell during greed, right? Like this. This box, if this is the cycle of bottom to top, all the shills, most of the shills get sent here during the top region. So maybe the shill gets sent here and you make money for 2 weeks. The ultimate sort of end situation is the coin goes down 80% or something and then you lose money. If you enter your long-term positions during a period of greed, when everyone has high conviction on the coin on Twitter, you will ultimately need to experience a loss because the market will inevitably fluctuate back to that period of greed. And if you're buying altcoins, they tend to move up and down 60 to 80% before going on to new all-time highs. Or they just end up dying after that first bull market cycle. Things like Uniswap, for example, pumped for a little bit and then it died for the rest of the market. This guy, he talked about OXO, right? Let's look at the OXO chart here. He talked about it at the exact top on the 14th of December, right here. Now it's down 30%. This could be the top for multiple months. We could see this coin go down like this, right? And he will say, oh, but I bought it here. It's a long-term hold and it's going to go like this. People are going to think, oh, he's got a lot of conviction. I'm going to buy it here because he's really confident on it. And he said that it's the best chart in crypto and you only need one coin to make it. But look, they bought during greed. And so like we said, it's like this. You have to buy during this period. Well, you know what? This is buying during greed. It has to go through fear, probably going to come down to here and then it's going to pump, okay? Using me as a case study, right? I'm not perfect. I'm definitely not posting on Twitter to try and all make you all money. My mastermind comes first. And if you follow my Twitter account, you're just more my exit liquidity. You don't want to be my exit liquidity? Cool, join my group. We'll print money together. I'm in Toshi since 2.5 million market cap. I put this thread out, which basically explained why this thing's going to go to $1 billion market cap. I put Toshi to 1 billion in my Twitter name, and you can see I put the tweet out here. It went up a little bit because people obviously bought, but now it's actually below the entry. And I think Toshi's probably going to go down 80%. It's had its 30, 60 days of flavor of the month, and I just don't think the trend can sustain. So I think it's probably going to go to a $20, $30 million market cap. It's currently at like a 55, peaked at 100, probably an 80% retracement from the high. Even me, I'm cloud farming at the top. Look at all the engagement I got. 300 likes, 50K views. You know, all these people want to join my mastermind now. I have an incentive alignment to shill shit after it's gone up. This is how crypto works. This is not just me. This is every single influencer and person you follow in the entire crypto space, maybe except a few. Like I said, influencers create liquidity. They want to create attention. They do not care about as much giving you alpha. Now, I did tweet about Toshi at the bottom. I put out a video saying this is the next 100x coin, and I told you all to buy. But the thing is, a lot of people are dumb and they don't listen, and they end up buying here instead of when I tell you to buy. Because they go, oh, Daniel, I didn't buy it at 2.5 million. I'm sorry, I should have listened. Can I buy now? And then I'm tweeting bullish about it. So they go, okay, I'm going to buy now, Daniel. Please make me money. It's going to $1 billion. You put to 1 B in your bio, so it must be going to $1 billion right now. Absolute idiots. So that's sort of how the game works. This is how the crypto game works. And let's bring this back to YouTube as well, because it's also YouTube, it's Facebook, it's every fucking platform. Most of these like top 100x coin video or like a post about a coin, they're all paid shills or they're posts to pump their own bags, because the goal of every single social media account in the crypto niche is to take your money somehow. Why is this? Well, none of us watching this video can make money. We don't make money. None of us have ever made money. We never will. You're going to die without making a single dollar. Because we don't make money, only the central banks, only the governments make money because they can print it out of thin air. But us, we have to take money. This is an Andrew Tate quote. It's so true. We're like fighting for scraps in an arena from each other. So because we can't make money and we can only take it from others, every single influencer makes money by taking it from you. So they either do paid shills where they get paid for you to buy shit coins that lose you money, or they make money from you gambling on exchanges, losing all your money, or they make money from launching a paid group. So they, you pay them money and then they try to make you money, which is fine if it's a good group. Or they make money from YouTube ad revenue, which is fine. It's just the promotion of goods and services. Or they do what's even worse is they promote their own coins and NFTs, which is making them rich directly, because it doesn't matter what price the coin gets to. They made money because the pre-sale or whatever the fuck it was, right? Each of the above is how influencers make money through posting content online. They don't do it for your benefit. They do it to take your money. Obviously, there is a component of enjoying helping you, but the goal is they make money from helping you. That's how most of them do it. Why else would they tweet? Because they get some sort of benefit. Now, obviously, there's some accounts like Kun who just tweet and they just help people and they're actually genuinely amazing humans and they make millions without ever charging you a single cent. But these people are far and few between. I am talking about the 98% of people online. And actually, just to let you know, just because someone does it to take your money doesn't mean they're not helpful people. Doesn't mean they can't make you money. There is ethical options of ways that they make money from you. YouTube ad revenue, totally fine. Exchange referral links. Okay, you have to use exchanges, right? Binance. It's not that bad. They use the link. And paid groups. If it's a good paid group, you join and you learn a lot. You know exactly when they buy, exactly when they sell. You're entering with your favorite influencer, not against them. It sets you up for success if you're in the right groups. Most groups are shit, but if you're in a good one, it's actually a genuinely good business. You pay them money, and so now they have an incentive to make you rich, because if they make you rich, they can leverage you as a case study, and you also refer your friends, which makes them more money. If a paid group leader can't make you rich, the business dies. So they have to make you incredibly wealthy, or they just don't make money from the group. So you can see here that the incentive is aligned to make the best outcome for you. The incentives with promoting coins, they make money by you buying the coin, not from you making money from the coin. So once you bought the coin, they don't give a fuck what happens. They just care that they've made money. Paid groups are like you and them against the world. Coins is like you versus them. So it's a direct competition. 2 years ago, I did some short-term work for a crypto project. Now, this is when I was early in the game. I wasn't a super pro. And basically, my job was to do the marketing for a new crypto project. You need to get a bunch of what's called KOLs. A KOL is a key opinion leader. These people get paid to promote your coin, right? So what happens is you add all the KOLs into a group chat. You tell them about your coin. You sell them on getting them to work with you. You pay them enough money and then they promote your coin. Most of them don't say, hey, I was paid to promote this. They just take the free tokens and then do a video about your coin. So for example, this guy, Moon Carl, he was added into the KOL group and he actually wanted to become a KOL of our project. And we were like, hold up, all these other KOLs have like 2,000 fucking followers, 10,000 followers, they're shit. Why is this huge dude wanting to promote our project? And the truth is, this guy promotes fucking everything. You go to his YouTube channel, this guy has like top 10 coins every fucking week. Top 5 altcoins. What else has he got? Let's find another one. Now he's promoting some stupid trading algo. We've got any more here? He did it more in the bull run when the things were pumping because nothing's going up right now. Castor, that's a coin, so it's a coin shill. Day trading, now he's promoting day trading. Now he's promoting scalping. Top 3 altcoins. Now he's promoting, what else has he got? Trading algo, a new trading bot thing. What else we got? So this is when altcoins were dead, so not many people were interested in them. So when the market's dead, you have to end up promoting other shit, like trading strategies. So you can see that he's done one here, top 5 gaming coins. He did 2 in a row. Market's starting to hit up. There we go, another one. So you can see that basically this guy just joins all the fucking KOL groups and tries to get allocation to all of them and then just promotes them all. And he doesn't tell you that he promotes them. He just shills them without caring about you. And another problem is these guys don't actually properly analyze these projects. They'll tell you it's a great coin, and the reasons they'll give you it's a great coin are really terrible. In this course, this stage of filming this video, this is the sections on the fundamental side. We talk about all the different really important components to doing fundamental analysis on a coin. These guys in this video will not mention a single one of these. They will use some other dumb shit, and they talk about it here, I'm pretty sure, right? They're talking about this medieval empires game. So he's talking about graphics and he's talking about the gameplay. Let me make it clear why this is not important variables. Crypto is a scam, and a game needing a token is a fucking scam. This whole thing is a scam, and they don't recognize this. They don't tell you it's a scam. They tell you the graphics are really important. Wow, they're going to release some really good graphics soon. Graphics is the most easy to, for most people, aspect of games possible. So many games in crypto for years now have shown amazing graphics, and none of them are fucking used, or none of them have come out with a game. Anyone is able to use these game creating softwares and make a really immersive, cool looking game, but that's not what's important. The graphics are the easy part. The hard part is creating the in-game mechanisms. It's creating the storyline. It's making the game different from its competitors. It's actually bringing people to use the game, right? How do you bring people to use a game when everyone has access to the same baseline game templates and anyone can spin up some fucking high graphics game out of nowhere? That's not the important part, and these guys have no fucking idea. And that's the problem. They get paid to shill these coins. Maybe not this one because it's a bigger market cap, but at least a few of the coins in here they're paid to shill, and they try to find any reason why this coin's good. They didn't even do fundamental analysis on the coin. They just looked at it. Oh, yep, this looks all right. I can shill this. The graphics look cool. All right, guys, so you're watching this video, top 10 coins. So this coin, Sidus or whatever the fuck, the graphics are going to be great, so I think it's going to be a good coin. Doesn't make any sense. I don't have time, but I could show you all the other things they're saying.
Absolutely flying. It's made a return. It's done 10x in the space of 2 weeks.
Okay, here's another example. They're telling you that the best coins to buy before the next bull run, but it's up 10x. Why would you want to buy something that's up 10x? And also, the bull run's already started. Why would you buy it before the next bull run? The bull run started. So this guy doesn't even know the bull run started. They're shilling coins after they've gone up 10x. You should be buying this shit before it goes up 10x, not now.
Estimated on my Telegram channel months ago. And the reason why it came back is because they were about to release their game. Now, you might not know in this call, but Decimated, and I think it was 2018, so before the gaming hype was even a thing, Estimated was building, and they actually got the award for one of the most hyped games in 2019. And the only reason why it didn't launch last cycle was because they got done over by an exchange. I think they got, I'm not going to say which one, but some exchange are holding their private sale allocation. So they've done a new raise, people have backed them, and Decimated came out from, to be honest, the price was Decimated. It was funny, the name's Decimated and the price was Decimated, so it's crazy. But if you look at the difference and look at how fast this thing can just spike, it's crazy. So the reason why I've chosen Decimated is because, again,
Here, this is the reason.
$30 million market cap, a lot more than things like medieval empires. So if you're new to the block and you're thinking, okay, which one should I rather support? I'd rather look at, obviously, medieval empires, just go for gains are a lot better. If you're somebody that's looking to, run through a few different altcoins and spread bets.
Spread your bets. Oh my God. Remember, we talked about the video about why diversification is a myth? And this guy is telling you that you have to spread your bets? Well, yeah, buy just like 10 coins and spread your bets. Bro, you're a fucking moron. And also, he just gave you the reason why he bought this coin. He said, because the market cap is low. They won an award, they did a raise, it's up 10x instead of high market cap or low market cap, whatever he said. And then he moved on. That's all he said. So you need to understand that these influencers make money from you by just shilling shit, right? Without any fucking understanding of what they're talking about. They didn't talk about the flows. They didn't talk about the tokenomics. They didn't talk anything about what the token is or what it does. They didn't do any narrative analysis. They didn't talk about any pattern recognition they've seen from other coins they've made money on. They didn't talk about the second and third order consequences. They didn't talk about the team. They said the team won an award. That's all they said. They didn't talk about the community behind the coin. They didn't talk about how much mind share it has in the gaming community. They didn't talk about whether the perception of the coin is different from its reality, as in a market inefficiency. It's not a 0-to-1 primitive. They didn't mention it. There's no outlier price action. It's just moving as the rest of the coins. The initial distribution, they didn't talk about that it was a fair launch or anything. The age of the project, they didn't talk about if it's an old coin or a new coin. They literally didn't tell you anything. The goal of building an audience online is to take your money and get validation from others. And if you're going to consider listening to someone's calls on Twitter or YouTube, whatever it is, you have to consider, are they offering a good entry or are they just clout farming? So for example, we talked about this before. Me and Johnny, up 25x on our respective coins. We're not looking to tell you a good entry. We're looking to flex on you because we get followers. See how much engagement this post got? Because everyone's searching the Toshi hashtag. My goal was to basically rank at the top of the Toshi hashtag. So when people go, who was the first guy to talk about Toshi? They'd find out it was me. So I get followers and I make money. Are you entering with them or did they enter from much, much lower? Are you entering with them or did they enter before you? So for example, me and Crypto God, because we're both gods at crypto, I mean, he's probably better than me to be honest, but both of us, he's way better at altcoin. We all entered these coins way fucking lower, 20, 30, 40, 50, 100x lower. So you're not entering with them. Kun, it's not just this, it's all CT right now. Influencers buy in early and they shill for the masses to get in, saying it's the future of finance, and then they sell as a trade. Flavor of the month, AVAX. So when you buy a coin that a Twitter guy says is the best coin for the bull run, the Twitter guy takes profit because he knows he has to take profit. You hold it because it's the next big thing of the bull run. You buy during greed, you end up losing money. Most coins get shilled here and you FOMO buy. The green is the value of crypto and the red is the price. So you can see that it goes from under and, being over or undervalued. Most of the shills happen here during the overvaluation period. You only make money in crypto by doing a momentum or swing trade here, taking profits quick, or by being a long-term investor, buying during fear and selling during greed. Be very wary of people who just shill their bag that they bought 20x's ago, but they aren't buying more on dips. They purely want speculation to drive prices higher. This is what I do. You should be wary of me. You should be terrified when I start bull tweeting about Toshi, because I guarantee you I ain't buying more of this coin until it drops 80%. And I guarantee you when I take profits, I'm not telling you on fucking Twitter, I'm telling my mastermind guys so that we can get as much people sold at as high of a price as possible, because this shit is illiquid. Now, the next question is this a non-disclosed paid shill? So for example, these ones, they don't tell you when they do a paid shill. They just shill shit and they're just, oh, okay, this guy must be, he must have thought it was a good coin. He definitely wasn't paid to do it. Is this an insider coordinated pump and dump? Remember, I showed you before an example of an insider coordinated pump and dump. These guys with track. Now, obviously it hasn't really dumped yet. It's just pumped, but you get the idea, right? Is everyone bullish on this coin on social media? When everyone's talking about a coin, it's getting late in that cycle of greed, and it's going to go back to fear and you're going to lose money, right? And this is another point here. Messy original bags were MTA, Hedgick, Badger, Rook, 88 MPH. They all pumped hard when he shilled them, then they died a month after. Remember the 30, 60 day sort of expiry date. I think this happens because he can shill and turn a micro cap into a mid cap, but then no more buyers. Remember this when you just follow anyone in. So for example, most coins, when they're really small, they grow from like a 3 million market cap to like $100, $200 million market cap. Most of the coins that are shilled to this level end up dying because it was the influencers on Twitter who grew it to that level. They use their audience to pump their bags, and it sort of kicks off a positive feedback loop, sort of like Toshi. And in order for that coin to get to the next level, you need more money to come in. And most of these coins never get that money. If you long-term invest a Twitter shill coin, which is fine, you can long-term invest into shills on Twitter. A lot of the coins do perform well, like Toshi, for example. You must wait to buy fear. The summary here isn't don't buy coins people talk about on Twitter. It's you have to buy the coins they talk about on Twitter after you've built your own thesis and during fear. You have to buy it during fear. Shills become most rampant in the final part of a coin's rally as they get validation they were right from making money. You long-term invest and buy during the beginning of the end, buying here, without realizing that you can only succeed long-term buying fear and selling greed. Influencers are here to take your money. They're here to sell you a paid group, a referral link, do an inside non-disclosed shill. They're here to build a brand, get validation from you, flex on you. They're not here to just be some saint. There's always something they get from you. Some people get things from you that don't help you. Some people get things from you that can help you. So you need to make sure that when you're entering, you're buying during fear, you're building your own thesis, the incentives are aligned if you're listening to someone else, and you're trying to invest alongside your favorite investors, not against them, okay? However you want to do that, whether you join their mastermind like mine. Thanks for watching. See you in the next one.
Now we're talking about the house money effect.
It's a big problem most people have at the end of the bull run. They gamble all their money away. If you do your bull run right, using the stuff that I talk about in this course, then you're going to have a wallet that looks sort of like this, right? Obviously, you're not going to have 69 million. You're going to have a lot of money, and it's going to feel like looking at this, right? It's going to feel like you have 69 million based off of just, holy fuck, look at the number that I see on my wallet. You're going to have MetaMask or whatever it is, and you're going to see all this money, right? Oh my God, I'm finally rich. I'm not a peasant anymore. Like, you're going to see that. So let's talk about why this is going to fuck with you. So it's all about this concept of the house money effect. 95% of investors make insane gains during the bull run, but they all pretty much lose it all. And only like 5% or less actually keep the big profits that they made. So why is this? It's a number of things, but a big component of this is the house money effect. Profits are much easier to gamble with than initial money, because if you lose profit, you didn't actually lose anything. If you're in the casino, right, you put $100 in, you turn it into $1,000. your perception around this money is, oh my God, I have $900 that I can spend and lose. Because we don't like losing money, but if we quickly made money, then we're never really losing it because we still have the initial amount of money that we put in. That mentality, every human has it, and it's called the house money effect. And here's an actual definition of it. The house money effect is a theory used to explain the tendency of investors to take on greater risk when reinvesting profits earned through investing than they would investing their savings or wages. Because when you think about it, right, when you put $1,000 into the casino, where did that money come from? Well, you had your trash, shitty ass 9-to-5 job that you hate because you're a little slave, or you've got money that you saved up, all these little pennies from all the slave work that you did. The work required to get that money together was significant. You had to be a slave, right? You had to get whipped on your ass, turn up 9 a.m., do shit you don't want to do, listen to a boss that shits on you, gives you all this work, and they pay you fucking scraps. So when you put that money in, it's like, wow, like if I lose this, oh my God, this took me a lot to make. But when you go into the casino and you put $1,000 in and you sit there with a martini next to your girl and you basically press a button and now you've got $9,000 extra dollars, it fucks with your perception of money because $1,000 you put in took a lot to make, but the $9,000 you made took nothing. And money that was easy to make, that was fast to make, that didn't require effort or skill is quickly handed back to who it belongs to because you cannot appreciate that money and understand it for what it's worth because you didn't really do anything to make it. And this happens in crypto, right? The casino metaphor is very much like crypto. People at the end of the bull run make all this money and then they go and gamble it on fucking shit coins, right? Let's look at like Doge and stuff. Everyone ends up like making all this money during the bull run on Bitcoin, Ethereum, whatever, the coins go up. And then they've got all this profit and they end up just gambling it away because of the house money effect. They didn't really do anything to make the money. They just bought Bitcoin at like 5K, rode it up to 50K, didn't really do anything. So then they go and all have fun in the shitcoin casino. And this is why altcoins tend to rally after Bitcoin, because after Bitcoin's gone up, there's this huge wealth effect, right? Like house money effect. Bitcoin is the biggest asset. So when it goes up 2x, that's more important than a shitcoin going up 2x because the market cap growth is humongous. It's bigger than any individual coin goes up. So let's say Bitcoin goes from a $400 to an $800 billion market cap. That's $400 billion in wealth that represents the house money effect. Altcoins start rallying. All these people who hold Bitcoin want to continue to grow their money because they didn't really do anything and they've made fast, quick, easy money. They put it in the shit coins and they end up losing it all. So that's what, you want to avoid here with the house money effect, because this is what you guys look like at the top of the bull run. I hit the jackpot. Look at me. Woo! And this is you at the bottom of the bear market, still holding the same sign, except now you've flipped it around and you've said, I used to be your neighbor. I used to have a big villa and I lost it all because I'm a retard, right? This is what happens. And when I say you guys, I don't mean any particular person watching. I just mean like people in general. So they make all this money, house money effect. They no longer appreciate or value the money for what it's worth. They lose it all. Fast money made easily is always lost fast and easily. Why does this happen? Well, the reason most people make riches and lose them is they lose perspective of how much money they actually have. So dudes will have $1 million, which is like 20 years of their salary, and they gamble it away without any problem. They'll lose $1 million and they might not even feel it because it's house money effect. They made $1 million doing nothing. So it's like, oh, it's only, I didn't do anything. So if I lose it, I don't really lose anything. People don't necessarily hate the feeling of losing money. They hate the feeling of losing the time and effort that went into making the money. So if you lose $1 million and you had to work 50 years to make it, that's 50 years of effort disappeared, like gone, poof, down the drain, 50 years of your life. You spend like 30% of your awake hours working. So it's like 30% of your life gone. That's why people have their mortgage and they retire and they got like 2 mil in a house. They're so risk averse. Even though they're technically multi-millionaires, it's because it took them an entire lifetime to make that money. But when you make $1 million in crypto doing literally nothing, it was so easy to make that money. There was no time requirement to make it. If you lose $1 million, but you don't lose any time, it didn't take long. So your brain goes, oh, well, I can just do what I did again and make another $1 million because it only took me 10 hours. That's the wrong way to look at it, and we're going to get into how to fix that mindset later on. People lose sense of money's true worth. They made the money quick, easily, and without work, and when you make things quick, easy, without work, you tend to lose it quickly, easily, and without doing anything. This is why fast cash is a bad idea. This is why trying to get rich only from crypto is a bad idea, because most people didn't actually really do anything to make the money, and if it didn't require skill, effort, or time, you tend to just fucking waste it away because you didn't do anything. How do you avoid this house money effect problem and keep the profits so that you don't end up like like this dude here. So what you should do is with your portfolio, when you make all this money in the bull run and you got $69,669,669 in your bank account, you should calculate the amount of man hours that you would actually need to work to get a portfolio number of that size. So if you have $1 million and your hourly rate is $20 an hour, which probably most of you guys, it's probably around that, $20, $30, $40, then you have to calculate out how many hours you would have to work divided by, let's say 30. That's 33,000 hours. So how many hours? 33,000 divided by 365. That's like 5-10 years of work just to make the $1 million, right? And that's what you guys are aiming for. You're aiming to make your first million. If you get to $1 million and you make 30 an hour, it would take you 5 to 10 years of work at your current hourly rate in order for you to even get to that amount of money that you've just made in crypto. So if you calculate out the man hours required, it's going to help you, or woman hours, equality. You can see that, holy fuck, this is actually a lot of money. This post here is really good. It sort of covers this point. So I'm going to reveal to you my biggest mistake during the 2017 bull run. Way more than listening to shillfluencers. Way more than allocating all my net worth into shitcoins. And yes, even more than not recognizing top signals. The biggest mistake I made, but the one that truly fulfilled my growth, was losing touch with reality. What does it mean? Were you in some sort of mental Woodstock festival? Yes, in a sense. When the market goes parabolic and each refresh of your portfolio leads to a new all-time high, you start losing the perception of money. Portfolio to new highs means yourself high. This means that your brain perceives $1,000 as $10, $10,000 as $100, $100,000 as $1,000, and so on. So you start moving that money and popping into new shiny coins, underestimating the risk until the entire castle collapses. And no, there's no Mario to save Peach from Bowser's castle. So it is just greed, zero. His name's zero. No. The key aspect here is not being able to give value to money. $1,000 is the average salary for an employee who works 8 to 9 hours a day. $10,000 an entire year's salary for majority of the population. $100,000, 10 years of most people in the world's annual salary. So what you're risking to leave on the big table isn't a potential fancy Lambo or a new iPhone to flex. What you're risking to leave on the table is a huge amount of time. Time that doesn't come back if you fuck up. Time that another person would kill to have. Once the market skyrockets to new highs, learn to give value to your portfolio. Instead of watching it in US dollar terms, watch it in time terms. I'm sure you'll have the correct choice along this bullish stairway to heaven. And that's what we're sort of having right now in the market. If you look at, let's do Solana, right? I've really started to notice this. I check it every day, my portfolio, like just once a day. And it just keeps going only up with, small retracements, but only small and only temporary. And it's basically just only up. It's just like, and it fucks with you because you get used to it and you just think it's going to keep happening. And because it was so quick, you just don't value the money. If you're not careful, you're going to increase the amount of risk that you take as your portfolio is increasing. This is what most people do. As the bull run happens and we get more and more parabolic, the amount of risk they take goes parabolic. But what should be happening is as the price goes higher, you take less and less and less risk. You should be aping $50,000 into a new coin at the top of the bull run, because the closer you get to the top of the bull run, the more potential downside, the more asymmetric the downside becomes and the more risk you take on for every position you enter. You should only enter things when the upside is asymmetric, but obviously towards the end of the bull run, you run out of asymmetric opportunities. And when you have less asymmetric opportunities, you should be positioning less because there's a higher chance of downside and losing money. And also you need to account for the fact that you are completely lost touch with reality. And because you've lost touch with reality, you have to position on the defensive because you're so caught up in this mousse of money that you've made. How much the money you're putting in is actually worth. Oh, I'll chuck in 10 grand to this coin. You can't recognize how big 10 grand is when you just made 100 grand. So you need to play the defensive towards the end of the bull run, even if it doesn't feel right. You just have to. Number 2, withdraw the money to your bank and see if it feels any different to being in a crypto wallet. So when you have 100K in your MetaMask, that's very different to having $100,000 in your bank account. Money in your bank account feels different. Imagine having 100 grand cash and lighting it on fire. You wouldn't be able to do that, but you could fucking light on fire 100 grand in the casino. So the place you hold your money will massively impact your perception of the money. If you ever lose touch with reality, you should be taking money to your bank account and then send it back to the exchange later on. It's fine. It's not a big deal. Oh, but you can't send money to your bank account. Well, that's a fucking problem. You should probably fix that. Withdraw your money to your bank, pay 1% in fees, but get the mental solution to the house money effect. Another one, show your friends and family and see what they think of your portfolio. Show them the $1 million that you have and tell them what you're going to do with it. They're going to tell you that you're a retard and you should probably listen to them. Understand that greed is endless and you will always be fighting for more profits. You must force an end when the bull is near its end. So So the thing with money, and I've realized this, I have multiple millions now and I'm aiming for 8 figures. And I can tell that when I get to 8 figures, I'm going to want more. I'm going to go, I want 20 mil. No, I want 50 mil. I want 100 mil. The greed for money never ends because numbers are endless. And there's always going to be a higher target. And in fact, if you stop aiming for more, you'll end up getting depressed because life is just this continual movement forward. And if you ever just stop doing things, stop going to the gym, stop making money, stop working, you just sit around and do nothing, you get depression and you get fucking sad. You have to sort of always aim for more in a lot of areas. It ends up fucking with you as well. So the answer here is not to never care about money. It is to balance the greed and understand when it's time to stop and also still aim for more. It's a balance. Not too much greed, not too little effort to try to achieve more, basically. Now, next one, go spend time in a third world country to see how much of a moron you are for being willing to lose so much money and not care. And that's what you guys should consider. Like, if you ever lose touch with reality, go and see what probably like half of the population experience not making much money, living to quite a low standard compared to what you might be living now. That'll give you a reality check. And last but not least, have an exit strategy so that you can sell at the end of the bull run and be held accountable to it. So most people, they never know when to stop gambling. This is the biggest thing that you guys need to fix. If I had one thing that you guys need to get correct, it's knowing when to stop gambling in the casino. Or stop, knowing when to take your chips out. That's the biggest thing. That's the biggest problem that people have. They all make money. Everyone makes money. It's easy to make money. But no one keeps it because they don't know when to stop. So the key is to have an exit strategy to mitigate against house money effect. If you know that it's time to exit because the bull run's at an end, that means that you can't gamble anymore. The house money effect doesn't matter because you're not going to gamble anyway. You're done. You're out. So I think that's the end. I'll see you in the next video.